Very good morning, everyone. So today we are going to complete of a chapter called as Forex. Once that is completed, then we will be going into options. Once we complete the options, I will be touching out all the important concepts like understanding the basic concept of options. Two problems we will do. After that, option payoff concept. Later we directly go into the option strategies and dividends in options. So option strategies, options we can give a maximum of 3.5 hours for the today's session. In that we will be completing binomial risk neutralization model, Black-Scholes model and arbitrages in options and some basic concepts. Okay. Once that is completed, then we will be moving on into a small another area, continued area called as a currency options and futures. After that, I will be taking 1.5 hours each for 3 different chapters: mutual funds, mergers, acquisitions, and the concept called as the mergers, acquisitions, mutual funds, and security valuation concept. Because security valuation we have done only a couple of problems along with the corporate valuation chapter, but some important questions are there. So 1.5 hour will give the time, and lastly I will cover up the swaps as well. Clear? So once options and futures are understood, swaps is not a big deal. So first, in the yesterday's session we started with the concept called as Forex. In that we have completed up to covered interest arbitrage with a single quotation as well as two-way quotation. Okay, so two-way quotation also completed. So two-way quotation also completed. Everyone understood the concept of covered interest arbitrage and the procedure? Done. Let us now move on into the next one. So we have completed question number 25 and 26. Okay, covered interest arbitrage is over. Next. Okay, keep the heading hedging. Hedging. Next concept, hedging. So see here, hedging the following types are there: forward hedging, money market hedging, leading, lagging, exposure netting, currency options, currency futures. These are all the hedging strategies. Now we are going to complete all except last two. Last two I said na, understand until you understand options, you can't do currency options. Okay. Futures anyway we completed na, you can do currency futures, no problem. But still let us do together. Why to do 3 problems there and again coming back, again doing 2 problems and again coming back? Let's not do like that. Let's complete everything. So our target is to complete how many strategies now? 5. What is the first one? Forward hedging, money market hedging, leading, lagging, exposure netting. Exposure netting means creditors and debtors will be there in 2 different countries. Okay, we will do one problem on that, remaining look alike. So anyway, see here, forward hedging, money market hedging, leading, lagging. In this, first 2 are most important from the exam's point of view. Last 2 are most important. Remaining are asked in examination, but very, very rare. Okay, even they are asked not so great, not so difficult as well. Dead easy concepts, leading, lagging and exposure netting. The main focus of the examiner will be on 3 areas. Number 1, forward hedging. Number 2 will be money market hedging, and number 3 will be currency options. Number 4 will be currency futures. This he will give full marks. 8 marks questions will come from these areas. So let us first start with forward hedging. What is the concept? Forward hedging. So let us take some questions in this regard. Sir, forward hedging means, see here, what we have to do in this forward hedging questions. In the question, he will give you spot rate, forward rate, unhedged rate. Spot rate means the rate which is quoted today for a transaction to happen today. Forward rate is a rate quoted today for a transaction to happen at a future date. Okay. Unhedged rate is also called as a EFS, expected future spot. Very popular word. Expected future spot means if you don't go for forward hedging, I repeat, if you don't go for forward hedging, for example, I will receive money after 3 months. Okay. Today itself, I will lock a forward rate with the banker. That will be called as a forward rate. If I don't lock with the banker, what will happen? One rate will be there on the day all around. That's called as a expected future spot. Clear, everyone? In this regard, I have to tell you certain things. Please see here. Rates. In the point of view of this concept, 3 rates are important. Number 1 will be Number 1 will be spot rate. Number 2 will be forward rate. Number 3 will be expected future spot. It's also called as a unhedged rates. Okay. If you don't go for hedging, that will apply. Now listen carefully. Sir, how questions will be tested? When I tell forward rate, listening everyone, when I tell forward rate, there can be 3 types of forward rates he can give in the question. One is called as outright forward. Second one, swap adjusted forwards. Third one, IRPT forward. When I tell forward, it means outright forward or swap adjusted forward or IRPT forward. EFS. EFS is also having 3 types of EFS. Outright EFS. Second one, fixed percentage differential. Third one, EFS through premium or discount. EFS through premium or discount. There are 3 types. So there are 3 types of rates. One is a spot rate, another one is a forward rate, another one is a expected future spot. Forward rate are of 3 types again: outright forward, swap adjusted forward, IRPT forward. And EFS will be of 3 types: outright EFS, fixed percentage differential, and EFS through the premium or discount. I will first explain what is the meaning. After that, we can go into the analysis. See here. Outright forward. Forward rates will be directly given in the question. They will only tell 1 month forward, 6 month forward, 3 month forward. They only given in the question. Clear? You need not do anything. No calculations, no adjustments required. Directly they will give. That's one type of forward. Second type, swap adjusted forward. What do you mean swap adjusted forward? They will give the spot rate. They will also give you the swap points. You have to adjust descending and ascending accordingly. This is second type they will give. Third type, they don't give anything, but interest rates will be given in the question. What does it mean? They don't give any information. They will give only interest information. What to do? IRPT forward you have to calculate and assume that IRPT forward is the actual forward traded by the bank. Clear, everyone? This is one kind of forward. So forwards can be calculated in how many ways? 3 ways. Number 1 will be outright forward. Number 2 will be swap adjusted forward. Number 3 will be IRPT forward. Next, EFS, outright EFS. What does it mean? Directly they will only give. The swap rate is expected to be $1 equal to 81. They will only give in the question. Clear everyone? That's the way. Second one, fixed percentage differential. They will tell in the question, dollar is, okay, dollar is going to, for example, you should change by 2% or 0.5%, 0.6%, they will tell like that. Or they will give you the premium discount information. What information? Premium discount information. Accordingly, you should add and deduct. Okay, this is the third type. So when you do the problems, you can understand all the 6 types. First point, everyone understood that there are multiple rates given in the question. Yes or no? Tell me, what are the 3 rates? Spot rate, this they will give anyway. Next one, forward rate and expected future spot. What is the hedge rate here? Hedged rate is what? Spot and forward both are hedge rates. Because what do you mean by hedging? It is to cover unexpected losses. When you make the payment to today, there is no fluctuation in foreign exchange. Listen, future is uncertain, present is uncertain. Sir, what is the purpose of this entire hedging process? Dollar payment or dollar receipt we are going to make today in future. At that time, the dollar price may increase in imports, it may decrease in case of exports. Sir, no. If I receive every rupee today itself, that means if a spot is received, automated hedging, you need not do anything. If there is a forward hedging, whatever the rate may be on the expiry date, you will get a particular rate. For example, I go to the banker, lock myself at 78 rupees. Whatever may be the rate on the date, maybe 85, it may be 75. I will be paying only 78 or receiving only 78. Everyone understood the point clearly? So therefore, that's the forward rate. EFS is always dependent on one's perception. I presume that if dollar is continuing like this, it may reach 85 next year. I will feel like that. Clear or not? On the basis of the past movements of this particular dollar, I assume that dollar may increase to 85 by another 6 months. I can tell like that. That can happen, cannot happen. Anything can happen. That may happen, that may not happen. It is only an expectation. Clear or not? Whenever you are going by EFS, the danger is your position is hedged or unhedged. Unhedged, it is only a expectation. Clear everyone in the class? Shall we start doing the problems now? So tell me, in every question that we are going to do now, 3 rates will be given. Number 1, spot rate. Number 2, number 3. Let's do the problems. Let's make it very fast. Take question number 31. Let us do. Sir, in hedging, listen, in hedging, actually I spotted only 4 problems for you in the yesterday's class. Okay. Now I am telling you we are going to do 8 problems on hedging. 8 different categories of problems. Clear? So, therefore, please do as fast as possible. Okay. No steps are required. Just you repeat the steps and write down the final answer there. See the question. JKL Limited, an Indian company, has an export exposure of Japanese yens 1 crore. Japanese yens 1 crore 10 lakhs. 1 crore. Payable 31st August 2014. Japanese yen is not directly quoted against Indian rupee. Sir, when the yen is not quoted against the rupee, what to do? Cross currency quotations. Using what currency? Common currency. Read. Current spot rates. Underline that. Spot rates. Exam question, sir. 6 marks. Current spot rates are dollar by rupee. Sorry, rupee by dollar. Means how much? 62.22. Yen by dollar. 102.34. Next, continue. It is estimated. When I use the word estimate, it is called as what? Expected future spot. It is estimated that Japanese yen will depreciate to 124, Indian rupee will depreciate to 65. Forward rates directly given. So these are which kind of forwards? Outright forwards. Directly they will give the numbers. You need not do anything. Calculate the expected loss if the hedging is not done. How the position will change if the firm takes a forward cover. So just 1 minute. Read the question. We'll go with the analysis. Shall we do, everyone? First point number 1. Directly quotations are given or not given? First, what we have to calculate? There itself, please solve. We want spot rate for rupee by yen. Rupee by yen equal to, write on, rupee by dollar. Hey, why you are waiting for answers here? Tell and write rupee by dollar into dollar by yen equal to, what is the rupee by dollar? 62.22 into, sir, given is dollar by yen, original, given is dollar by yen by dollar. So, how to write? 1 by 102.34. Please tell the rate. 4 digits, 0.60. 80 na? 80, no problem. Write down. Continue. Next, here also like that. 65 into 1 by 124. Tell the rate. 0.5242. This also 66.50 divided by 110.35. 0.6026. Hello, everyone understood what we are doing? What we calculated? That's all. Cross currency quotations we calculated. Sir, when cross currency quotations will be calculated? When two currencies are not directly quoted against each other, but both are quoted against a common currency, we will go for a CCQ. What is the two currencies not quoted together here? Rupee, but both are traded against a common currency called as, therefore dollar we are taking as a base currency B. Clear, everyone? Okay, now tell me how to do the answer now. How to do the answer? Can I get an answer now? Tell how. Difference. How to present this answer? Sir, can I take calculator now? What is the EFS receipt? 0.5242. What is the forward receipt? 0.6026. Write down. Take it at 0.6026 minus 0.5242. How much profit on each yen? 0.0784. Yes or no, everyone? Like this you should not do. Okay? Listen carefully. Whenever hedging questions are given, institute will follow a format, rather that is a correct format. For God's sake, fortunately they have done correctly. So see here how they have presented the answer, and that's a good presentation. First, always whenever hedging questions are given, first thing you should understand, we need to open 3 columns. Please don't write, I will give time. Particulars, hedging not done. Second one is hedging done. You answer me first, point number 1. Answer my question one by one. First tell me how much I am having a receipt. Receipt how much? 1 crore. First tell me hedging, 1 second. Applicable rate. You only tell me what rate will apply if hedging is not done. 1 yen equal to rupees 0. Answer, sir. 5242. Here. Point. 1 second. 1 yen equal to rupees 0.6026. Okay. This is base information they will take. First tell me what is the spot rate. 1 yen equal to rupees 0.60. Likewise here also rupees 0.6080. Now listen carefully. You should only answer my question now. Tell me, if hedging is not done, Answer everyone, don't sit idle. If hedging is not done, okay, I will receive 52.4, sorry, 0.5242, yes or no? If I would have received everything in the spot without going to the credit sales, I would have received how much? Repetition once again. If I would have received everything in spot, how much I would have received? Not going for spot, but postponing my receipt, I am getting how much if hedging is not done? Answer. Now tell me, what is the difference? Loss or gain? First tell me that. Loss or gain? How much? Rupees 0.838. This is a loss. Clear? Now tell me, hedging if done, everyone answer, hedging if done, loss will be there or will not be there? Will be there. I said very clearly in yesterday's class, hedging is not a profit making strategy. Hedging is a stop loss strategy. Sometimes it can stop entire loss, sometimes it can stop substantial loss. Okay, take there. Second part, how much I would have received if I would have received everything in spot? 0.6080. How much I will receive if I go for a forward quotation? That means how much loss I am getting because of going for credit sale. Please tell me. 0.054. Tell me, what is the total loss? Rupees 8,38,000. Next, rupees 54. Now tell me, I would have got a loss, everyone. I would have got a loss of how much if I don't go for hedging? I would have got a loss of when I go for hedging. That means how much loss is covered? 8,38,000 minus 54,000. Exactly, that's what you got in the previous case. The difference between EFS and forward, 0.0784 you got. So how much it is? Rupees 7,84,000. Please see here once what he is asking in the question. Calculate the expected loss. Loss A will come if hedging is not done. Okay, first calculate the loss if hedging is not done. Tell me, what is the loss if hedging is not done? Next, how the position will change if the firm takes a forward cover. If the firm takes a forward cover, we can cover 7,84,000 rupees of loss. That's how you need to present the answer. Are you understanding or not? Sir, directly you take the calculator, 0.6026 minus 0.5242 into 1 crore. Like that also you will get the answer. Half mark also he will not give. Because that is not what he is asking. Are you understanding or not? He is asking, first tell me what is the loss if hedging is not done. I pen one bit over. Clear? And how you are going to cover that loss with hedging is the second bit. This is the second bit. So this is a loss. This is a loss if hedging is not done. This is the loss if hedging is done. In both the cases, what is coming? Loss A coming in both the cases. But what happened in the second case? Because of shifting from the case 1 to case 2, I am going to cover huge loss or not? Marginal 95% loss I have covered. Clear or not, everyone? This is how you need to present the answer. Make it fast. Copy down. Sir, I am telling you again and again. Last day also I am telling the same presentation. SFM marks, if they are not coming, the only reason is your presentation. You are making direct steps. Or they will ask one thing, you are doing another thing. Completed? Completed everyone? Can go to the next one. Next. So no problem. This is there in study material also. No problem. All the questions, whatever I am going to do now, everything is there in your study material. No worry. They also present in the same way. That's what I said. I think you are not there at that time. I said that also. Institute fortunately presented same. First time they presented well. What they asked is what they have given. So anyway, everyone comfortable with doing this answer, everyone? So tell me, in every question they will give how many rates generally? 3 rates. Number 1, spot. Number 2, forward. Number 3, EFS. Understand the rates and do the question properly. Okay, now let us do another question. So how many questions we are targeting? 8. How many questions completed? 1. Next question on forward hedging. Let us go by question number 35. Fast. But I can't spend so much time on every question like this for 10 minutes. Please make as soon as possible. Let us read the question together. Question number 35. Shall we read? A company is considering hedging its foreign exchange risk. It has made a purchase on 1st January 2008 for which it has to make a payment of $50,000 on September 30th, 2008. So tell me, how many months forward? 9 months forward. Okay. Present exchange rate is $1 equal to 40. It can purchase forward $1 at 39. So tell me, what is the spot rate? Right on there, spot. Forward, how much? 39. Next. EFS given or not given? EFS given below 42, 38 EFS. Below. At the end, 42 and 38 EFS. The company will have to pay an upfront. Upfront means advance. Upfront premium of 2% of the forward amount purchased. The cost of the funds to the company is 10% per annum. And the rate of corporate tax is 50%. Ignore taxation. God should know why they have given. Consider the following situations and compute the profit or loss the company will make if it hedges its foreign exchange risk. If the exchange rate on 30th September is 42 or is 38. Now tell me, how many rates are again given in the question? Number 1, number 2, number 3. First thing, we are exporters or importers? See their payment. Payment or receipt? Importer, exporter? Buy or sell? Buy foreign currency or sell foreign currency? Here it doesn't matter because there is only single quotation. If it is a dual quotation, your understanding matters. Okay, single quotation, no problem, whatever you assume, but still having a clarity is always a good thing. So tell me, first point number 1. If I have to pay everything in spot, I would have paid at how much rate? Because of going for a credit purchase, I am subjected to a risk. Yes or no? Because of going for credit purchase, I am subjected to a risk. Tell me, dollar will be same in both these scenarios. So dollar will change. 1st January dollar rate to 30th September dollar rate will be same or different? Risk of hike in prices or fall in prices? Raise in prices or fall in prices? Raise in prices. To cover myself, I entered into hedging. Hedging, when I am entering, how much is the forward rate? How much is the forward rate? Wrong answer. 39 plus premium plus opportunity cost. 3 things are there. What are they, sir? 49 forward. Okay, on that, how much he is asking upfront premium? 2%. And because of that paying upfront 2% premium, I am subjected to an opportunity cost or not? All those are added to the cost of forward to the company. Shall we start, everyone in the class? First, keep the heading. Step 1. Step 1. Question number? Step 1. Calculation of forward rate to the importer. Calculation of forward rate to the importer. Okay. Let us do below, everyone. Start. Point number 1. Tell me, how much is the forward quotation? Everyone answer. $1 equal to how much rupees? 39. Plus upfront premium, how much percent I need to pay? 2%. 39 into 2%, how much? 0.78. Plus opportunity cost, 0.78 into 10% into 9 by 12. Why 9 by 12? 9 months into 10% into 9 divided by 12. 6 into 10% into 9 divided by 12. It is 0.0585. 0.0585. So tell me, what is the total cost? Rupees 39.8385. This is what rate? So tell me, listen, when I go to the bank, the forward rate is quoted at 39.8385. Wrong, 39. Cost to me is 39.8385. Yeah. How you lose the marks? This is how you lose the marks. Do you know, if I ask in this question, calculate the forward premium or discount. If you take this forward premium discount, you should take as per the bank quotations. This is a net cost for us. This is a rate quoted by bank. This is a charges asked by the bank. This is the loss of interest for me. This is a cost for me. This is what bank collected. Clear, everyone? If you have to calculate premium discount, what is the formula? F minus, yes, at the time F in the place, how much you need to write? 39, not 39.8385, not even adding the premium. Premium is a charge, it's not a cost of the exchange. So have clarity. So therefore, tell me, cost for me is how much? That is correct. Cost for me is 39.8385. Shall we continue? Now let us do this problem together now. Same format. Step 2. Calculation of import outflows. What are the two options we need to consider? What is the format? Particulars. First, hedging not done, hedging done. Hedging not done. Second one is hedging done. You should only tell me the answer. Same format. What is the applicable rate? What is the applicable rate? $1 equal to rupees. Hey, first applicable rate. Sorry. I'm very sorry, sir. Very sorry. 42. EFS na. Next minute దొరికిపోతారు ఎందుకు? ఎక్కువ టైం కూడా వెయిట్ చేయగల నేను. So how many cases are there? 2 cases. Case 1, write down. $1 equal to rupees 42. Case 2, $1 equal to rupees 38. Let's write both. And hedging is done common rate. $1 equal to rupees 39 point. How much you got? 39.8385. Okay. Hedging done. Hedging done means which rate will apply? Forward rate will apply. That forward rate plus premium plus opportunity cost. Everything will apply to me. Everyone. Next, applicable rate over. What is the next one? Spot rate. If I would have got everything at spot, how much I would have paid? Rupees 40. $1 equal to rupees 40. Now, lastly, spot rate also done. First, tell me what is the difference. I want 42 minus 40. Sir, I would have paid 40 if I have done in the spot. Answer. If I am not hedging myself, 42 I have to pay. There is a loss again, a loss. How much? 2 rupee loss. Case 1, rupees 2 loss. Case 2, rupees 2 gain. Rupees 2 gain. Okay, now rupees 2 gain. In this case, always there is a loss. Loss or gain? Gain, 39, okay. Try the difference, minus 40. How much? Point. Plus 0.1615. So can you please give out the difference? If first case, let us take, if hedging is not done, hedging is done. First case, not done. Hedging is not done. What is the rate applicable? Answer, yeah. So if rate is not applicable, if that particular rate is applicable 42, in that case I will get a loss of 2 or not? Now tell me, loss of 2, okay, loss of 2 is made as a profit of 0.1615 means how much change is there? Please calculate. 2 plus 0.1615. So how much? So in the first case, case number 1, tell me everyone, rupees 2.1615. Did you understand what I said here, everyone? I repeat once again, listen carefully. If I would have paid everything at spot, I repeat, if I had paid everything at spot, listening, tell me, if I had paid everything at spot, I would have paid how much? Because of going for hedging, I am paying only how much? That means because of forward, this time loss is not there. We are also getting some amount of a profit. Up to here, understood or not, everyone? Next, compare with the second case. If I do not hedge myself, instead of paying 40, I will pay how much in the first case? I will pay how much in the first case? Therefore, I am paying excess, I am paying lesser. Excess how much? Now compare this with this. Okay. If I don't go for hedging, I will be experiencing a loss of how much? That loss will be turned into a profit of 0.1615 if I go for hedging, yes or no? That means minus 2 will first become 0. 0 is again increased to 0.1615, means technically how much profit how much change it has brought? 2.1615. Understood a point, everyone? How many dollars are there? How many? Total calculate. 1,75,000. This is one answer. Second, you should tell me now, if I don't go for hedging, second case, if I don't go for hedging, I would have paid how much? Some people are not even seeing the notes. Please see there. If I don't go for hedging, what rate is applicable? Forward, EFS, EFS rate. So EFS rate, if I pay, how much I will pay? 38. Instead of paying, that means I would have got a gain of how much? Answer. But because of going for forward, I have to pay 39.8385 or not. Now you can answer, plus 2 profit is made as plus 0.1615 profit, means because of going for hedging, I am experiencing a gain or loss. Tell me how much? Case 2 minus, tell me, 2 minus point, how much? 2 minus 0.1615. How much loss? 1.8385 into how much? $50,000. Tell me. 925. This is the loss because of going for hedging. This is how you have to do. You can present this in a different way. Just I am roughly telling you how to do in this particular question. One important question is there. Once for all, I have my doubts. Please clarify my doubts. After that, we'll go to the next one. Point number 1. If I would have gone for, listen, if I would have gone for forward, how much I would have paid? If I go for forward, how much I have to pay? Because of not going for forward and keeping my exposure uncovered, first case la I have to pay. So first case, if I don't hedge, I have to pay 42 for each dollar. If I go for hedging, I will pay only 39.8385. Clear? So how much? If I don't go, I will get a 2 rupee loss. If I go for hedging, I will get a 0.1615 profit. Means that technically, because of going for hedging, how much profit I am making? So that's the first case answer, everyone. And the second case is 91,925. Everyone understood the workings clearly, yeah? Everyone in the class. So this is how you have to do this particular problem. Understood the point clearly? Let us go into the next one. You can see the institute study material also for this. How the answer has been presented. Ditto, but they will convert everything into $50,000 and they have said. Next. Which question we have completed? Question number 35. Next one. Take question number 33. How many questions we promised totally? 8. How many completed? 2. Another 6 we have to do. So take. Again, past exam question, study material question. Let us do. Excel exporters are holding holding an export bill in United States dollars. 1 lakh due 60 days hence. They are worried about the falling dollar, which is currently at 45.60 per dollar. The concerned export consignment has been priced on an exchange rate of 45.5 per dollar. The firm's banker have quoted a 60-day forward rate of 45.2. Calculate the rate of discount quoted by the bank. The probable loss of operating profit if the forward sale is agreed to. This is a question he is asking. Read the question first before we go for a solution. First tell me, can we calculate the rate of discount quoted? Answer. Tell me, in this question they have given forward, spot and EFS. First tell me, what is the spot rate? Very good. What is the forward rate? 45 point? Okay, now tell me, can we calculate the forward discount in this case? Everyone in the class, what is the formula? F minus S by S into 12 by N, or 12 by N or 360 by 60 into 100. Can we calculate? Let's do that here itself. 45.20 minus 45.60 divided by 45.60 divided by 360 divided by 60 into 100 minus 26 per annum. We converted into per annum terms. 5.26% per annum. This is the rate of discount quoted on the dollar. Listening everyone? 1 point over. Probable loss of operating profit if the forward sale is agreed to. Tell me, if I would have received at spot, how much I would have received? Answer everyone. Because of going for a forward, I would have received only how much? So the difference between 45.60 and 45.20 being 0.40 for every dollar will be the operating loss. Yes or no? Wrong. Listen carefully. The point is, listen, please understand the concept. So the point is, He is asking a question, calculate the probable loss of operating profit. What profit? Operating profit. Can you please explain what is an operating profit? EBIT. Okay. EBIT. Operating profit. Okay. EBIT. Probable loss of operating profit. First listen to my question. How much is the export to consignment invoiced at? What is the spot rate at which export is invoiced? 45.50, not 60. Spot is traded at 60, but we are giving the invoice only at 45.40. That means in the books of accounts, in the records, sale is recorded at 45.50 na, sale is recorded at 45.60 na. Answer. We are making payment to today na, in future na. How many days? Answer. We are making a credit purchase, credit sale, normal cash sale. So we will be receiving today na, after 60 days. Answer. So nothing we are going to receive today. Therefore, we can invoice at any rate possible. Our company invoiced in the books of accounts at 45.50 for each dollar. That's what he is telling there. That means if I have to calculate the loss in the books of accounts, I should not take 45.60 because in my books 45.60 cannot be found. Clear or not, everyone? I recorded sale at 45 point. Now tell me, at the end, I enter into which contract? In which I will receive how much? Now tell me what is the difference? 0.3 into 1 lakh, how much? That's the answer for the given question. Check the study material as well, same answer. Understood the point or not? Here, what is the main important point, sir? Operating profit means we are talking about books of accounts. So therefore, you can write here itself 45.50 minus 0.20 into 1 lakh. So the answer will be 30,000. 45.50 minus 45.20 into 1 lakh. Answer is 30,000. First one, everyone understood the concept clearly or not up to here? Done. We have done the another one. So what is the promise that we made? How many? 8. How many are completed? 3. At how many had to be done? 5. Let us do those. Take question number 37. Again, study material question. You can open your study material. You will find that question. Let us read. Fast, everyone. What is the question? Shoe company sells to a wholesaler in Germany. The purchase price of the shipment is 50,000 Deutschmarks with a term of 90 days. Upon payment, shoe company will convert the DM into dollars. The present spot rate for DM per dollar is 1.71, whereas 90-day forward rate is 1.7. You are required to calculate and explain. If shoe company were to hedge its forex risk, what would it do? What transactions are necessary? Is the Deutschmarks at a forward premium or at a forward discount? What is the implied differential in interest rates between the two countries? Use the interest rate parity assumption. Mark this question important. Read the question properly. Who is buying, who is selling? First get that clarity. Number game we can do later. Completed? First one, answer. Shall we continue? So first answer my question clearly. Two companies sell to a wholesaler in Germany. The purchase price of shipment is 50,000 Deutschmarks. Like that he has given certain things. Okay. We are Germany or USA? We are Germany or USA? Obvious, because if we are Germans, Deutschmarks is our currency, then Forex chapter does not apply. Okay. So first assumption is we are from USA. Sorry, 1 point over. We are having a payment exposure or receipt exposure. Receipt or payment? Receipt, because shoe company in USA is selling. So therefore it is having a exporter, importer, export. Receivable or payable? Receivable. Next, 50,000 Deutschmarks. Upon payment, shoe company will convert the DM into dollars. Okay. Purchase, the present spot rate 1.71, forward rate is 1.70. First one, what is asking is if shoe company were to hedge the risk, what it has to do, what transactions it has to do. Tell me, theory question. Sir, in order to hedge the risk, what it has to do? It is having a export exposure or import exposure? Receivable or a payable? There is always a risk of fall in. Therefore, the company has to enter into an agreement with its banker for purchase of a forward quotation, such that whatever the price may be in the future day after how many days? 90 days, he will get the same amount of receipt. That's a theory answer. Up to here, understood? Now, see and tell. Deutschmark is at a forward premium or discount. He is not asking percentage. He is asking to tell whether there is a forward premium or discount. Sir, what is the forward rate? What is the spot rate? So there is a premium or discount? Wrong answer, already in reverse. Yesterday I told you one point. Always appreciation, depreciation will be on per unit currency. That is the question. See there. First, there, what is the per unit currency in the given question? Answer. He is asking premium discount on? Where you are here, everyone? First one, tell me, in the given quotation, per unit is what? He is asking premium discount on? You cannot calculate like that. So, always per unit only is subjected to calculation of premium discount. So, first what we have to do? Convert these currencies into per DM basis. Okay. So, tell me. Now, spot rate 1 by 1.71. 0.5848. Yes or no? Yes. 1 by 1.7. 0.5882. Now tell me, forward 1 DM equal to dollar, 1 DM equal to dollar. First, what is the spot? 5848. What is the forward? 5882. Now tell me, forward is at a premium or discount? Answer. That's all. Answer over. First, second bit over. Next, he is asking the amount of percentage difference. 0.5882 minus 0.5848 whole divided by 0.5848 into 360 divided by 90 into 100. Answer is 2.33%. Sir, what is the only new point we learnt in this question? What is the only important question we found out in this question? What is the important point? The given quotation is given in which currency? I told 100 times yesterday. Again you are forgetting today. Whenever question is given in Forex, first what you have to see? On that only the transaction should happen. But in the question he is asking premium discount on what? DM. That means that should become per unit to calculate. Are you understanding or not? Next. So 37th over. Tell me how many I promised totally? 8. How many completed? Answer, sir. How many are still pending? Another 4. Only on hedging, only on forward hedging, another 4 are pending. Let us take question number 32. Mark it, very, very important for exam. Minimum 4-5 times that question has been tested. That question and 34th also. Minimum 3-4 times in the last 5-6 attempts. This is called as external commercial borrowing in FEMA, supplier's credit. The other day when we are discussing about law, external commercial borrowings we discussed. In the external commercial borrowings, we got a point called as there are 7 types of external commercial borrowings under the FEMA. So buyer's credit, supplier's credit, like that 7 list I have shown you. So one is a buyer's credit, another one is a supplier's credit, second and third one will be the FCCB, fourth one will be the FCEB, fifth one will be the financial leases, sixth one will be the loans, seventh one will be the secured debt instruments and floating and fixed rate bonds and optionally convertible debentures. So these are all said in ECB FEMA guidelines. In that the first one, supplier's credit and buyer's credit, this is the thing. 32nd question. First, let me explain what is the concept involved inside. After that, we can go into analysis. Point number 1. There is let us read first. Z Limited importing the goods worth how much? US dollar to everyone. Please read. X Limit, Z Limited, importer, exporter. Payable or receivable? Okay. Goods worth US dollar 2 million. Requires 90 days to make the payment. Overseas supplier has offered a 60 days interest-free credit period, and for additional credit of 30 days, an interest of 8% per annum. The bankers of Z Limited offer a 30 days loan at 10% per annum, and their quote for exchange rates are as follows. Spot 56.5, 60-day forward 57.1, 90-day forward 57.5. You are required to evaluate the following options. Pay the supplier in 60 days, avail the supplier's offer of 90 days credit. These are the questions that is being asked. First read, later we go into the analysis part. Read the question properly. Completed? Have you read the question? First, point number 1, answer. We are having a importer, exporter. Goods worth how much? And how many days credit? Very good. Next, I can make payment within how many days? Answer. Wrong. You cannot make. 90 days when 90 days credit, why you will take? Because you can't pay within 90 days. I been the answer. Akkani any mistakes inka. From there, everything you write in examination, you will be driven towards wrong answers. So, first point, I can't pay within 90 days. So, in no case I can pay within 90 days. Then why I will take 90 days credit? Early payment, he is not talking there. So, tell me, I will not get money within how many days? I will get money after 90 days from some person. Then I will make the payment. Within 90 days, you don't even dream that I will get money. Everyone understood the concept clearly, yeah? So the first point, I don't get money within the 90 days period. First point, everyone understood, So, but what happened is, overseas supplier has offered how many days interest-free credit? 60 days. That means, see here, listen, we have 2 options. Option number 1, take the supplier's credit or take a loan in India. Take a loan in. Now listen, 0 date to 60th day. Will the supplier ask any interest or will not ask? Answer. Therefore, postpone up to first 60 days. Clear? 61st day. take loan in India, repay him immediately. 60th day, take loan in India, repay him immediately. Repay whom? Let's start from the beginning again. Tell me. Please. Listen. Point number 1. How many days is the total period? In this, how many days interest-free credit period is there? Answer. That means for the first 60 days, I don't make the payment in any case. I'm not a fool. Okay. In 60 days, I don't make a payment. I will happily avail 60 days interest-free credit. 60th day end means 61st day, I will take loan in India from my banker. Okay? Okay. I will raise money. Immediately, I will convert them into dollars. Dollars is some payment. What dollars? Dollars. And I will immediately make the payment to him. For the next 30 days, I will pay interest in Indian rupee. In that, I will get one outflow calculation or not. We will keep it aside. That is called as credit in India. Clear, everyone? Next, tell me again. How many days is the total period? 90 days. How many days interest free? From 61st day to 90th day, I will be having a interest. Yes or no? I have a second option. Supplier will give that. Who will give? Supplier. He is charging how much interest? 8%. For how many days? Per annum he will charge, but I have to calculate for 30 days. So now tell me. First 60 days? Interest free. Next 30 days? I will not take loan in India. I will take the credit period of given by whom? So next 30 days I will take this supplier's credit of how much percent? Now tell me, in the first case, I will make the payment at the end of? Answer. In the second case, I will pay at the end of? Therefore, in the first case, I request 60 day forward or 90 day forward. In the second case, these are the informations that we require. Clear, everyone? This is how you need to sum up the information. Sir, Institute Study Material books, normally they presented this answer, but what I have done is I have created a time chart for this. How to understand these type of questions when they come in examination. See the screen once. See here. Pay supplier in how many days? 60 days. Pay supplier in 60 days. Please see the screen once. These are all the transactions that we need to understand. Point number 1, D0. D0 means what? Day 0, today. Today what we are going to do? Purchase of goods on credit. Done. One transaction over. Second, we decided to go by option 1. What is option 1 given in the question? Pay supplier in. Sir, I can pay supplier in 60 days. How? Avail a loan at the end of 60 days in foreign country, in India na, and pay him. Clear? So read. First one. Purchase goods on. D0. Purchase goods on. Second. Decide to go by. When I decide to go by option 1, first tell me. Option 1, I have to pay the supplier within 90 days or 60 days. Today itself go for a 60-day forward contract to buy dollar. Clear or not? Next, today itself, apply for a loan to be disbursed after how many days? 60 days. Or else if you go by 60th day, they will tell come after another 10 days. Therefore, today itself I have to enter into which agreement? Loan agreement. Listening everyone. Loan agreement and take a loan. You need not take loan today. It will be disbursed at the end of how many days? 60 days. D0 to D60 happily you sleep. Why? It's an interest-free credit period. Clear everyone? Next after that, what I have to do? 60th day. Actually borrow rupee. Actually borrow. After borrowing rupees, what I have to do? Convert. Convert into what? Dollar and convert into dollar at which rate? Forward rate. Which forward rate? 60 days forward rate. Already we have blocked it. Convert it and pay to the creditor. Pay the rupee borrowings along with the interest at the end of 90 days. Answer will be completed. Understood the process, everyone? First tell me, what is the thing that we need to do today? Don't see this. Tell me, what is the thing we need to do today? First we need to do credit purchase. Second one we are exercising option number 1. Third, today we are also doing what? block a forward rate. Which forward? 60-day forward. Also go for a loan agreement to be disbursed after how many days? Next, 0 to 60. Interest free credit. 60th day, what you are going to do? Really take a loan and repay whom? By converting rupees into, at what rate? Which forward rate? Now everything is done. Now what is only pending for you? Loan in India that has to be repaid after how many after how many days? With interest or without interest? With interest of 8%. How much? 10%. Indian loan rate we have to apply. Up to here, understood everyone? That's all. Copy down this. Answer is very simple, provided you understand the quotations and the things. Again, I am telling you, presentation, how you present itself will matter in exam. How beautifully you are going to present in a stepwise format, each and every point. How you write theory, how you write the answer, how you present yourself is more important than doing the answers. Completed? So completed the first model. Sir, tell me, I am not going by this. What is the second option available? Avail the supplier state of 90 days. That means will I touch the loan within India? Na? No, within India, I will not take any kind of loan. So within India, we will not touch any kind of loan transaction. Everything will be done only in supplier state, being an external commercial borrowing type. Okay. So now you should answer. Tell me, invoice value will be same or different? Same. 20 lakh dollars will not change. Rate will change or will not change? Answer. Tell the transactions. D0. One you have seen. Second, can't you guess what happens? First thing, what you have to do? First, purchase goods on and avail. And avail. First, purchase the goods and you are deciding that you have to pay only after 90 days. Second, D0. Now, second, I am selecting option 1 or option 2. When I select option 2, first I have to avail if interest be great or not. Before that, I have to pay him today, na, after 60, after 90. I have to book which one? 90 day, remaining everything is same. Clear? So therefore, this is the situation, sir. Please read. Purchase goods on credit. Decide to go by option 2. Book what contract? 90 day. Remaining everything is same. Instead of taking loan in India, supplier credit, avail interest credit, honor the forward contract, convert, pay the supplier with 9% interest. Okay. So please do this. So completed. So which is a better option? Which is a better option? First option or second option? That means going for, paying the supplier in 60 days is better, availing the supplier's credit is better. Paying within? Okay, that's all. Now, I will ask you one question. You do that. 32 we completed. Sir, we promised how many? How many completed? How many are still pending? Now, this one you will do. 34. Again, past exam question. November 2014 attempt, if I am not wrong. Good question only. Small change will be there. See, so many questions we have done. With that experience, do this. Don't see the answers, solve it. Let us read the question first. Everyone, let us read the question. An Indian importer has to settle an import bill of $130,000. Means, everyone answer, payable or receivable? How much? He has given two options. Pay immediately without any interest charges. Pay immediately without any interest charges. Next one, pay after 3 months with the interest. The importer's bank charges. Okay, 15% per annum overdraft. The exchange rates are given below. Importer seeks your advice. First tell me, what is the difference between the first and second one? Previous problem and this problem, what is the difference? Interest free credit period is there or not there? Not there. That means on the very beginning it will start getting the interest payments now. Clear? Will you do? Solve it. So have you done, everyone? I will show you the answer. Check your answers whether you are correct or not. But if you are doing wrong, I can't do anything. It's a easy question actually. See, this is the answer. You should have got this. 65 lakhs 22,555. First bit everyone completed. Second bit answer is this much. Okay, na? Sir, if you want, I am putting it before you. Have you completed, everyone? Shall we go to the next one? So, first outflow is 65 lakh 22,555. Next one is how much? 64 lakh 27,249. So, how many problems we completed? 6. Out of total, how much? 8. Now, take question number 39. This is leading and lagging. Leading and lagging. Let us see. This is a old ISM question. After this question has been removed. Leading, lagging questionnaire removed from study material. Like this, a question can come. Paper Products Limited had already received the invoice for Hong Kong dollars 2,10,000 spot. Spot rate is 6.5 rupees by Hong Kong dollar and 60-day forward rate is rupees 6.6. Determine whether PPL should avail the full credit of 60 days or lead the payment if interest rate in India is 11% per annum, 6.5% per annum. What would you suggest if the company is running a cash surplus? This is the question that is being asked. First, read the question. 5 minutes it will take to answer. Have you read the question, everyone? First, you tell me one point. Paper Products Limited has already made an invoice, received an invoice for Hong Kong dollars, how much? 2,10,000 totally. Okay. Spot rate is how much? Sir, first tell me, we are having receipt, payment. Receipt, payment. Payment. So we have to pay how many Hong Kong dollars? Okay. He is asking, shall we avail full credit period or full credit period, whether to lag the repayment or whether to lead the payment? He is asking a question in two circumstances. If the interest rate in India is how much percent? 11%. If interest rate in India is 6%. Shall we start doing the problem or not? Before doing that, please directly see here. Let's not waste even a single minute. See here. So, whether to lead or not to lead. Whether to lead the payment or not to lead the payment is a question that is being asked. So, okay, I don't know where I have done this. Let us do together. Please put the heading in your notes. Question number 39. Question number 39 in your material. First, particulars lead, lag. Particulars, lead and lag. Sir, if I lead the payment, what will happen? If I lag the payment, what will happen? Okay. Sir, in both the cases, first we are going to assume that interest rate in India is how much percent? 11% we will do, 6% you will do. Okay. Now first tell me, everyone do along with me. You need not wait for this. Easy question only. Tell me what is the invoice value? Do that. Hong Kong dollar 2 lakh 10,000. Hong Kong dollar 2 lakh 10,000. Next, tell me, if I lead, what is the applicable rate? Once again, if I lead, what rate will apply? Spot rate or forward rate? What is the spot rate? 1 Hong Kong dollar equal to rupees 6.5. If I lag the payment, what will apply? 1 Hong Kong dollar equal to rupees 6.6. Next, what is the outflow under first option? 2,10,000 into 6.5. How much rupees? 13,65,000. 2,10,000 into 6.6 rupees 13,86,000. But try to understand, if I have to pay immediately, I have to lose some interest in India or not? At what rate of interest? 11%. Add opportunity cost. Add opportunity cost. 13,65,000 into 11% into 60 divided by 360. How much? 25025. This opportunity cost will be added to what? No. Added in case of lead or added in case of lag? Lead. So plus 13,65,000. 13,90,025. Yes or no? Now tell me. Payment is more under which option? Payment is more under which option? Lead option. Therefore, we have to lead and make the payment in advance. We have to lag and postpone the payment. That's how the question has to be answered when the leading and lagging strategies are being asked. Everyone first one understood. So tell me, in this case, I have to lead a lag. Means I have to avail full credit. I have to prepone my payment. Avail full credit and then only pick the payment. Everyone understood? Sir, listen. Without doing all these things also, we can do this question. First, everyone tell me. We are having a payment exposure or receipt exposure? Payment or receipt? How much payment? 2,10,000. Now answer my question clearly. One second. I have two rates given. Spot rate 6.5. If I am not wrong, correct? Forward rate is how much? 6.6. Tell me, what is, sir, we are having payment or receipt? Payment or receipt? Payment of dollars or Hong Kong dollars? First, let us see. We are having a payment, yes or no? Can I calculate the forward premium or discount on the dollar, Hong Kong dollar? Yesterday night I told you one point. Don't call it as a premium, discount, appreciation, depreciation. It is called as implied interest. It is called as can we calculate implied interest on Hong Kong dollar? Now that implied interest will be like a payment for me, a receipt. I am having the checks. Some people are not in this world. Listen carefully again. You are in a serious problem. Please listen. Point number one. We are having payment or receipt. So everything you should see from the payment point now. Okay. Premium, discount, appreciation, depreciation's real name is what? Implied interest. What is it called as? Implied interest. Hong Kong dollar, I am having a payment or receipt. Therefore, implied interest is also an implied interest payment for me now. Clear? So take calculator. 6.6 minus 6.5 divided by 6.5 into 360 by 60 into 100. How much? That means technically If you have to pay in the spot, you have to pay 6.5. If you have to pay in the forward, you have to pay how much? 6.6. Means extra how much interest you are paying on Hong Kong dollar implied? 9.23. But India interest rate is how much? Therefore, since Hong Kong dollar implied interest is lesser than Indian interest rate, go for Hong Kong dollar lag. Forward is better since forward interest rates are lesser. Like that also you can answer. Understood or not, everyone? This is other way around. You can show the same answer. Clear or not, everyone? Okay. Do the second one now. How much percentage? 6.5. Do that. You can do directly like this. Sir, 9.2. Listen carefully. What is the interest rates in India? Revised interest rates. Second bit. Payment or receipt. Hong Kong dollar also we have a payment or receipt. On that, what is a forward premium discount payment? 9.23. Tell me, interest rate on India? Interest rate on Hong Kong dollar? Answer 9.23. Now tell me, compare 6.5, 9.23. Which is better? 6.5. Therefore, what is the answer? Avail lead the payment and make the payment in India. Borrow at 6.5%. That's a better option. Everyone understood? Like this also you can do the answer. Instead of doing the table, all these analysis, directly from the calculator we can tell the answer. But in exam you do the working. But I am telling you how you can otherwise around also check the answer. Answer here, everyone. Now tell me what strategy we have done. Hedging, forward hedging, leading and lagging. One lead transaction, one lag transaction we have done in the same problem. Everyone understood? This is one way they can ask the question. How many questions I promised in total hedging? How many completed? How many pending? That's a previous problem only. May 2012. Again in my attempt, 8 marks question. 38. May 2012. 8 marks question. If you want, you can check in your question bank also. Year number, date and number of marks. So it was tested in May 12 attempt for 8 marks. And I have done obviously correct. So this is also given on what? Lead lag with forward hedging. Read the question. Question. Everyone read the question. First tell me, in this question, NP and Co has importa, exporta, receivable, payable. Answer. Both are there in the same question. So NP and company has imported goods for US dollar 7 lakh. Amount is payable after how many months? 3 months. Company has also exported goods for 4 lakh 50 and this amount is receivable in how many months? 2 months. Forward rate is already taken on that. What rate? 9. Next, the market rates for rupee and dollar 48. I am talking 2012 May. At the time rates of dollar are like that. 48 rupees. Today 80. When I qualified, dollar trading at 46 or 47. Today dollar is, when you are getting past, dollar is trading at 80. After another 10 years, you can imagine again double. So 2012 means 2024, 12 years. Almost 12 years back when I qualified. So at that time, almost 10, 11 years, completely 11 years over. So sir, 12 years, completed 12 years by 2024 means it is getting doubled. Because by next year, definitely dollar will hit 90. Okay. That means every 10 years or 12 years maximum, for every Pushkara Kalam, dollar is getting doubled in India against the rupee. So let us see. But you should pass before it become 83. Means in another 2-3 months maximum it will become, in another 4 months you take, it will definitely become 82, 83. Before it crosses that 83 boundary, you pass, qualify. Okay. You should proudly tell that when I passed, it is 83. Today it is 120. Like that you should tell. Sir, see here. In the given question, I am having a receipt of payment of both. Both import to there, export there. But the problem is both are belonging to the same time frames or different time frames. The company wants to cover the risk and it has two options as under: to cover the payables in forward market and to lag the receivables by 1 month and cover the risk only for the net amount. No interest for the delaying the receivables is here. Evaluate both the options if the cost of rupee funds is 12%. Which option is preferable? This is a question that is being asked. In Marie? Understood the question, everyone? Will you do? Do. Huh? Huh? Let us do. అయిపోయింది, వచ్చేసారు మీరు ఫామ్లోకి. సరే, ఓకే. See here. So, how to solve this question? Like you only, I also would have felt in exam hall now. And I first time see the question, like seen in one movie, Venkatesh will get eyeballs popped out. And it will again go back. So, in my attempt also, some questions came, bouncers came, direct. So, some bouncer questions came, sir. Futures options, they have given good number of questions at that time, futures and options. So, I also found in the same way. But eventually, when you start doing the question, you will get confidence. So, in this question, one thing is very clear. I can do at least up to 50% correctly. I have done everything, but minimum, by seeing the questionnaire, we can tell that, okay, at least half I will do correctly, because there are 2 points here. One is the forward rates are given. We can multiply forward rate to the invoice value. That we can do or not. At least that I can do properly. So I have one confidence, okay, at least if 8 marks, 3 marks at least I will get, instead of leaving everything. But eventually we start solving. See there, to cover payables in the forward market. First you tell me, what is the time frame for receivables? Answer. Time frame for the payable. Both are belonging to the same time frames, are different time frames are. So you can't adjust both of them immediately. Therefore, the first option available is, anyway you are covering receivables at 48.9. Receivables. Cover payables separately in the forward market and calculate the total outflow. That's the first question he is asking. Shall we do that at least? Okay. Let's do this. So what is the question number? Can you please help me? 38. Thank you very much, bro. $165. Sir, see there. First one. See there, yeah. You need not write. Just observe the question properly. If you want, you can take a snap. See there. First one. Cover the risk individually. What is the first option available? Cover the risk individually. Means we are not going to set off anything. Let's cover both independently. So what is the first answer? What is the invoice value? 1 second. See the question once. for my sake, see the question. They are given forward rates or not? They have given the forward rates or not? They have given the forward rates are swap adjusted forward rates. Where is the question? Here. So tell me, we are going to pay today na or in future? Payable. Future means how many months future? Tell me the 3 months forward rate. Sir, we have a payable or receivable? Answer. Always a forex question. First we need to check per unit. What is the per unit? Answer. We have payable or receivable. Second case, payable. We have to pay in dollars. That means we have to buy dollar, sell dollar. Bank cash to bank sell side. Higher rate. Higher rate will be ask rate of today na 3 months forward. Please see there. What are the rates given? 40. First tell me what is the spot ask? 70. 48.70. Okay, tell me. 48.70. How many months? 3 months. 40.15. That's the rate. Clear or not, everyone? So that's all. You have to do this. So this is a value. This is for the payable. Up to here, everyone understood the point clearly. Yeah. So we have taken a rate exchange rate to 49.15. What is the value in rupees totally? 3,44,000. So first see that invoice value is how much? Receivable. Exchange rate we calculated already taken. So what is the value totally? 2 crores 20 lakh 5,000. 2 lakh 2 crore 20 lakh and 5,000. We are comparing the net payable. That means we need to bring that receivable to how many months? 3 months. Therefore, we will deposit that. Interest for 1 month you got 2,20,050. Total receipt at the end of 3 months is how much? 2 crore 22 lakh 25,050. Up to here, everyone understood? From this, the payable is deducted. Or from the payable, receivable is deducted. What is the net payable at the end? 1 crore 21 lakh 79,950. Up to here, everyone understood the answer clearly. Next. So this is one option available for us. What is the second option available? Lag the receivable and net exposure. Listen carefully. When my receivable will come? After 1 month, after 2 months, after 3 months? 2 months. Now already I have entered into a forward contract or not? Now second option is telling is you didn't enter into forward contract, cover the net exposure. That means we have to lag the receipt, lead the receipt. Some people are not even understanding what is going on. Please listen carefully. We are having receivable, payable both. Payable after, receivable after. Now I don't have a chance to ask for preponement of a payable. I can't pay. Maximum what I can do, what is in my hand? Receivable is my ownership. Therefore, I can lag my receipt such that I can cover only net exposure. Clear, everyone? So tell me, invoice value of payable, invoice value of receivable, in net invoice payable. Now everyone tell me, applicable forward exchange rate will be, I have to pay that net today after 3 months. Already we have an exchange rate on earned. So we applied and we got this. So tell me, 1 crore 21 lakh 79,950, 1 crore 22 lakh 87,500, which is a better option? First option, second option. That means it is to lagging the receipt is better or leading the receipt is better? Leading the receipt is better. Cover the exposures independently. That's the answer, sir. Everyone understood the concept clearly? That's all. With this, we have completed all hedging strategies except money market hedging. Which hedging, sir? Money market hedging. This is also called as exposure netting. That means what exposures are netted here? See here, everyone. What are the two exposures you are netting? You are having a receivable. You are also having a payable. You are netting of both receivables and payables. So this one question is a blend of a forward rate, lead, lag, exposure netting. Clear or not, everyone? That's all. Next, we are having 3 balance hedging strategies. What are the hedging we completed? Forward, leading, lagging, exposure netting of receivables with payables. We are still having another 3 hedging studies. What is the number 1? Money market hedging, currency options, and currency futures. Here, all these 3 we cover separately. A separate chapter I kept called as special hedging strategies. Okay, so currency options, currency futures, and money market hedging will come separately. Clear, everyone in the class? So we had take a break and come. After the break, we are going to start with international capital budgeting. So let us now start with important and difficult area in this. As students said, international financial management, called as international capital budgeting, and international treasury management. These are the 2 areas we are going to cover. One is a capital budgeting, one is a cash budgeting. 2 types of concepts are there. One is a cash budget, second one is capital budget. 2 types of concepts we are going to analyze. See there, lack of conceptual clarity, direct formula answers will always make this particular area as one of the most difficult ones from the student point of view, but should not be after the class. Now we are going to cover in and out regarding the international financial management, being international capital budgeting. So international capital budgeting, if you can see, the first one is a discussion and analysis. That the theory itself has spread across 4 or 5 pages, how this concept has come. This is also theory only, overseas capital budgeting concept. From there the problems will start. Doing problems is dead easy once you understand all these basics clearly. Okay, so the point, first one, international capital budgeting. What is this particular idea behind, and how this particular concept will be, how they design this idea? Let us first try to understand those clearly. Point number 1, international financial management is a separate chapter in your study material, which will cover 2 areas. One is international treasury management, also called as the international cash management, budgeting the cash. And second one is international capital budgeting, what we are going to cover now. In this, cash budgeting is very easy. Generally, they don't ask, that's why. Difficult ones will be the capital budget. Therefore, they will ask in every attempt. Difficult paper of SFM will contain international capital budgeting instead of normal hedging. Clear? Difficult paper, so-called branded difficult papers in SFM will contain international capital budgeting inside them. Why? International capital budgeting involves interest rates, inflation rates, okay, expectation theory. All these things are involved in one single concept called as a international capital budgeting. And it includes a theory in itself called as international fixtures effect. Have you heard? International fixtures effect is a concept. So that will be included. Because of that, concept becomes more complicated. So we need to understand what is this international fixtures effect in detail to understand this concept of capital budgeting. First, you see the screen once. Capital budgeting is an exercise companies will undertake to select or reject the projects. If a project is estimated to give a positive NPV, it will be accepted. Negative, it will be rejected. Positive NPV maximizes the wealth. Negative NPV will erodes the wealth. NPV will be calculated as under. First one, what is the first column? Here. Second one, future cash flows. Next one, present value at the rate of required rate, PVCF. So you will get a discounted cash inflow, discounted cash outflow, NPV will come. Yes or no? Later, evaluate the future cash flow. Step 1, evaluate the future cash flow. Next, estimate the appropriate discount rate. Calculate sum of all discounted cash flows, deduct initial cost from the cumulative discounted. Resultant NPV can be positive, resultant NPV can be negative. Positive NPV accepts the project, negative NPV reject the project. This is how we will do. Yes or no? Problem started here. In every normal capital budgeting question, they will give for two information minimum. Life they will give, asset will give a cash flow they will give. Yes or no? So what are the 2 things they will give? Life. Second one, cash flows the asset going to generate. These are the two bare basic information everyone has to give. I'm talking to everyone. So the problem is, tell me, year one, cash flow, PV factor and PVCF. Okay. Now listen carefully. I will be explaining you this way. See here. For example, year cash flow, PV at the rate of some percentage, PVCF. First point number one, I will be estimating, I will be taking the particular company's sales, because we always consider what here? Meaning of cash flow I already explained in the second day of our revision classes, everyone in the class. So cash flows we have to consider. We should not consider, rather we should consider cash flows. Sorry, okay. So we have to consider the cash flows but not the profits. So therefore cash flows we have to consider. Sale is a cash flow, na? No, it will contain credit sales. Okay, it will contain credit sale, I am telling. When it contains a credit sale, it becomes a cash, will not become a cash. Therefore, I want what flow? Cash flow from this particular project I want. Okay, listen. Sales minus cost, operating profit, minus interest, like that so many I have to deduct, and lastly I will recalculate cash flow by adding depreciation, etc. Everyone in the classes or no? This is how we will calculate. Now tell me, in order to calculate EBIT, let us take like that. In order to calculate what? EBIT, first you answer me one question. We require sales, we require variable cost. We require which local ordinance applies. Be in this world. Sales, variable cost. Sales means what? Sales amount 1 crore means how to calculate? Sale price per unit into number of units sold. Clear? Tell me, what is the variable cost bifurcated? Materials, labor, overheads. Yes or no, everyone? Overheads, again there will be multiple overheads will be there. Unit based system or absorption based system or activity based system. You can use any kind of costing system, but anyway overheads will be having so many departments again. We call cost drivers. Clear, everyone? Sorry, okay. So variable cost, first one, what is the variable cost? First one, material. Sir, every kg of sale requires some material to be manufactured or material to be purchased or not. So purchase price per unit into number of units will make material cost. Am I clear or not? Likewise, tell me, labor cost per hour into number of hours will give the labor cost. Assumed to be they are taking on an hourly basis. Unit based also they can take, but let's not do overaction. Let us understand in a primitive way. Okay, that's a total labor cost. Overhead will be absorption per unit into number of units absorbed. Total overheads. Now listen carefully. Point number one, sale price. Listening. So please listen carefully, everyone. In every capital budgeting problem, whatever you have done in your IPCC, okay, when you are in CA IPCC, you have done capital budgeting or not? Either in CA final it is not there. CA internal you might have already done the capital budgeting concept or not. Capital budgeting concept, if you remember, you will take cash flows in the second column continuously. You will take 1 lakh, 5 lakh, 2 lakh, 3 lakh, like that. Some random cash flows, multiple uneven cash flows you will take or not. That is sales minus cost. Cash flow they have given you. What they have given you? What is cash flow? Sales minus cost. For example, this year selling price per unit is 100 rupees. Cost per unit, total material, labor, overhead, total cost per unit is 60 rupees. How much is my EBIT? Answer, sir. 40 is my EBIT. Let's say there are no fixed costs. Clear, everyone? There are no. Tell me how much amount? 40 rupees per unit. Everyone in the class understood? Now tell me. Now I am assuming 10,000 units in the first year. So how much will be the total cash flow? 4 lakh. Am I clear? Next year I am manufacturing, I am selling 12,000 units. How much will be my cash flow? 4,80,000. How much per unit? How many units? First year cash flow. Next year 12,000, 15,000, 6 lakh. Like that every year you are going to estimate. Okay, first year I will sell 10,000 units. 10,000 into 40, 4 lakhs cash flow. Like that 4 lakh, 4 lakh 80, 6 lakh, 7 lakh 20, 8 lakh 40, 9 lakh 60. Like that you are taking some numbers. Now answer my question clearly. Sale units you have taken, yes or no? First one, second one, third one, like that 18,000 to 20,000, some amount you are estimating or not? All our projections are guaranteed. First thing, projection, it is having an uncertainty. So the capital budget you are making is having a uncertainty inside. Those many units you may sell, you may not sell. Anything can happen. Clear? And moreover, in all the capital budgeting questions they ask in your CA Inter, whatever you have done, tell me what is the cost, what is the net profit per unit? 100 rupees sale price, 60 rupees all the costs. How much? 40. 10,000 units, 4 lakh. 12,000 units, 15,000 units. Like that it is increasing or not? But profit per unit is how much? 40. 40 depends on what and what? Sale and the cost. Yes or no? That means when you take the 5th year cash flow also, you will take the same sale price, you will take the same cost. Yes or no? Inflation you will not consider. Sale price, why it will be same every year? Yeah? Why it will be same every year? You will sell the product at the same price every year. You will not. Sale price will automatically increase due to various factors. Are you understanding the point or not? So this year I am selling at 100. Next year I will sell at 110. There should be some growth in the business or not. Business has to grow. Make the sale price 110. Next year it may increase to 115. Next one. Labor who is available for 100 rupees per hour will be available at same 100 rupees after 5 years. But you are considering capital budgeting in a way that it is constant, which is correct or wrong? Therefore, IPCC capital budgeting is wrong. Therefore, a concept called as a risk and uncertainty in capital budgeting has been introduced. Repeat what I said. Risk and uncertainty in capital budgeting concept has been introduced. Sir, where introduced, sir? CA Inter new FM. Not new syllabus, existing FM syllabus it is there. Risk and uncertainty in capital budgeting. IPCC CA Inter student can understand. Final students are leaving these concepts. Why inter student will understand? Overburden to him or not? Therefore, they are removing that new syllabus again. They are including capital budgeting. New syllabus is in a SFM new curriculum. For God's sake, they include again capital budgeting. Capital budgeting is included back into the syllabus. Viswarupan they will see in me, because capital budgeting is one of the finest concepts in SFM, where you can explain so many concepts. One capital budgeting will be equal to 10 chapters in SFM, because all concepts, NPV, IRR, discount rates, all concepts you can understand only through one single chapter. Risk and uncertainty and normal concepts of capital budgeting. See here, capital budgeting till now whatever you learned is wrong, because you are not considering the inflation in the sale values, inflation the cost, or material per unit will be available at same cost. So cement bag you take, today's cement bag cost, 2 years after cement bag cost will be same or different. But while doing the problem, we will assume that it is constant throughout the project life. Correct or wrong? Decision making also will become wrong. You will not get the budgeted cash flows properly. So, what are the 2 factors we missed in normal capital budgeting? You tell me. No. Wrong. Tell me, units you are assuming or not? Those units are guaranteed units or uncertain units are? Guaranteed or not unguaranteed? Certain or uncertain? Probable or guaranteed? Risky or not risky? That's the problem. Project cash flows, two things are there. Cash flow is a product of number of units into cash flow per unit. Both are uncertain. Listening everyone. Cash flow is a multiple of two things. Number one, number of units. Second one, cash flow per unit. Both are uncertain. Then therefore budget also will become uncertain. The NPV becomes uncertain. The IRR become uncertain. Profitability index become uncertain. The coefficient of variation will become uncertain. Capital budgeting is uncertain. Uncertainty should be there in decision making or should not be a answer. We have to remove what from capital budgeting? That's how they started developing uncertainty in capital budgeting. That's how it became International Financial Management, also called as International Capital Budgeting. Here we are going to see inflation rates. Which rates will come? Inflation rates will be covered. That means in this particular chapter, we will consider the projects inclusive of inflation. Everyone, inclusive of yes, inclusive of inflation, they will give the cash flows for us. Inclusive of risk, they will give the classification for us. Inclusive of risk and inclusive of inflation. That means they will give information to us which is inclusive of dash and dash. Inclusive of risk, inclusive of inflation. Now we have to calculate removing the risk, removing the inflation, actual how much will be certain, we have to calculate that. Clear or not everyone? Unique model of doing a problem. Let us try to understand how we need to solve. But before going into that first point, what I said, understood everyone? What are the two things which makes the capital budgeting more futile? One is the risk, another one is risk affects dash. Risk affected dash, number of units sold. Inflation affects dash, cost and sales amount. Clear? So, but we consider both of them as constant or constantly increasing at least. Both. Either you will take same or you will take same with a constant growth you will take, which cannot happen, which may happen, may not happen. Now listen carefully. From this, a concept has been started. Please, everyone listen. 10 minutes spare with me by understanding the concept. Problems just like that we will complete after this explanation. So please listen carefully. See the screen. See here. There are 3 cash flows. There are 3 rates. Everyone tell me how many rates are there? 3 rates, 3 cash flows. Please listen first, after that you can copy. Please listen first one. How many types of cash flows are there? 3 cash flow. Please listen carefully. Money cash flow, also called as nominal cash flow. First one, also called as real cash flow. What is the next one? This is also called as risk cash flows. Also called as what? Risk cash flows. Third one is discounted cash flows. What is the next one? Next one. This is called as sans risk, sans inflation cash flows. Sans, S-A-N, sans means without. Sans course, sans recourse. Negotiable instruments they will give. Sans means without. Listening everyone, I'm giving technical names they use generally. Okay. If you don't understand, I can't do anything. First one, tell me. Cash flows are of how many types? Everyone. Everyone, please listen. Answer number 1. How many types of cash flows will be there? Number 1, money cash flow. Second one, real cash flow. And the third one, discounted cash flow. Up to here, everyone understood? Rates are three: inflation rate, real rate, money rate. Everyone repeat: inflation rate, real rate, money rate. Everyone repeat once again: inflation rate, real rate, money rate. So everything repeat properly. How many kinds of cash flows are there? Number one, money cash flow, real cash flow, discounted cash flow rates. Inflation rate, real rate, money rate. See here. Whenever I say bond valuation, I already said this. To what extent you remember, I don't know. Tell me, in bonds, the cash flow what we get when you hit with the discounting factor, what will be separated? Principal will be separated. Yes or no? Separated from what? The interest yield, what you expect. Yes or no? That means it will be broken into two parts. Yes or no? So first one, what is broken? Yield will be broken from that. Principal will be separated. Yes or no? As I already said or not? Like that, whenever you hit something with the discounting factor, with what you hit, that will come out. There you are hitting with the yield rate. Therefore, yield is coming out. Listening. There you are hitting with yield. Cash flow. What is this yield? Yield hits the cash flow. What will come out? Yield will come out. What is separated from yield? Principal will be separated. Likewise, see here. Money cash flow is a cash flow which has inflation and risk of the project inside it. Inflation and everyone, inflation and risk of the project will be included inside what? Money cash flow. Real cash flow will have risk only. What only will be there? Risk only. Discounted cash flow is sans risk, sans inflation. Did you understand the concept clearly? First tell me, every cash flow will have two components. Number one, cash flow per unit, number of units. Number of units is equated with inflation or risk? Answer, risk. And second one, inflation. Yes or no? These are the two elements. Am I clear? I will consider a cash flow taking inflation into impact. Inflation into impact. I will consider inflation, I will consider the risk, and I will first calculate a cash flow. That means the cash flow which contains both inflation and risk is called as what cash flow? Is called as what cash flow? In that what will be there? Inflation is there, risk is there. Now listen carefully. Discounting factor, if you hit something, what will come out? With what you hit, that will come out. Okay, I hit with inflation rate. I will hit with risk rate. I will hit with both. Both will come out. What will be available will be the sans risk and sans inflation. Clear? First tell me, we are going to consider including inflation cash flows, excluding inflation, including. But when you show the NPV, that the NPV should not have inflation inside it. Therefore, we will consider inflated cash flows. Will consider means the cash flow what we take. So tell me, sale price this year, next year will be same or different? Different. Some inflation will be there or not? 10% or 5% or 7 or 8 or some amount will be there or not? Today, this year, our inflation is 10%. This year, SP, 100. Next year, 100 this year, 10% inflation. Next year, SP, 110. Cost this year, 60. Next year, 10%. I can calculate like that or not? Already I calculated the inflows in that way only. Are you understanding or not? That means what is already included into the cash flow? Inflation is already included. Clear or not? Inflation will be there in future, will be there in present. Today will have inflation, future will have inflation. But we are calculating NPV. What is PV? That means the present value you take should not have inflation inside it. Clear or not, everyone? You should consider inflation include cash flows. But while calculating NPV, we should remove them. IPCC capital budget, what you have done? The information don't contain inflation. Are you understanding or not, everyone? The information given, the cash flows given don't contain inflation, don't contain risk. Directly we will take some estimated cash flows, multiply with PV factor, we will get PVCF, discounted cash flow, discounted outflow, we will calculate NPV, answer over. That's a primitive way. So 10-15 years back, people used to use that model, but now advancements have come in capital budgeting. So therefore, try to understand clearly, everyone. We will consider the cash flows with risk or without risk. We will consider the cash flows with risk or without risk. With risk, we will calculate. That means risky cash flows means what? I will explain you. Every year, we will get same cash flow. Different same units will be sold. Different units can be sold. Answer. That means try to understand the number of units you take, okay, in the capital budgeting process will be bond paper written guaranteed cash flows or anticipated expectation. And expectation only, it will not happen. It may happen, may not happen on the other side. I mean, clear? That risk, how to consider? That way there is a rate called as a risk rate. Which rate? Sir, how people calculate risk rate? Question will arise or not? Using standard deviation. Using year 1, 10,000 units. Year 2, 12,000 units. Year 3, 15,000. Year 4, 18,000. Year 5, 21,000. Like that I have taken. Clear? Portfolio management knowledge you use. How many years information? When I total, I will get the total inflow or not? When I average a mean cash, number of units will come or not? Answer. X minus X bar, X minus X bar, X minus X bar, X minus X bar, X minus X bar. 5 times I can calculate a square. I can do a root of sigma X in X minus X bar whole square by N. Can I make a? For that I will get a rate. That rate will be RR. That they will give in the question only. You need not calculate. That calculation also will be done in a capital budgeting model called a Hiller's model. That's in CA Inter. They are getting paralysis when I am teaching. So that model is also there. Calculation only. But CA final they didn't keep that. That is a for CA Inter in a model called as Hiller's model. So final students, they are resistant to capital budgeting. What they will understand? They will anyway, they are very happy understanding so many issues. But point I want to tell you, there is a model also for that. That model is called a Hiller's model, where they will calculate the RR rates. What is RR? Risk rates or real rate. What rate? Or real rate. So now tell me. My discounting factor, PV at the rate of you will do na. That rate should contain 2 things now. Number 1, risk of the project and inflation. Listening? Now tell me. First column. Here. Second column. That cash flow will contain 2 things. Number 1. Inflated sale prices, inflated cost, everything will be there. So net inflation will be there, everyone. And number of units also will be there or not? Those number of units given in the question are guaranteed or unguaranteed. So that also should be considered or not? So I should prepare the PV factor to discount these cash flows in such a way it should hit 2 things. Number 1, inflation, and it should also hit risk. Therefore, I should take a rate to discount these cash flows which can hit both inflation and risk. That's called as a money rate. Called as? Answer. Called as a? Now answer this question. You already know from here what I ask. See here. How many types of cash flows are there? Answer. How many kinds of rates are there? You only tell, I will write. First one, money cash flow, real cash flow, discounted cash flow. Okay, or I will rewrite like this. First cash flow is money cash flow. Next cash flow is real cash flow. Next cash flow is okay. Now you should answer me. I should write. Do your work properly. See the screen and tell. Money cash flow is a cash flow which contains what and what? Risk and inflation. Everyone tell me what will be there. Whenever I discount something, what will happen? That will come out. Discounting means discounting means divided by a multiplied. Therefore, I will first take this MCF into 1 by 1 plus IR. I will discount using 1 by 1 plus IR. What is 1 by 1 plus IR? Inflation rate I will discount. Listening. Where I will go? When I discount something, that will come out or not? MCF, two things are there. What are those? Inflation and risk. I hit with which rate? So what is coming out? What is still there? Which cash flow it is? Only R is there now. Yes or no? Now I will re-hit it with 1 by 1 plus RR. I will go to which cash flow now? Discounted cash flow. Everyone understood the point or not? So tell me, IR will be what rate? Inflation rate. RR will be what rate? Risk rate. Both combined together can be called as what? Money rate. Combined called as a. Therefore, instead of doing 2 times like this, can I directly go this way? Yes, that is 1 by 1 plus MR. 1 by 1 plus MR. So, tell me, 1 by 1 plus MR will be equal to 1 by 1 plus IR into 1 by 1 plus RR. Can I take like this or not? Numerators are so same. Therefore, we can equate. Tell me, 1 plus MR equal to 1 plus IR into 1 plus RR. So, MR will be calculated as 1 plus IR into 1 plus RR minus 1. Can I calculate this way or not? Steady metal formula will be written like this. We don't know what is happening there. So, you do it too, but you go to. In study material and all other books, they will name MR as NR sometimes, nominal rate. Sometimes money rate. CFA books uses the word money rate, not nominal rate. They will use the word money rate. CFA uses money rate. Our books also uses money rate sometime. Interchangeably they will use. Don't get confused. Nominal cash flow means what? Nominal cash flow means what? Money cash flow. It contains both inflation and risk. NR means nominal rate, which is also called as a money rate. First, everyone understood up to here or not? Sir, I will ask you one question. Tell me, using the same equation, tell me how to calculate RR. RR. Use common sense, sir. That's all. Nothing required. 1 by, sorry. 1 plus MR divided by IR minus 1. Yes or no? This is second formula you will find in study material. After doing 2 problems, then you will realize why I left this chapter. Seriously, I promise you. After doing 2 problems, study material problems, then you will think, why I am not doing these problems till now? And in easy ga undo exam lo na bariste enti. Later if I realize, so therefore these are dead easy concepts, nothing will be there, but logic will be, background is very big to understand, but still hope everyone understood the logic behind this. So the point is, tell me, this is all normal notes, this is the main. If you want to copy, you copy this. Right now. So what are the 3 rates? Money rate, real rate, inflation rate. Up to here understood everyone? But one very important concept before we start doing the problem. See here, what is IR? Not interest rate, inflation rate. Okay? Inflation of India, inflation of USA, same or different? That's the problem. Till now what you learned has anything to do with IFM? Inflation, risk, all these things has anything to do with the dollar? Answer here. then you should ask that question first. What is the relation of this discussion with this chapter? ఎందుకు చెప్తున్నారు ఇవన్నీ? Why you are telling all these things? There should be some reason or not. For X, why we are dealing with all these issues? Up to here, last 15-20 minutes we are discussing about one small concept. Why? In this where dollar is involved, I don't see anywhere. Now the problem comes. When I take inflation rate in the cash flows, when I take the rate in the cash flows, the inflation is not my inflation. When you start a project outside India, their inflation I have to consider. But the project is analyzed by Indian company or foreign company. My PV factor I have to use a deadlock has come in understanding the concepts now. Because the PV factor is for my company. Inflation is hit by other country. Now how to deal with the capital busting problems has become a subjected question for every expert at that time. That how this concept came into the chapter called as International Financial Management. Then one person has come, his name is called as William Fisher, who got a Nobel Award for International Fisher's effect for the field of economics. So that particular person has formulated a concept called as the International Fisher's effect. Now whatever the explanation you have seen, it is said by William Fisher. That person is an economist who has got a prestigious Nobel Award for his greatest invention called as International Fisher's effect to understand multinational capital budgeting. Understood the concept or not? So therefore, the main point that you have to understand is, till now, is there anything to do with the IFM? No. Now it starts. Problem will start like this. We are having two inflation rates now. Number one, first one, Indian inflation rate. Second one, foreign inflation rate. We want Indian inflation or foreign inflation? Why don't we need our inflation? Because the project is not started in India. The project is started outside India. Clear or not, everyone? If the project starts in India, my inflation is relevant. But if the project starts outside, why my cash flows are relevant? Their cash flows are relevant. Clear or not, everyone? Now you should only answer. I started a project in USA. Whose inflation is relevant here? Indian inflation, US inflation? First point, very good. Second one, tell me, risk of the project is same in India and outside India, different? It is same. Risk of a project comes from the nature of the business. Example, except in some rare scenarios, always a business will have equal risk anywhere started across the globe. Silicon business is there. Silicon business means software. It has an element of risk everywhere in the globe. You start a project of software in India, you start a project of software in USA, in UK, that have an element of risk called as technological advancement. Understanding or not? Automobile industry has one risk. That risk is also new research and development of another competitor. That's a risk in India. Competitor risk is there in India. Competitor risk is there everywhere. Then how can you tell that risk of the project is different in two different countries? Therefore, Fisher has assumed in his model. When Newton assumed let X be, you should not question also this. You should not question this. Yeah. When science assumes let X be, you will agree. When our economist assumes that it will be same almost, you should not question this. Are you understanding or not? Therefore, his model has an assumption. Every model will have assumptions or not? Without assumptions, models are prepared. You can't prepare. Okay. Empirically, they will prove, that's all. So, therefore, they prepared a model which is said that real rate, also called as a risk rate, risk is of the project. Inflation is belonging to a country. Inflation is for? You are not listening. Inflation is for? Risk is for? What is assumed to be constant across any country? Risk of a project. Assumed. May be different. But model assumes that it is same. Clear, everyone? Tell me. IR, RR, MR. Which is constant? Answer. Which is different? IR, automatically what will change? MR will change, because MR is nothing but multiplication of IR and RR. Clear or not, everyone? So this is the modus operandi of this model. How this model operates actually, international capital budgeting. Therefore, answer my question clear. Up to here, everyone had a full clarity. Yeah. Tell me how many kinds of cash flows are there? एक, दो, तीन. Rates ला एक, दो, तीन. First one, money rate, real rate. Sorry, inflation rate, real rate, money rate. Next, money cash flow, real cash flow, discounted cash flow. Clear, everyone? The NPV, what you calculate at the end, should include risk, should include inflation, should exclude. But the original cash flows you take should contain both inflation and risk. The rate you use should include both inflation and risk. This rate will be hit with what will come out? Inflation and risk. What is available will be without risk, without inflation. More practical way of understanding a project analysis. Clear or not, everyone? In this process, we are doing inflation and real rate calculations in our questions. Last final point before we start with the solutions. Listen, there are two approaches. There are how many approaches? Two. Approach number one, home currency approach. Approach to foreign currency approach. Examination of both are asked in one question only. 8 marks questions are coming. Means I will do home currency, sir. Foreign currency I will not learn. No. In exam, 4 marks they are asking. Do from home currency, do from foreign currency. Both they are asking. Listening, everyone. Now tell me. Home currency approach. What we have to do? This is the home currency approach. Please see. What is home currency approach? What are the steps in home currency approach? See there. If you forget the steps, Govinda. First, see there. First one is home currency approach. Second one is a foreign currency approach. Everyone, first one. Second one. See the steps in home currency. First, what we need to estimate? Estimate the future cash flows in what currency? Tell me, I am starting project in India, no, overseas. Cash inflows will come in rupees, in foreign currency. That's the step number one. Shall we continue? Step number two. Use the corresponding ER. Means exchange rate. We are calculating home currency, foreign currency approach. First one. Home currency approach. Means convert every cash flow into which currency? Which currency? To convert the foreign cash flows into home currency, we require exchange rates or not. Take the exchange rate and convert it into home currency. First point, everyone understood clearly. Yeah. Tell me, what cash flows we need to consider? Foreign currency cash flows. Use what? IRPT forwards will be given. You have to calculate a forward rate. Everyone listening. Using those exchange rate, convert that foreign cash flows into rupee cash flows. Clear? But the beauty of this model is you should understand the concept clearly. Again, you will use Indian PV rate. I mean Indian PV factor, foreign PV factor. Answer. Then what about inflation? Then the cash flow what they have given is containing inflation or not, everyone? Tell me now. Shall I tell you the beauty of this model? When you are converting exchange rate, you will convert using PPPT, IRPT. PPPT already considers inflation. Are you understanding or not? IRPT model is there a formula? Formula and SR. Formula is what? Plus RD by 1 plus RF equal to F by S. Or no? Interest rate will include the inflation as well. Therefore, in this chapter, if inflation rate and interest rates both are given, consider interest rate. That is more significant than inflation rates. Listen this, everyone. Institute will do in the same model. In the same question, inflation rates are given, interest rates are also given. Which will be more important to take? Interest rates, you should calculate exchange rate. Clear or not, everyone? So now tell me, when first model, home currency or foreign currency? Tell me, what is the step number one? Identify the foreign currency cash flows. Next, second step, identify the exchange rates and convert into. You converted. home currency discount rate you will use. Okay na? Home currency discount rate will have risk inside it. Therefore, inflation already converted through exchange rates. Risk will be converted through using our PV factor. Listening everyone. Lastly, you will get the discounted future cash flows. Everyone understood? Now, understand how much is the initial investment you put. Initial total of discounted inflows minus total of discounted outflows will be equal to NPV of the project. This is the first way in which you can do the model. Everyone understood the concept or not? Okay, next, the second one. See the second cash flow, second type. What is the second type? Home currency or foreign currency? Here, our home currency will never be involved. First one, take the cash flows in. We're not listening. Take the cash flows in. Take the IR, RR, MR also in. Discount it. Tell me, we are starting project in India, outside India. Outflow in rupee or dollar. Say for example, outflow rupee or dollar. Therefore, outflow in dollar. Inflows also will be in. PV factor should also become the dollar PV factor. We will convert. Discounted inflows will be dollar discounted inflows. Outflow will be dollar outflow. NPV will be dollar. Convert NPV. NPV. PV means what? Spot of future. Use spot rate and convert NPV. That's all, answer over. Understanding the model or not? This is how you have to do the international capital budgeting questions. Inventory. Listen carefully. Sir, listen. So, understood up to here clearly, yeah? Now, okay, let us start doing the answer now. Let's take, sir, 100 times you discuss theory, na? One practical question you do, full clarity you will get. Take question number 48. Take question number 48. (2009). This is a 6 marks question. Shall we continue, everyone? Sir, we don't have that much time. Sir, I told you hundreds of time. Concept, I will spend as much time as I want. But problems, I don't spend time. Clear? Problems, anyone can do once you understand the concept. Sample, I will do 2-3 problems for you. Shall we continue? See the screen. LB Incorporated is considering a new plant in Netherlands. The plant will cost 26 million guilders. Incremental cash flows are expected to be 3 million guilders for first 3 years, 4 million guilders in next 3, 5 million guilders in year 3, 7 through 9, and 6 million guilders in years 10 through 19. After which the project will terminate with no residual value. Present exchange rate is 1.9 guilders per dollar. The required rate of return on repatriated dollar is 16%. If the exchange rate stays at 1.9, what is the project net present value? Read the question. Sir, you are not going to do anything. I will show you the answer directly. I will ask you questions, answer those. That's all. Clear? Don't waste time in doing the numbers and calculations. So you can do it at home. Shall we continue? First, you should answer me. Home currency or foreign currency? Home currency, the US ki home. In that India is not involved here. You are thinking that India is there, then home. read the question here. What is this? After listening to entire concept. అంటే ఇటు ఇండియన్ రూపీ ఉంటే హోమ్, అదర్ దాన్ ఇండియన్ రూపీ మీన్స్ ఫారెన్. ఏం సెన్స్లు? See the question properly. Okay, first point, tell me, who is starting the project? USA company. Starting project in USA na Netherlands. Very good. Now, the cash flows are expected to be how much? First 3 years, how much? 3. 3, 4, 5, 6 is the million cash flows that they are getting in 4 levels of stream of cash flows. Sir, please look into the book, everyone. See the question. So, 1, 2, 3. Next, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. Very good. Next, after that, it will have a residual value or no residual value. Okay, next, what is the exchange rate? That's only they have given home currency. Tell me, cash flows are coming in dollars or guilders? Answer, guilders. We have to convert everything into. Therefore, when you use exchange rate, already exchange rate includes what? Inflation inside it. Therefore, when you convert back, already what is removed? What is only remained? PV factor is anywhere risk rate only. Therefore, you apply the PV factor, risk will be coming out. Whatever will be left out will be sans risk, sans inflation to consider for NPV. Everyone understood the point or not? See here, this is how the answer will be. That's all. First understood how the problem has been solved, everyone. Tell me, 1, 2, 3, 4 to 6, 7 to 9 and 10 to 19 I have taken cash flows, exchange rate, cash flows, PV factor, PVCF, initial investment I have removed, NPV I calculated, NPV is a negative NPV. So it is not recommended to take up the project. Everyone understood the concept up to here clearly? Sir, I can't spend so much time on problems. Understood the concept or not? Yes or no, everyone? This is home or foreigner? This model, sir, home or foreigner? Home. There is another model. Which model? Let us do. Take question number 49. Mark it very, 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 very important. 3-4 times already asked in exam. I will do one thing. This question 49 we will do and we will go to the next concept. 49 what we will do is, we will do both. What do you mean by both? Home currency, foreign currency. Let us do both. Sir, first I ask you one question, answer properly. 49th question you answer. Read, let's read first. So chadudam, after that I will ask you the question. Read. ABC Limited is considering a project in USA which will involve an initial investment of US dollar 1 crore 10 lakh. The project will have 5 years of life. Current spot exchange rate is 48 per dollar. RF is 8%. India is 12%. Cash inflows from the project are cash flow US dollar 20, 25, 30, 40, 50. Calculate NPV of the project using foreign currency approach. Required rate is 14%. Okay. Sir, clearly he asked do using which model? But we will do for both home currency as well as foreign currency. Cheseddama. Let's start. Amigos, come on. So, 49. Everyone, shall we start doing the answer? Yes. First, let us do using which approach? Foreign currency approach. Okay. Foreign currency approach. Tell me, in a foreign currency approach, first thing, we are given with inflation rates. Inflation rates given RF. Okay. Listen. Every step there is some concept involved in SFM like that. తిరుమలలో మెట్టు మెట్టుకి దేవుడు ఉన్నట్టు ఇందులో మెట్టు మెట్టుకి ఒక కాన్సెప్ట్ ఉంటుంది. సీరియస్లీ ఐఎమ్ నాట్ జోకింగ్. Since it's a crash batch, for every point I can't explain you the logic behind, but I can tell you one point. Tell me, RBI leave off. I want to invest in TCS shares. I will expect return of risk-free rate more than risk-free rate. Somewhere around 15-16%. I will ask for a return in TCS. Yes or no? Because the return what I get from TCS should counter two things. Number one, risk. Number two, inflation. Number two, sir, PV factor is always made of two elements. Number one, risk. Number two, inflation. Yes or no, everyone? Therefore, whenever I ask any return, I should take two into consideration. Number one, risk. Number two, inflation. Now listen carefully. Sir, RBI bonds, government securities are risky or risk-free? Answer, risk or no risk? But still they are paying some return or not? Because they are not paying to counter the risk, they are paying to counter the inflation. Therefore, risk-free rates are also called as inflation rates. Are you understanding the point or not, everyone? Yeah. So tell me, what is inflation rate in USA? 8%. What is the inflation rate in India? 12%. Cash inflows from the projects are cash flow 20, 25, 30, 40 and 50. Calculate what? NPV. What is the required rate? 14%. Sir, answer, 14% is the required return of Indian company or US company. Think and answer. Don't give sudden answers. India, USA, don't give. Read. Read. Who started project? In American or Indian? Therefore, that is the required rate for India, not for foreign. Okay. First point, number one. To calculate foreign currency approach, listen carefully. We require 14% dollar discount rate. Tell me, year how many? Year how many? Cash flows how much? 20, 25, 30, 40, 50. PV at the rate of how much percent? 14 if you take, ila kotestu vasta answer ni. Ela? Ila. Okay? Ela? Ila. Mattham kotestaadu. 14% is a cash flow, PV factor for whom? India. Not PV factor for USA. We have to calculate the PV factor for whom? First thing, tell me, these are inflation inclusive and risk inclusive. These are excluding both. Including both. It's an assumption if nothing is said. These are including both. That means in these cash flows, what is there? Inflation is there. Risk is also there. Therefore, my PV factor in USA should have two elements now. What should be there? Inflation should be there in the trade. Risk also should be there in the trade. That means I should use IRA, RRA, MRA. Given or not given? That we have to calculate first. Clear everyone in the class? Okay. Now let us start doing the answer. Please. Let us start. First, step 1. Calculation of required rates. First problem is confusion, sir. Second time, if you do no confusion, you will get clarity. First time you are doing, maybe chances are there, but do properly. Tell me, one second. There are two countries involved. What are they? India, USA. Okay, first write India, sir. First whom? India. Next whom? USA. Please tell me, what is the inflation rate? See and tell. India how much? 10%. విలన్లు ఎక్కడో ఉండరు, ముందర బెంచ్ రూపంలో స్టూడెంట్స్ రూపంలో ఎక్కడే కూర్చుంటారు. సో టెల్ మీ, హౌ మచ్ పర్సెంట్ ఇన్ఫ్లేషన్ రేట్? 12%. ఇన్ఫ్లేషన్ రేట్ ఇన్ USA. వెరీ గుడ్. ఆర్ గివెనా నాట్ గివెనా? గివెనా నాట్ గివెనా? They didn't give anything. Listen, sir. Listen. MR, They have given or not? For whom they have given in the question? India they have given. Tell me. How much percent, sir? 14%. So now listen. How many rates are available with us? Answer. Now answer my question. With this available information, can I calculate RR or not? How? RR equal to 1 plus MR by 1 plus IR minus 1. Can I calculate? Tell me what is 1 plus MR? 1.14 divided by 1.12 minus 1, please. So I am listening multiple answers for same question. 0. First tell me. 0, 1, 8, 5, 9. 0.0179. So 0.0179 can also be written as what percentage? 1.79 percentage. This is IR, MR, RR, enna? అదే రాయండి అదే రాయండి అదాస్తు. So tell me how much is the RR? 1.79. Okay. Sir, 1.79 is a RR of India na USA na? Both. Therefore take it 1.79. When I can take this 1.79, can I get this missing figure or not? Formula. MR equal to 1 plus IR into 1 plus RR minus 1. Tell me, what is 1 plus IR? 1.08 into 1 plus RR. 1.0179 minus 1. 9.93. 9.93%. 9.93%. In your institute study material, this question is there. You can check also. Our answer will be much more clear than them. That guarantee also I can give. With logic we will do. Sir, everyone answer understood how we calculated. What are the two rates we calculated? RR, MR. RR we calculated for India na USA na? Both. If one you calculate na, that applies for both. That's why it's called as universal real rate. What it is called as a universal real rate. What do you mean universal real rate? Wherever you calculate, that is assumed to be same as per this model. Shall we do? Sir, listen. Now tell me what are the columns. Here cash flow. Here I will take the same. Please. Here cash flow. Next PV at the rate of 93%. Next one PV CF. Sir, no. Tell me 9.93%. Don't read anything already. Half the question is given there. 0.910. Next. Multiply. Don't do anything. Multiply and tell the direct total. M plus M plus M plus M plus M plus. Don't waste time. 20 lakh into 0.910 total. I don't want like that. In lakhs or crores you tell. Lakhs, tell me. Dollar. 1 crore. Correct? Hello. Correct? Sir, I don't know the answer. That's why I'm asking you. If you want, I will check the answer. That's all. That's maximum I can do. Correct. So from this, what we need to deduct? Initial investment. How much initial investment they kept? They only given the question 1 crore, $10 lakh. So how much is the NPV? 10 lakh 1,500. So 10 lakh 1,500 is the NPV in rupees or dollars? NPV. P means what? Present value. Means it's spot rate or forward rate or spot. Convert using that. NPV comes to 4 crore 80 lakh 72,000. First point, everyone are comfortable with foreign currency approach. Everyone. Next model is what model? Home currency approach. Which approach, sir? Home currency approach. So tell me, home currency approach, how to do? Step 1. First, identify cash flows. Identified. How many years, how many cash flows? 5 years, 5 cash flows. Next, convert using exchange rate. Do they give the exchange rate? They gave only spot. They didn't give forward. We have to calculate IRPT forward for 5 years. Can we do like this? You need to do. Clear, everyone? Like this you need to do. Forward rates you need to calculate. Sir, don't do. 1 second. Sir, it is there in study mat. No problem. You see the answer, that's all. My presentation you should look into. Tell me, how many years we calculated forwards? Answer. What we need to do with that? Using those exchange rates, we have to convert what into what? Foreign currency cash flows into rupee cash flow. Clear? Therefore, we should use our PV factor directly 14%. Clear, everyone? That's all. You will be getting the PVCF. Again, 4 crore 78 lakhs. Sir, NPV we are taking PV factor 3 decimal rounding after. So 2 lakh difference will come here. Or else both the concepts are same, sir. That's what I want to tell. Foreign currency approach, home currency approach, if you are getting a tremendous difference, somewhere you have done wrong. Here we are doing in 4 crore rupees. Decimals la changes, it will result in thousands and lakhs. Differences will come, no problem. I got 4 crore 80 lakh under which model? Foreign currency. I crore 4 crore, how many lakhs? 78 lakhs. 1 lakh 30,000, 40,000 difference will come. That's because, not because of mistake. That's because of what? Rounding of the PV factors. Clear or not, everyone? So therefore that's a problem. So NPV is again the same. So now tell me, whether you use home currency approach or whether you use foreign currency approach, the answer will be same. Yes or no? Answer, everyone. Now my question, last question before we go into the next model. Tell me, whether you do home currency or foreign currency, answer will remain the same. Yes or no? Then why foreign currency approach? No, they also will consider. Both models will consider that. If there is a if both the models use same answer, why we need to consider this? But answer is same essentially. I'm asking, sir, answer me. Sir, give a wise answer. Capital budgeting la importance is other information, sir. NPV negative positive. That's all. At the end we want whether NPV negative or positive. So tell me, home currency approach la NPV is positive. Will there be a chance that using foreign currency approach can it be negative? Can there be a chance, sir, foreign currency approach like got a profit? Is there a chance that when can we get loss under home currency approach? There is no chance because foreign exchange can't be negative. Foreign exchange can't be. It can never happen. So NPV positive under foreign currency approach means it will be positive also under home currency approach. There is no question of. There is no question of negative or changing NPVs. NPV also will be same. We proved everyone. So it cannot change. Then why? Question arises now, everyone. First point number 1. Tell me, sir, we are converting 20 lakh, 25 lakh, 30 lakh, 40 lakh, 50 lakh into which currency, from which currency to which currency? From which to which? Dollar to? Answer. Sir, this will be 49.77 is today's rate, 1 year forward. Like that 57.58 is this year forward rate, 50 year forward rate. Answer. First tell me, these rates are blocked by whom? You will block all these rates with whom? 49.77, 51.62. All these are blocked with whom? Answer. Wrong answer. These are all budgeted cash flows. These are not real cash flows to enter into agreement with the banker. These are all IRPT forwards, not the actual forwards given by the banker, because the cash flows are uncertain. Is the bond paper written at $20 lakh, I will come, I will give, come. Lelo $20 lakh. You go and convert. Who has given you bond paper to enter into forward agreement? Did you understand or not? So that's the point. So the rates you use, sir, these cash flows are guaranteed, unguaranteed. Maximum we try to remove inflation risk of project, but still some amount of risk will be there or not. But you can't enter it. If this is an interest cash flow, can I enter into forward rate? If this is an interest cash flow, can I enter into forward rate? Yes, because interest is certainly happening event. These are interests, budgeted cash flows, and guaranteed or unguaranteed. Therefore, and moreover, these rates are bankers' rates, fair rates, fair rates. Model number 1 that we need to understand. Everyone understood the point clearly. And lastly, NPV, every time we will calculate into which currency? Even if you use the foreign currency approach, you are not just stopping your answer with NPV positive. You are converting again into which currency? Reason is what? Positive you tell, sir, NPV amount important, positive negative important. Positive negative important. IRR amounts are important. IRR what is important? Sir, IRR 10 rupees, IRR 20 rupees. Which is more preferable? IRR 10, IRR 20. IRR 10, IRR 20. Which is more preferable? IRR 20. Sir, IRR means inflow outflow same. One is the 10 rupee above the zero. Next one is 20 rupees above the zero. Which will be selected? Positive 10 or positive 20. But NPV we will not check amounts. NPV we will check always positive or negative. So tell me, foreign currency approach is positive. Can it become negative under home currency approach? Then why you are converting into rupees? The reason is NPV of a particular project is started by India or foreigner? Started by which company? Answer. NPV of a project will affect the stock market or not? Whose stock market? African stock market. Indian stock market is denominated in. Therefore, NPV you must recalculate and tell in rupee such that here the market should be affected. Are you understanding the concept clearly? For that reason, even in a foreign currency approach, they don't stop with calculating NPV. They convert again into rupee to show what is the impact on our cash flows. Everyone understood the concept clearly? This is the end of international capital budgeting. This is how all the problems are being done. Hope everyone understood with confidence. Understood the concept clearly, yeah? Can you go to the last category of Forex, everyone? Cancellation, extensions and early honor. Sir, Nostro, Ostro accounts, everyone know? Nostro, Ostro. Can we start, everyone? What is the next concept? Disposal of forwards. Disposal of forwards is the next area. Disposal of forwards. Sir, what is this concept of disposal of forwards? Sir, disposal of forwards is a concept of cancellation of forward rates, extension of forward rates, early honor of a forward rate. Number one, cancellation, extension, early honor. How many concepts are there? 3. See here, Institute study material, again old one, had explained with 4 different scenarios. Now in the new study mat, they have given 1 example out of them. 3 examples they used to give previously. They have given only 1 now. If you can understand the situations I am going to show you now, You can do any extension, early honor, cancellation question. Confident as of now up to the forex 95%, whatever we discuss, are you confident, everyone? Everyone? Very good. First point, number one. With regard to the disposal of forward, we are going to see cancellations, extensions, and early honors. Shall I continue? Listen, in this, let's not waste time in doing so many problems and wasting our time. We will go into the next options now. Once we complete this, because options, there are some important concepts like binomial risk neutralization and black scholes, which is always a confusing concept for so many of the students. So I have to jump into that immediately after this. Sir, whatever the concepts that are covered till now, the huge volume of concepts that we have completed, 10 hours we are taking every day, and we are putting all human efforts possible. Everyone understood all the concepts discussed till now. Sir, again and again I am asking the same question. Your situation before class, after class changed? Everyone, before classes, whatever your knowledge you acquired, after the classes or during these classes, there is a change in understanding. That is what we require. So that's what I promised you also in the law classes, that definitely you will have a definite shift. That's why I told you, than law it will be more beautiful, SFM will be. So because I have confidence in me, and I know what I can tell, and I know what student in general are having a knowledge on. So therefore, please listen carefully. We are now moving into the last areas of Forex chapter called as the disposal of forwards. There are three concepts. Number one, cancellation. Number two, extension. Number three, early honor. Easy way to understand this. I have 4 tables. See here. Please see the screen. Listen. Photo session after నేను చెప్తా. After that you take, no problem. I only said you. First listen. Shall I? Listen. There are 3 concepts. Cancellation, extension, early honor. Cancellation, extension, early honor. In that, cancellation, extension, if you understand, early honor is almost similar with the changes. Basic changes. See the screen. First, forward contract is a contract entered by a customer with his. Forward contract is a contract entered by the customer with his to lock forward rate, such that whatever may happen in the future, he will be unexposed to the risk. That's the idea. Yes or no? Okay. Now listen, see the screen. I really promise you, if you understand these examples without my intervention, you can solve questions on your own. If you understand these, I will give you totally 1, 2, 3, 4, 5, 6, 7, 9, 10, 11, 12 types of situations I will give you. Each 12 types of questions will come in exam. Clear or not, everyone? 4 in each set. Everyone seeing the screen? Let's start. Number 1, 2, 3, go. Start. Point number 1. On 1/1/2000, some year is irrelevant for us. On 1/1 means which date? I went to the bank. And I locked myself for a forward buy expiring on 1/4. Which date I went to the bank? Sir, from here you have to explain. Which date I went to the bank? 1st January. For locking a buyer seller. For happening today, after 3 months. After 3 months, not 4 months. 1/4 at the beginning. Listening, everyone. Tell me, which date I went to the bank? To lock myself on. First 1/4, some year. Okay, now tell me. For 1/1/14 is a forward or spot? Answer. I am buying or selling. Therefore, FB. FB means what? FB means what? Next, on which date I went to the bank? On 1/3, I came to know that I could not buy the dollar because I asked my importer to extend or to cancel. Example, I will tell you. Sir, I imported goods from USA. Okay? I have to pay or not? I opened box. All the goods are of a cheap quality or a defective pieces came. I said that I am going to cancel this contract with you. Listening, in this case, as promised to the banker, I will buy dollar. I cannot buy. When I open the box, 1-3. When I open the box, everything is defective. I want to continue with this importer, cannot continue. I want to pay to my importer, not to pay. Therefore, what will happen automatically? I don't want to pay to my person. Therefore, with the bank, I enter into contract on the day of purchase itself, believing that I will definitely like the goods. But I am now continuing or discontinuing. That means I can continue or cancel. Now everyone in the class answer on which date I went to the bank first to buy dollars. Which date? Today na in future? Okay. How many months after I got realization that I don't want to buy? 2 months after. Now tell me, on which date I went to the bank again? First, I went to the bank for asking cancellation of contract which is created on which date? 1-4. Tell me, for 1-3, 1-4 will become, for 1-3, 1-4 will become spot or forward? Next, I have already entered into which contract? No contract can be cancelled. Every contract can only be countered. Means for buy you can give a counter sell. Sir, I didn't understand this. I will explain you with one example. Everyone, will you see at least once in a year your bank statement? Bank statement. In bank statement, sometimes bank makes a wrong entry. Bank charges 2 times they have given 90 rupees, 90 rupees. Now tell me, if by mistake 190 rupees come, they will strike a whitener. What they will do immediately? Reversal they will do. That means once you note in the account, you can't cancel that. Maximum what you can do, counter it with a counter entry. Same will happen also with this banker. You are understanding or not? Tell me, first you came to first you came on which day? Answer. To buy dollar, sell dollar. Today na in future. Therefore, forward buyer, spot buyer. Answer. On which day you came to know that you could not honor this contract? You went to the banker and said that you are going to continue or cancel. Cancel. So, buy will be cancelled through sell. Buy will be cancelled through. Why? You can't cancel. You can only give a counter. Really you will sell. You will not sell really. Okay. Just the entry will be written. Clear? So tell me. Wow. Answer my question. On which date I went? 1st January to buy or sell. On which date? For 1114 is forward or spot. Therefore that is a FB. SB. FB. On which date I went again? To cancel the contract created on. Therefore for 1-3, 1-4 will become. For 1-3, 1-4 will become forward. For buy I will give again a buyer. I will give a counter seller. Therefore for 1-3, 1-4 will become counter sell. That's the answer. And next very important thing. On which date I went again to the bank? Second case. This one. When I went. Now to cancel the contract created on. Answer. Now for 1-3, 1-4 will become spot or forward. How many months forward? Therefore in the question you need to pick the 1 month forward. Here students are doing lot of mistakes. They will give 1 month forward, 2 months forward, 3 months forward, 4 months forward. So many informations will be given in the question. That's why always I recommend my students generally, whenever you write this in the question itself directly. You analyze the transaction step 1 such that you don't commit mistakes when you are analyzing which rate to be taken. Clear? So therefore, now tell me the second one. Tell me on which date you went? For buying or selling? Answer. For buying. So for 1-4 will be forward or spot? Buy or sell? Therefore forward buyer, forward seller. On which date you went to the bank? On the due date you went to the bank to honor or to cancel. So you went to the bank on which date? 1/4 to cancel the contract on 1/4. Tell me, buy will be cancelled through. Now for 1/1, 1/4, 1/4 will become. Therefore, spot sell. Second one. Understood the point or not? In this case, what rates we will take? Spot rates you have to take. Students are mugging up these. If the request is made on due date, spot rate is relevant rate. If request is made before the due date, forward rate is relevant rate. So, forward rate is relevant rate and batti kottavu gani ye forward cheppatla. So, point is, third situation you analyze. देखो, देखो. Tell me, first on which date you went to the bank? To sell bhaiya, sell. On which date? On which date? 1/4. You created forward seller, spot seller. You can sell, you cannot sell, cannot sell. When you came to know, before due date, after due date? Before due date you came to know. Okay na? So you came to know about a situation that you can't sell on 1/3 itself. You went to the bank. So tell me, for sell, reversal will be. For 1/3, 1/4 will be. So counted using FS. Sorry, FB. Here selling now. Okay, FB. Next, like that here it will be counted with the SB. First, everyone understood or not? Very good. So what we completed now? Cancellation we completed. Next one will be called as, what is the next one? Early honor. Next one is early honor. Now you people have to shout. Okay, start shouting. Tell me, first. First one, on which date you went to the bank? On which date you went to the bank? Bhaiya, sella. Today na, future. Forward bhaiya, spot bhaiya. Now you want to prepone the payment, postpone the payment. Early honor, I said. Prepone, postpone. Prepone the receipt payment. Prepone the receipt payment. In this case, first box. Again, let us start. First one, on which date? You went to lock yourself for forward buy on which date? After 1 month or 15 days, so you came to know that you are going to, you got suddenly the money. You want to pay immediately. Clear everyone? Or sometimes the other person may tell, I will give you 10% discount if you pay immediately. Then it is better to avail the discount or not. Therefore, I want to make a prepayment of postponing. Answer. Tell me, on what date I went to the bank? Answer. 1st February I went to the bank, saying the bank that I will pay not on 1/4 but I will pay on 1/3 itself. Clear or not everyone? Sorry, I will do one thing. Sir, you read first this, next this, lastly this. Okay. First tell me, on which date I went? Everyone in the class, which date I went? To buy a seller. For 1/4, for 1/1, 1/4 will be forward as spot. Buy a seller. On what date I came to know? Third one. On what date I came to know that I am going to make the prepayment? 1st February. I went to the bank and I said, already I created one contract na. Please cancel it. So tell me, already created one is forward buyer, spot buyer. Buy will be counted with 1/2 ki 1/4 will be. Therefore, forward buy will be counted with forward sell. But I want to pay it now. I have to create a new contract. Create a SR yeah. Create a new contract will be created on which date? 1/2 I will create a new contract expiring on 1/3. 1/2 ki 1/3 will be. Answer. New contract will be what contract? Buy contract. Therefore, forward buy. Here, when you are listening, original contract ki 3 months of forward is relevant. Cancellation ki 2 months forward is relevant. New contract ki 1 month forward is relevant. 3 rates we have to see in the question answer. Are you understanding or not, everyone? Next. Second bit. Answer. Tell me. On which date I went to the bank? To buy. Buy on which date? 1st April. I want to buy. Forward buy or spot buy? Now I want to make a preponement or postponement. Preponement. When I came to know that? 1st March. I came to know. 1st March I came to the bank and said, I want to honor the original contract. Cancel. Answer. Original contract is forward. Buy will be cancelled with. For 1313 will be, for 1314 will become. Answer. So forward buy is cancelled with forward sell. How many months forward? First one. Next one. Fantastic. Next one. What did I went? 13 I went and I said I will buy it today itself. Therefore for 1313 will become original contract is buy, spot buy. Then spot rates are relevant. So he will give spot rate to 3 month forward, 1 month forward, 2 months forward. Understood the point, not everyone. Okay. Remaining to see. You need not answer me. If you understand, well and good. Three and four, have you understood or not? You check once. Forward purchase. Like that only we should cover sometimes. Okay. So now, once again, let us go for extension. So last example, we do some problems in this regard. Last example, please. Listen, on which date I went to the bank? 1-1. I went to the bank to close a contract on. So for 1114 will become forward or spot. Original is what? But I am postponing or preponing. Postponing means can I honor this contract or dishonor? I came to know that on which date? Therefore, 1st March I go to the bank. First tell me, for buy what is a reversal? Sell created. For 1314 will become forward created. Now you need to postpone it, at least make the payment at some point of time or not. For that you need to create which one? On 1-3 you need to create a contract expiring on 1-5. It becomes what? Forward. Clear or not everyone? I will put it before you. Remaining 3 you understand. Since you already have a knowledge on the previous ones. Understood all the 4 circumstances given on the screen, everyone? Can we do the problems now? Sir, everyone in the class understood the cancellation extensions and Liliana's idea behind rates, everything. Are you thorough with it? Now, let us do 3 problems. One on cancellation, another one is on extension, Liliana. Please take question number. First, you take question number 53. 53. On Jan 15th, a company booked a forward purchase contract for French francs 250,000 from a banker. Delivery 15th February at rupees 6.95. On the due date, the customer requests cancellation of the contract. Assuming the French francs were quoted in London foreign exchange market as under. Spot $1 equal to French franc 5.200 dash 5.0300. Next, 1 month 305, 325, 2 months 710 and 760. And the US dollar quoted in local exchange market as under on the date of cancellation. Spot 1 month forward and 2 month forward. What will be the cancellation charges payable or receivable by company on contract cancellation? First read the question. Avesam no. First read. What is happening you need to understand. Okay, now? First, read the question, everyone. First, answer one by one to me. Tell me, on which day we went to the bank? First question is, don't do overaction. Please, everyone participate. Okay? Tell me, on which date you went to the bank? January. To close contract on 15 February. It is a forward buyer, forward seller. Because customer is having a purchase contract. Forward buyer, forward seller. When I came to know that I am not going to do the transaction on due date. Means which date? 15/2. 15/2 I went to the bank to cancel the contract on 15/2. Buy will be counted with 15/2. 15/2 will be. This is how you need to understand the question. Then rates are easy. Apply, answer will come. Understanding or not? Do here itself. Do here itself. Step 1. Tell me. Everyone, step 1. What is a forward buy contract already entered? Rupees 6.95. Now, spot 15/2 ki 15/2 on that. Okay, rates quoted. Spot. So tell me, once again, we want dollar FFR or dollar rupiah or rupee FFR. Quoted or not quoted together? First you tell me, we are having payment or receipt. Answer. So we have to buy French francs or sell French francs. Answer. So we have to buy. So when we have to buy, bank has to, bank sells it, higher rate will be. So calculate. Ask of. Sir, if you want directly the answer, just you need to take 1 second. If you want analysis, you need to write like this. Okay. Analyzing the transaction, clearly you have to write like this. So, first point you need to tell one thing. Company has booked a forward which contract? Purchase contract. For how much? French francs 250,000. From whom? Banker. Delivery on which date? 15th February. Due date, the customer request for cancellation. Customer request for cancellation. Original contract is a buy contract or sell contract. But when you reverse the contract, it becomes a buyer seller. So tell me, we have to sell? We have to sell which currency? French francs. FF, we have to sell FF. Bank has to buy FF. Bank buys at a lower rate. Lower rate will be bid rate. So the required quotation will become what? Bid of rupee by French franc. So 6.95 is ask of rupee by French franc, as we already said. That was already given in the question. So this is ask rate, bid rate. Ask of rupee by French franc. This is already given in the question. So first everyone tell me, original contract is buy or sell? Buy or sell? Reversal contract will be sell. We have to sell what? Bank has to buy. Bank buy said low rate will be, required quotation will be bid of rupee by FF. Clear everyone? Rupee by FF are traded together or not traded? What to do? Bid of rupee by dollar into bid of dollar by French franc. Sir, please you see, we have to take spot of 1 month forward, 2 months forward. Spot. Okay. Observe clearly and tell me what is bid of rupee by dollar. See the notes. See the notes. What is bid of rupee by dollar spot? 34.79 into, sir, original quotation is place. Original quotation is given as dollar by FFI, FF by dollar. Answer. Original quotation is given in FF by dollar. I am asking what? Yesterday I told you bid of A by B can be written as 1 by ask of B by A. Yes or no? So therefore, how I can write this? 1 by ask of FF by dollar. So 34.79 into 1 by 5.03. Tell me. 34.79 divided by 5.03. How much? 6.9165. 6.9165. So first tell me, original contract is a buyer seller. Buy at what rate? 9.5. Reversal contract is a buyer seller. Really I will not sell. Like futures law, we will just write down. Net loss and gain we will pay. Those are called as the cancellation charges. What is the cancellation charges? 6.95 minus 6.9165. It is 0.0335. How many amounts are there? Totally 2,50,000 into 2,50,000. What is the answer? 8375 is the final answer. 8375. 8375. See here, sir. This is how you need to do. First one point, tell me. Honestly, you tell me. Understood the working of problem? Confusion? Shall we do another problem? Let us do another also to clarify any doubts. 54th question, let us do. 54th. 8 marks question already given in one of the latest attempts. 2019, if I am not wrong. Later 2020. Please see there. How many information they have given? Please see there here. Spot 1 month, 2 months, 3 months, like that they have given. Please read properly. 8 marks question. A bank enters into forward purchase TT covering an export bill for Swiss francs 1 lakh at 32.4 due for 25th April and covered itself for the same delivery in the local interbank market at 32.42. However, on 25th March, exporter sought for cancellation of contract as the tenor of the bill is changed. In Singapore market, Swiss francs were quoted against dollar as under, and the interbank US dollar rates are so. Calculate the cancellation charges payable by the customer if the exchange margin required by the bank is 0.1 on buying and selling. Analyze the question first. You should tell me two things. Number one, summary of the transactions. Number two, which rates are relevant. If you are wrong in any of these, now you will be wrong in entire question. So first tell me, summarize the transaction. Which day I went? Which date I went? Which date I went? They didn't give. But expiring on which date? 25th. Forward buyer, forward seller. Forward buyer, seller. Sell. Bank is making a forward purchase. Means for me it will become a sell. Forward, sell. Sir, you should not get a doubt. Export, he said here. Mistake is yours entirely if you understand in other way. So next, on which date you went to the bank? 25th March you went for honoring a cancellation. Everyone, sell cancelled through. నిన్న అడగల సెల్ విజ్ఞాన ప్రదర్శన వద్దు. సెల్ క్యాన్సిల్డ్ త్రూ ఆన్సర్ షుడ్ బి ఎయిదర్ బై సెల్ అంతే. సో సెల్ విల్ బి క్యాన్సిల్డ్ త్రూ ఫర్ 25/3, 25/4 will become spot or forward. That's all. So forward sell will be countered through forward buy. But very important, when I take this, there is only how many months gap? Therefore I should take 1 month forward. I could take only 1 month forward. Now in the next coming attempts, if I have to prepare a question paper, how I will give? I will give 45 days and I merge that broken months forward rates into it. Hope you can understand the concept or not. Are 2 months 15 days? I will give question like that, such that I can test students in both. Did you understand? That also there is a possibility to ask or not. Every possibility will be there. If really they want to test you comprehensively, they can test like that. So that way they can ask. Maybe chance is also there. It can come. So therefore, sir, anyway, up to this question everyone understood na? So tell me, for me 1 month forward relevant, spot relevant, 2 months forward, 3 months forward. It could both. Shall we continue? So therefore, this is a point that they have given. Let us start doing. So answer if you want. See here, sir. How to write in exam. See there. How to write it. How to present in exam. See there. Like this first. What is step number 1? Analysis of transaction. What you have written analysis? Here, bank had entered into a forward purchase contract. That means we as a customer have entered into forward sell contract. Later, we want to cancel the contract of sale. So we need to counter it through a buy contract. Next, calculation of cancellation rate. Start. Since request for cancellation is made, sir, on the due date or before? On which date? Not tell me. 25th March. For that 25th April will become forward or spot. Sell will be cancelled through. Therefore, it shall be relevant. 1 month forward rate is relevant. We need to buy Swiss francs. Bank has to sell Swiss franc. Bank sells at a higher rate. Higher rate will be ask rate. Required quotation will be ask off. But like this, you need to make the adjustments. They have given the swap points. You can see there. If you want, you can copy this. Like this, you need to present your answer. So once again, there swap points are given in the question. You can see. Once again, margins are given. Sir, how much margin is given? Answer. Shall I tell you where the mistakes are getting committed in Forex chapter? First, student is not having a clarity when to adjust margin. First, the spot ki margin add. After that, we need to add the swap points. Or first you add swap points, after you add the margin. That's why in the notes I have clearly given how to do those. See the notes that are given on the right side. For every problem, some have taken notes. See there, if you have a time for every single problem on forex, portfolios, derivative options, derivative futures, portfolio theories, bond valuation, every point I have written the notes, explanatory notes, why it came, how to understand that, what is the idea behind it. So see there, margins should be added and deducted respectively before adjusting the swap or after adjusting swap. See there, that one very important point you need to observe. First forward swap points you adjust it. After that one rate will come now. Finally you should take the margin. Clear everyone? So first one, understood this rate clearly everyone? Lastly, this is the answer. Cancellation charges. Original contract, reversal contract. Cancellation charges, number of SFs, total cancellation charges is 54,750. First tell me, everyone understood the problem or not? Everyone, what is the new point we learned in this? I will tell you the new points. Number 1, opening date they didn't give. Number 2, bank enter into forward purchase means customer enter into forward sell. Listening, margins have been given and swap adjustments have been given. Margin should be added after swap adjustment or before swap adjustment. These are some of the noticeable points in this problem. We will do another problem and close this chapter. That concept is, you should try. I will give time for you. Don't see the answers. Those who have taken my book, please don't see the answers. I have given full explanation there. Don't copy that. 57th question. Try on your own. With this, we'll stop with this chapter. Sir, Nostro Vostro accounts, if anyone want. One YouTube video I have made on Forex. Okay, 6 hours video is there. Only on Forex. In that last 45 minutes, I explained about Nostro Vostro accounts. Do you understand what I said? Please go there and listen. I repeat once again, to save time, Nostro Vostro lower account, exchange position, cash position account and dealer's desk. This entire area, bankers area in Forex, I explained in a 6 hours Forex video already available in my playlist. There you go, last you scroll. Nostro I said in the last 45 minutes. Clear everyone? You visit that, just at 45 minutes you can listen and you can complete it. Shall I continue? Please do this. Shall I continue? Means you should continue now. Do the answer. Don't see the answers. Try on your own. Know the mistakes. So have you completed? Now first see here. I don't know how many of you got the answer correctly. I will show you the solution for this, how to do. See here. Question number 57. Okay. See here. On some date, we entered into a contract expiring on 30/10, which is a forward buy. On 30/10, we went and cancelled the contract entered on 30/10. Spot rate will be relevant. Like 30/10, we cancelled on 31. We created new contract on 31. It's a new contract. Up to there, okay na? Read the explanation below, everyone. Here we as an importer has to pay in dollars on 30th October. Since we are unable to make the payment, we are requesting to extend by a further period of 3 months. So we need to cancel the existing contract by counter sell and create a new buy contract expiring in 3 months. Calculation of new rate. We need to buy dollars. Bank has to sell dollars. All these things. Very, very important is a ask. We need to add a premium. First one, did you understand that adjustment or not? So what we need to add? Premium. We need to first add a premium. Premium should be added. After that, the next thing that you need to do is, see there, forward rate will come. For that forward rate, again, what you need to add? Selling margin you need to add. Sir, ask rate is a banker's buying rate or selling rate? Answer, sir. Selling margin has to be added. See there in the question, they have given buying and selling margin separately. Yes or no? So sale margin, including margin, this is a rate. You can also check the study material also if you want. So next, cancellation rate. We need to sell, reversal contract na sell. Bid rate, margin adjustment, net bid cost. Understood? Okay. Shall I continue? Next, extension. For cancellation, this is the amount. For extension, this is the amount. Net cost 10,400. Only cost will be 17,000. This is the only cost. So this one is the only cost. This is a profit. Net profit. Net cost will be 10,400. Only cost, if you ask now, how much you have to answer? 17,000. Sir, first one, tell me how many of you got 10,400 answer? Not even one. So where you have done wrong, either on premium calculation or on margin calculation, yes or no? So how many of you done wrong only on margin calculation? Margin entry. Okay, very less. Sir, how many of you got these rates correctly? Rates correctly, 41.99 and 41.47. 47 you didn't get? Margin? Adjusted much better. Added. Sir, ask is a selling rate, we have to add. Bid is a buying rate, we have to deduct. Yesterday, first problem we have done this adjustment. Bank buys at a, when there is a margin, buying margin, they will further deduct that. You added the margin, huh? You should not. So this is the answer. So, sir, if you have done up to here, 8 marks question, you will be getting 2 marks. 2 to 3 marks they will give. For this, they will give another 2 marks. For this, they will give the balance 3 or 4 marks. Whatever the balance is there. Okay. So this is how you need to do this answer. This is the answer for this given question. Sir, first, margin adjustments, all these things, okay. Concept wise, cancellation extensions, everyone understood the concept clearly, yeah? That's also, this is the idea behind the cancellation extension. Disposal of forwards has also been completed. With this, the entire forex, including the international capital budgeting, has been completed. Now we are going to start with another big area called as derivative options. See here. Okay. See here. Now we are going to start with another area called as derivatives options. Derivative options once completed, simultaneously I will complete another attached concept called as currency options and futures with the money market hedge. So those areas also we will complete. Clear? After that, then I will start with mutual funds and mergers also. Clear everyone? 3 chapters: mutual funds, mergers and security valuation. Small 3 chapters are there. Mutual funds we will take, listen sir, mutual funds we will take 2 questions on NAV. Intraday NAV and overall NAV calculation of 1 question. Most important difficult area, one concept is there called as constant ratio plan or insurance plan is there. A very big 15 marks to 14 marks question is there. Sunidhi, a question will be there in the study material. That I will explain. Okay. Plans will be there. Bonus plan, dividend reinvestment plan, those growth plan and return calculations. Those problems. 6 problems we will do. 6 problems will cover the 6 different concepts of mutual funds chapter. Clear? Mergers also there are 8 models on mergers. Mostly the important concept will be the synergies. We'll concentrate on that. I will show you how to do the questions on mergers as well. Clear? First let us complete this options and currency options and futures. So listen. Options. Please listen. Basics of options. Basics of options. Break even in options and other relevant concepts inside this. I have already kept 3 lectures on the YouTube channel already with regard to the entire basics of how to understand the options. So again I will not cover those. What I will do is in options I will directly begin with binomial model, risk neutral model, Black-Scholes model, binomial tree model and arbitrage in options with dividend, without dividend. So put call parity with dividend, without dividend. Clear or not everyone? Exam oriented questions will come from basics or advanced aspects. I will discuss those. Clear everyone? Again, what is call, what is put, who will be there? I don't want to discuss all those things. Listen, in the YouTube channel, options I have made 3 lectures. 3 lectures I covered full basics, regular classes videos for demo purpose I kept in the YouTube channel. Clear? When you find time, you can listen. I don't think that people sitting here for the revision has no basics or options. I think you have the options basics. Right? Therefore, that problem will not come. So my only point is, if you want, you listen those. But I am not going to start with what is options, what is call option, put option. I don't want to waste time here. I will just directly go into the binomial and risk neutralization model first. Everyone, can I start with the concept? See here, sir, everyone. So, first point. When I say I am going to start with binomial risk neutral, first point number 1. In options, derivative options area, generally what student feel difficult is option valuation models. How many option valuation models are there? 4 technically. Number 1, binomial. Second one, risk neutral. Third one, Black-Scholes. Fourth one, binomial tree. How many concepts are there totally? 4. After that, there is a concept called as arbitrage in options. Which concepts are? Arbitrage in options. Another concept is there. Arbitrage in options. Once this is completed, options, the advanced aspects will be over. When I am saying in the class that I start with advanced aspects directly, first you should understand that we are going to cover all important aspects in options. Again, I am repeating, if at all you want to know from the bare basics of options in the YouTube channel, I have already created 3 videos on derivative options. Almost 6 hours basics on how to understand the options. Okay. Now I am going into the concept of options with a small introduction. I am not going into every analysis of the options. I want one answer from your side. Point number 1. how many kinds of options are there? Answer, sir. How many kinds of options are there? 2. What are those? Everyone, what are the 2 types of options, sir? Okay, now 1-7 now. By 1:20, all basics I will complete in 13 minutes. Start doing the problems directly. Okay? Provided you answer me properly. Ensure that you are answering. Point number 1. How many kinds of options are there? Number 1. Number 2. Call option will give a buy option or sell option. Call option is an option to buy or option to sell. Answer, sir. Very good. Next one, put option. Put option. Very good. Again, I am asking how many kinds of options? Number 1. Number 2. First one, call option. Second one. Okay. Now tell me, in call option, buying will happen or selling will happen? In call option, buying will happen or selling will happen? Buying will happen by a call holder. In case of a put, what will happen? Now listen carefully. When you have options, there are 2 parties. One is a holder, another one is a writer. Another one is a writer is a person who create the option. Writer is a person who create the, holder is a person who buy the created option. Call option is an option to buy a share. Put option is an option to sell a share. Everyone repeat the statement. Call option is an option to buy a share. Put option is an option to sell a share. Today na in future. Today na in future. Everything is happening in future. So first point everyone understood clearly? Yeah? Now see here once. One small analytical point. First, here if you observe, 2 parties are there. Who is the first party? A. A has promised to sell. A has promised to sell whom? Mr. B. How many shares? Of which company? On which date? At what price? 3,000. Listening everyone. Now tell me, who promised to sell? Who promised to sell? Obligation or option? Obligation for him. Option to whom? B. That's why B, you can see the arrow mark, has an option to buy on the due date if the market is unfavorable. See again. Tell me, who has an option? First one, option already leave off. How many parties are there? Who are they? Who is A? Seller or buyer? B. Guaranteed buying optional. Well, A has obligation or option? B has obligation or option? Tell me, who promised to sell? Who has a right to buy? B has an obligation or option? Very good. Tell me, A is also called as a writer or seller. Writer or seller of share, seller of an option, seller of an option, seller of a. Okay, now tell me, I will give you an example. Just you answer this question. There are 2 types of prices: strike price, actual price. Tell me, what are the 2 prices? Strike price is a locked price. Actual price is a fluctuating price. Okay, na? First one. Second one, action by call holder. Value to call holder. This is what happening. Sir, okay. I will give you numbers. You put them and answer this. 100, 100, 100, 100 and 100. Tell me. Actual price is running as 120, 110, 100, 90 and 80. Tell me now. Call option I am asking about. Tell me. I am a call holder. I am whom? Call holder. Tell me. I have an option to buy a share at how much? A share which is actually trading at 1, I will exercise a lapse. Exercise. Next, second situation. I have an option to buy a share at how much? Which is traded at. So I will exercise a lapse. Very good. Third case, I will exercise a lapse. Indifference. Whether you exercise or lapse, answer will not be different. Tell me now. Fourth case, I have an option to buy a share at how much? 100. Which is available in the market at? Available in the market at. Now tell me, I will get a loss. I will exercise a lapse. I will lapse. Okay. Next, last one. I have a option to buy a share at how much? Answer. Which is available at? I will exercise a lapse. Lapse. Everyone understood to here. First situation. What is the value to me? What is the value to me? Second. Next. 0 and 0. Because when you are lapsing, you will have a value or no value. This is the first point. Everyone understood or not? First tell me, sir, from this logics. See here. Point number 1. First, Mr. A is there who is a call holder. He can buy a share at 100 only, which is available in the market at 120. Yes or no? No. Answer my question clearly. Here you can understand this in two ways. Here how much I have written? Plus 20. Plus 20. Listen, sir. You may ask a question. Sir, why you have written plus 20 here? Really he is not getting any advantage. Yes or no? He has an option to buy a share at. Not listening. You are having an option to buy a share at which is available in the market at. That's all, sir. A share which is available in the market, he is having it how much? 100. So what? Great. So why you are taking plus 20? You can understand in two ways. You can understand options in two ways. Number 1, speculator point of view, hedger point of view. Everyone tell me, speculator point of view, hedger point of view. This angle of understanding the options is not given in your study material. Therefore, there is no chance of any student knowing about this. So please listen carefully. Point number 1. Options are used as a tool for hedging. Okay. So therefore, how you can understand options? In two ways you can understand. Speculator point of view you can understand. Arbitrager point of view you can understand. Hedger point of view you can understand. Arbitrager we call as a options arbitrage. I told you, na arbitrage we will do problems. At the time I will explain you. Clear? Now we are going to see speculator and hedger. Listening everyone. Tell me now. Share is available. First case. Share is available in the market at what price? How much? I have an option to buy that at. I will exercise a lapse. Exercise a lapse. Now tell me, I am a speculator. I want to speculate on options. Okay. I paid 5 rupee premium. How much? 5 rupee premium. And I entered into the options market. Locked SP of 100. Locked SP of 100. On this premium is 5 rupees. Say for example. Okay. How much premium I paid? And I entered into the options market. And I entered into the and locked the price at on that day price happened to be 120. Price happens to be. Now I can buy a share which is available in the market at only at how much? Immediately I can sell. I can make a 20 rupee gain. That's why these are called as a speculator payoff tables. These are called as what table? That means first 10-15 problems you do generally are not hedging tables. Those are all what? Speculator tables. Ante you are having your leg only in? Not answering. You are having your leg only in one market. Which market? Options market. So now tell me. I paid premium on share to buy 100. I locked it. Tell me. First situation. Price went to? Price went to? I will buy only at how much? And sell immediately in the market at? Answer. Very good. Next stage. I can sell in the market at? I am getting a gain of? Answer. And now tell me, fourth case you take. Which case? Fourth case, in the market, price went to how much? Now tell me, if I exercise the option, what will happen? I have to buy at how much rate? If I sell in the market, how much I have to sell? Any fool will sell like that. Therefore I will, will I get any cash flow? That's why 0. Are you understanding the concept or not? Hedger point of view, let us see. Whose point of view? Means already I short sold share belonging to a person. I am forced to buy now. Whether I buy from writer or whether I buy from the market is a subjected question now. Did you understand the question or not? What I already made? And they already have taken a short sell position. So today, price of a share, 135. I found that this will be the highest price for this share in near coming future. Immediately I made a short sale. And at what price I would have already sold? 135 I have sold the shares. Now I have an option to buy, an obligation to buy. Bigger everyone. Obligation to buy, but that obligation may be with a writer or with a market is a question now. Clear or not? Now listen carefully to the point. Already what I made? Short sell means I will borrow na buy. First incident. Short sell means I will buy or borrow. Borrow share belonging to stock lender. In a short sell there are 3 parties involved. 4 parties. 1, investor, stockbroker, stock lender, buyer. I will first give instruction to whom? Stockbroker goes to borrow for his owner on my behalf, and he will sell to whom? This is what? Short sell. That means I have an obligation to refund back or give back the share to you or not. Now tell me, that means I have an obligation to buy or not? I have to buy. Where I will buy is a question. Understanding or not? Tell me, sir, what I did? I have to give back your share or not? That means I must, must to do what? Must buy today, na in future. The answer, sir. In future, markets will be same, it may change. To cover my risk in the future, for hedging, I will enter into options. Did you understand the point or not? What I will do today, I will enter into a call option. Now see the situation. Tell me, in the market, price went to. But I have an option to buy it. What I will do now? I will buy at 100 and I will give back the share to him. 35 rupee profit for me. Net profit. Why 35? 135 I already sold. I told you, na sir. So tell me, market has raised it to 110. I will buy in the market and close the short position. I will buy in the market or I will buy with the writer. At what price? A share which is available at. I will sell the share. I will give it to the stock lender. So tell me, at what price I bought? Come from the beginning. So many are answering. Tell me. First case. And you local layer. Please see there. Point number 1. Situation 1. I short sold the share today or not? At what price? 135. I have an option or obligation to buy. But whether that obligation will be done with the writer or in the market, we have to know on the expiration date. So expiration date, how my cash flows will be? Let us see. Tell me, in the market, what is the price? Tell me, I will buy at 120 and close the position. I will buy at 100. Why? I have a call option. Listening. So second. Market went to 110. I will buy at 100 110. And exercise a lapse. And buy with the market or writer. And close my short position again. Now my gain will be again. Answer, sir. Now tell me, across any price, your profit is 35. Yes or no? That's called as hedging. That's called as hedging. Your risk is covered or not, everyone? What is covered? Sir, when I have a risk, some other person is covering my risk. In general tendency, we call them as insurance contracts. Yes or no? Sir, my risk, right risk covering or not? Answer, yeah. This is in general sense. My life is there. On my life, some other person is giving money. What we call life insurance. On my car, someone is giving risk security. What is it called as? Insurance. Insurance is something which means others risk some other person will take. Answer. For that, what they will charge in insurance? That's why here also premium. That's why in SEBI, which chapter? SEBI. SEBI Act, SEBI will take care of adjudicating authorities under section number 15 IE. Second one, SEBI will also take care of appeals to SEBI. Appeals to SAT will be there. So SAT will take the appeals again as the orders of SEBI, again as orders of adjudicating authority, again as orders of Insurance Regulatory Development Authority of India, because derivatives are insurance contracts. That's why Securities Appellate Tribunal will take the cases relating to Insurance Regulatory Development Authority and PFRDAI. Securities Appellate Tribunal. Have you heard a word called a Securities Appellate Tribunal? You go home and read. Securities Appellate Tribunal will take the appeals against orders of SEBI, appeals against orders of adjudicating authority, appeals against orders of IRDA, appeals against orders of PFRDI, section number 15K, SEBI Act. So, in that they will take appeals. Why? Because derivatives is a typical insurance contract. Listening or not? Moreover, SEBI Act there will be SAT. SAT one of the section will be there, which will be talking about a Sarchicum selection committee for selecting the technical members of the SAT. A technical members of Sarchicum selection committee, one of the member will be member from Insurance Regulatory Development Authority of India, because he will check whether you have having the knowledge on derivatives or not. Do you understand what I said? So, the point what I want to tell is, everyone please answer. Options can be used in two ways. Number one. Number two, hedging. Arbitrage we will see separately. Clear, everyone? Now tell me, sir, tell me. Hello? Please see here. Now answer my question clearly. I made a short sale at? Answer, sir. Uniformly answer. I made a short sale at? Locked myself at? Now tell me. Now tell me. Market price increased to 140. I will buy it. Increase it to 160. Increase it to 1000. Now tell me, I will buy only at 100 and I will close the short position already created. Yes or no? Reverse now take. Market price fall to 90. Market price fall to. I will exercise a lapse. Lapse and buy at 90 and give back. Am I clear or not, everyone? So therefore, now tell me, sir, everyone in the class, answer my question. Everyone understood the idea of a call option, put option now, everyone? So put option, call option are two parties. Ek writer who creates an option. Who creates a? Next, holder who buys the option. Who buys the? Now tell me, what call writer will do with the share? What call writer will do with the option? What put writer will do with an option? What put writer will do with the share? What put holder will do with an option? What put holder will do with the share? What call holder will do with an option? What call holder will do with the share? Here, John Doe, sorry. See there. Point one. How many parties will be there in options? Number one. Number two. Writer, holder. So tell me, writer is a seller of contract. Holder is a buyer of a contract. Writer is a? Which contract? Options contract. Either put or call. Holder is a buyer of an option. Writer is a seller of an option. Everyone understood? Holder is a buyer. Writer is a Seller. Who sells an option? Writer. Who buys from him? Holder. Up to here, everyone understood? Can I become a writer? Yes. Demat account, you have to select clearly that you want to become a writer. Okay? Sorry. Now listen carefully to the point. Everyone in the last bench is also visible. Now listen carefully to the point. See here. Call writer. Writers are of two types. Call option writer, put option writer. Holders are also two types. What is that? Call option holder, call option holder and also put option holder. Writer. What writer will do with a call option? Read. With a call option, he will sell an option and he will sell a share. Tell me, call holder will buy share or sell share? Call holder will buy share or sell share? Call holder will buy. Who will sell? Call writer. That's what I have written there. Listening or not? So simply, a call holder will buy an option to buy. Repeat. A call holder will buy an option to buy. Or you can tell, a call holder will buy an option to buy a share. Repeat what I said. A call holder will buy an option to buy a share. A put holder will buy an option to sell a share. Avesmuttu. He will not sell an option. Day 6 life you are weak na options. Govinda. Tell me. Call holder will buy an option to buy a share. Put holder will buy an option to sell a share. Call writer will sell an option. That's all. Put writer will sell an option. That's all. Always writers will sell options. Holders will buy options. Listening or not? Holders will always buy options. Writers will always, again, clarity. Writers will not satisfied. Writers will sell. Why you are shopping? Some people are stopping with sell. What sell? Rala Rapala. So tell me, writer will, holder will. What will happen with the share? Buying or selling a share? It depends, because on expiration date whether I will buy or not depends on the price on the day. If at all I exercise, tell me, call holder will with the share. Call holder will buy a share. Call writer has to sell. Put holder will sell a share. Put writer has to buy. Answer over. Understanding the point or not? No, don't see the chart. Answer. Call holder with option. Whether your brain is using Pentium chip, Celeron chip, i3, i5, i7, i9, or Apple M1 chip, or Apple M2, M2 Pro, M2 Max, I will decide now. Okay, how fast your processing is. Don't tell Charles Babbage computer. So answer properly. Process fast. Tell me, call holder with an option. Call holder with an option. Call writer with an option. Put holder with an option. I pen biscuit. Call holder with an option. Sir, when I say word, brain should process that sound. Bad processors don't use. Outdated processors. Brain should catch the sound properly. Listen carefully. Announcement sound bhai anipisthayi. So, answer my question. Point number 1. Tell me. Call holder with an option. Call holder with a share. Bad processing. Very bad processing. Sir, when you use laptop, you clicked on share. Over. Later, S typing. H typing. A-R-E. Typed after 5 seconds. You will use will throw away na. Bad processing. So tell me, point number 1. Call holder with a share. Call holder with the option. Slow processing is better than wrong processing. Slow process. If I click on share now, it should not give other answer. So listen carefully. Point number 1. Call holder with a share. Call holder with an option. Let me ask. Put writer with a share. Syntax error. Error 404. Put writer with a share. Sir, when I sell put writer, mind map should come first. What writers are doing? Sir, holder will sell. Writer has to buy. Tell me. Put writer with a share. Put writer with an option. Call writer with option. Two months lo exam, call writer, put writer, option, buying and selling. Tell me now. Everyone please answer. Break. Already system is shut down. Since long back. Listen carefully. You are in hibernation mode. Stand by. Sorry, one second. Hey, don't shout there. Let's complete and we will go. Tell me. Clarity, please give me and you go. One by one answer. I will ask easily. Call holder with a option. Call holder with a share. Put holder with a option. Sir. Call holder with an option. Call holder with a share. Put holder with a option. Put holder with a share. Call writer with an option. Put writer with an option. Sell. Put writer with a share. Call writer with a share. Are you understanding or not? Sorry. Okay. So there are three types of persons in options market also. Number 1, speculators, arbitrators, hedgers. Speculator will enter only into one position. Arbitrator, already he short sold in cash market. Already he short sold in. Sir, cash market, if I make a short sell, I am at a risk or no risk? Think, sir. Brain ichadga sir, Devudu, please. If I short sell, there is a risk or no risk? Very risky. Why? I have to buy the share and give back to him or not. When I go to buy, prices may increase or not. Therefore, I will first, already what I did. Sir, hedgers I told you. What is the behavior of an hedger? Hedger will first enter into one market. And that market will become shaky. Now to protect himself, he will enter into opposite market being options now. Everyone understood the hedger? Already what I did. Short sell. Short sell means I borrowed and sold, bought and sold. I have an obligation to return back or not. Return back today in future. What I have to do in future? Buy and return. To buy and return, I have to buy or not. I can't print money. I have to buy and give. Therefore, when I buy and give, when I try, prices may increase or not. Therefore, to protect myself, today I will also enter into a call option. Clear? Call option means a guaranteed buying price I will get or not. On the day, price became 140. What I will do? Actual price. Sir, my SP is 120. Say for example, SP is changed. Question is changed. SP is what? 120. How much? 120. Tell me. On that date, actual price is 150. Exercise. And what I will do? 120 I will buy or not? And I sell at 135. I sell at 150. No, I will close my short position. Because hedger intention is not to make gain. Hedger intention is to cover the loss. Understood or not? Price came to 80 on that day. What I will do? I will exercise a lapse. Lapse. What I will do? Buy at 80 and return the share. Lasering or not, everyone? Next, think as a speculator now. Speculator will enter only into one market. So I will enter only into which market? Options market. Now tell me, I paid what? Premium. Entered into which market? SP is 100. SP is take scenarios. 150 AP. What will happen? Answer means I can buy it, sell it, gain 50. Next 140. Exercise, buy it, sell it, 40. Next 100, 130, 30 gain, 100, 120, 20 gain, 100, 110, 10 gain, 100, 100, 0 gain, 100, 90 laps premium fat. You are in loss. Understood or not, everyone? Everyone had a full clarity on the concept. So we observe two persons now. Number one, speculator. Number two, hedger. So after the break, I will directly start with arbitrages. Clear? 10 problems I will do in options. 5 on arbitrages and put call parity, 5 on models. Then we will cover and we will go to the next chapter. Clear or not, everyone? Okay. Sir, today please take only 45 minutes break. Now it is 1:40, 2:20 we'll meet again. One day please sacrifice and nothing will happen. I also have to shout along with you. So in the options, we have completed the basics of understanding how the options actually work. Now we need to understand the positions that a person can take in the options market. I think that also we completed. This one. So parties involved in their activities. Writer, holder. Writer can be of two types again. Call holder and put holder. Writer will be call writer and put writer. Writers will always sell options. Holder will always buy option. So whenever options chapter is concerned, the difficulty student will face because of two things. Confusion between option and a share. Whenever I ask a question, what a call holder will do? Buy. What a put holder will do? Sell. No. He will buy an option and sell a share. So two things we need to understand. In both the cases, premium is a negative number for holder or writer. Put holder or call holder. Both it is a negative number. Which one? Premium, because the premium is the cost of an option. Binomial model, risk neutral model, all these models will calculate what? Premium calculation. Premium calculation done through those models. Which model? Binomial and risk neutralization model. Shall we continue? Now listen carefully. Shall we begin? Any more to come? Many more, I can't do anything. I'm starting with the valuation models. What is the valuation models concept? Binomial model, risk neutralization model, Black-Scholes model, and binomial tree. All the four models. Model. Shall we begin, bro? So, shall we begin? Okay. Shall we start, everyone? So, option valuation models. There are totally 4 option valuation models. In that 4 option valuation models, Black-Scholes model will take lot of time to analyze the formula, around 3 hours session, because each and every formula you need to understand. Therefore, I will not go into intricacies of formula in this class. Regular class, we can see that. What we will do is, listen, I will tell you the steps to do the formula, particular problem. In 13 steps we can do. Easy breaking of Black-Scholes model into 13 different steps. Clear? In examination, they will give you standard normal distribution table. Using that, you have to pin the numbers. Here, everyone? So, you have to pick the numbers. The picking the numbers, I think you know how to check the numbers for Z numbers in the standard distribution table. Okay? Sorry, that also means I can't do anything. So, listen carefully. So, I will do the problem in the steps format. So, Black-Scholes model, but logic, everything we will be explaining for binomial model, risk neutralization model, I will explain. Okay? Let's begin with the concept, but before going into that, please see the screen once. Option valuation models. Till now in this chapter, we have seen only the market behavior and the way in the parties act on market changes. In theoretical boundaries concept, we have understood how much is the minimum and how much is the maximum, but we didn't value any option till now. For this, there are 4 models. Number 1, binomial model, by 2. Second, risk neutralization model, second one. What is the third one? Binomial tree model. And last one, Black-Scholes model. Exam lo, what is more important? Which will be very frequently asked question. First two. In past 10 attempts, 6 times binomial and risk neutral came. 2 times this Black-Scholes model came in exam. Black-Scholes is student-wise difficulty they will face because of formula. They don't understand. So now what I am doing in the class is I will break down that formula. Clear? Such that you will be ultimately comfortable with that Black-Scholes model. Okay? You will like to come in examination. Confidence will come. Okay, if it comes in examination, happily I can score the 6 marks. That feel you will get after this particular class. But difficult models are not Black-Scholes. Difficult models are binomial and risk neutral models difficult. Binomial tree is very easy. Okay, let us first see about binomial model and risk neutralization model. Listen, binomial model and risk neutral model. First, everyone concentrate. I am going to start first with which model? Binomial model. See the screen. Totally there are 7 steps in binomial model. So see here, steps in binomial model. Okay, see there. Step number 1, create risk-free portfolio consisting of write a call and hold a share. Calculation of delta shares. Delta shares equal to change in value of call by change in value of share. Third one. Okay. Calculation of future value of portfolio. Calculation of present value of portfolio. Calculation of present value of delta shares. Calculation of value of call. Calculation of value of put using the put call parity equation. First, everyone in the class, note down all the steps. At the end of another 1 hour from now, you will be perfectly confident with the concepts binomial and risk neutral. Please write down all the steps. We are going to do 4 problems on this. 3 we will do, 1 you will do. Don't just take photos, write down. You take photo, no problem, but write. In exam, he will use the word replicating portfolio model. At that time, don't tell he didn't teach it. Replicating portfolio means what? Binomial models. Another name is called as a replicating portfolio. Why? Also, I will tell you. Once copy down. Shall we continue? So totally how many steps are there? 7. Listen, these 7 steps are to value what? Value the premium. Premium on dash. Call option, put option. Call option A. Put option we don't calculate using this model. Under this model we calculate call using put call parity equation. Everyone know put call parity equation? What it is? What is the meaning of put call parity equation? Anyone? What is the meaning of a put call parity equation? What is the meaning of put call parity equation? Any guess? What is the meaning? Answer okay. So we should understand that also or not? Answer here everyone. That also will be answered. So listen carefully. Please give me some time. Listen carefully. We will do together. Okay? See here now. Point number 1. First, work number 1 that you should do. Mug up the steps. Literally by heart them. Steps by heart, not the concept. Steps by heart, na? Remaining I will take care. What is the step number 1? Na? Create a riskless portfolio, a risk-free portfolio consisting of write a call, not hold a share. It is what? Delta share. It's called as a derivative Greeks. Called as what? Derivative Greeks. If we would have some time, na, we would also discuss about derivative Greeks. Derivative rho, derivative vega, derivative gamma, derivative kappa, all these things. All these are Greek terminology here. So derivatives like derivative alpha, derivative beta, derivative delta, rho, vega. Class is stopping me from so many things. క్లాస్ ను ఉండకపోతే వచ్చేసేది వాటికి ఫ్లోలో అది వదలమంటారా? థ్యాంక్ యూ. See here. How many steps are there totally? 7. Step 1. Create a riskless portfolio or risk-free portfolio, anything you can call, consisting of what? Write a call and hold a delta share. Okay, question. Sir, why write a call? Sir, why not hold a call? Okay. Why delta share? Why not a share? Both questions are there. Yes or no? I will answer. Calculation of delta share. Sir, why, sir? Why change in value of call by change in value of a share? Why we need to do this? In insured material, they will use C1 minus C2 divided by S1 minus S2. Yes or no? Don't use that. Next. So, next one. What is the third one? Calculation of future value of the portfolio. Next one, calculate present value of portfolio. Sir, why to calculate future? Why to bring it to present? What is this? Next one, calculate the present value of not share. Calculation of present value of delta share. Next one, calculation of value of a call. Next one, calculation of value of a put using put call parity equation. Before we go into the valuation, first the summary. Listen carefully. I will never forget what I already said in yesterday's class. I said when we start with binomial model, I will tell why derivatives use RF rates. If you remember, I remember. So I said in the previous session that why derivatives and options always uses what rates? Risk-free rates for calculation. Why not they don't take KE or any other rates? Question will arise or not? Listen, total subject of financial management is dependent on a bedrock concept called as types of persons, behavior. First point number one. FM and SFM, you call inter-FM, final SFM. These are branches of one subject called as economics. It is a branch of economics. Economics is having big branches. First branch is statistics. Second branch is economics. Listening or not? Main branch is called as economics. Economics are two parts. Stats, financial management. If you observe in our entire curriculum, these are there. Foundational economics, stats is there. Internal FM is there, final SFM is there. That means first chartered accountant should know about economics properly. Okay, that is the intention. Sir, okay, good intention. Institute has introduced into the syllabus FM, SFM, whether we are mugging or not. They made their attempt to introduce into your syllabus. You came to know. Economics is based on one common concept which is running everywhere. The concept is whenever rates are there, why in this particular theory only RF is considered to understand. Economics has given a build, the source, the foundation. Okay, platforming is given by economics. Economics divided the investors into three categories. Number one, listening everyone. Number one, risk averse investor. Who is the fellow? Second one, risk lovers. Risk lovers. First one, risk averse. AVERSE, risk averse. Second one, risk lovers. Third one, risk neutral. Third one, risk neutral. Risk averse. Investors are those investors who will not take any risk. If at all you ask them to take a risk, they will ask a premium. Those are all the people considered under stock markets. Portfolio theories are written for them. Written for whom? Risk averse investors. For them, portfolio theories have been drafted. Clear? Portfolio theory, if you have taken the book, you can see portfolio theory concept itself is for 130 pages. Because I have written entire behavioral economics. So how it actually come? Sir, no exaggeration. 2015-16 time, when I came into teaching, etc. at that time, sir, due to some family reasons, I couldn't do that. I tried for IIM Kozhikode for the PhD in economics. IIM Kozhikode, Kerala. So, for behavioral economics, PhD in behavioral economics, because in India, one of the best IIM which you can do, the PhD in economics is a Kozhikode in Kerala. Very popular, IIM economics. So, economics will contain three branches. I told you, micro macro economics will be the first branch. Statistical economics is second branch. Financial management will be the third branch. So, in that, if you read the theories, they write the thesis on how the behavior of investors will be. Investor behavior, they divided it into three parts. One is a risk averse, another one is a risk lovers, third one is a risk neutral models. So, the first one, a person will be there called as a risk averse investor who will not take any risk, like you and me. If you have to take a risk, you should pay me some premium. Why you join CA? You can join BCom also. BCom will get 20,000 per month. Are you understanding or not? BCom, risk free. When you join, you will fail, you will pass. Generally will pass. With that, you have some experience, 20,000, 15,000, guarantee you will get. India has plenty of opportunities if you have an attitude. Okay, right attitude, I am talking. Okay. So therefore 15-20,000 you will get. Now tell me, I don't want to take a risk. I want to join BCom or I want to join BTech. Why you came to CA? It is risky, yeah? Risk free, yeah? Answer, sir. Risky, yeah? Risk free, yeah? Very, 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 very risky. Okay. These many varies are there. Risky, yeah? Not risky, yeah? Very risky. Why you took the risk means you will tell I will get 20,000 salary per month. That premium salary motivated you, rather tempted you to join CA. We are all coming under risk averse category. That's what economics also said. Behavior economics is talking about investors' behavior. How people generally behave, how their mindset will be. People will put money. Answer. They will put money. Whenever they put money in the stock markets, they will ask, sir, first any person, we are all risk averse, risk lovers. We don't love risk. We are averse to risk. Clear or not? We are averse to risk. But if at all we have to take a risk, we will ask a premium. Free of cost, we don't take any risk. Clear, everyone? Okay. Now tell me, as an investor, which is risk averse, you and me, tell me, whenever we are putting our money in a stock market, we are losing an opportunity to invest in a risk-free place, and we are investing in stock markets or not. Therefore, what you are losing in the risk-free, first you should ask it, yes or no? Therefore, CAPL first RF plus. Are you understanding or not? Now you are asking some premium, RM minus RF, like it beta, all these calculations came. It takes hours together to explain that thesis. I'm just summarizing everything in 1-2 minutes, which I normally discuss in a class at 3-4 hours. So what we have to understand, risk averse is a person who don't take risk. If at all you have to take a risk, he will ask a premium, number one. Second type of persons, they will pay money to take risk. They will pay money to take risk. Financially, I can give examples. Sir, pay money to take risk means so many people will do that. I'm talking about investor point of view. When a person buys a lottery ticket, which ticket? 1 lakh persons participate in a lottery. Clear? Lottery money is 500 rupees ticket price. How much? 500. Prize money 1 crore. Listening? Now tell me, every participant will get 1 crore. Only one among them will get. Answer. They will put a lottery or not? Lottery, they will take one name. That one person will get that 1 crore. 1 lakh people will participate or not? 5 crores will come to the draw. In that 1 crore, they will give as a lottery draw. That means, answer my question clearly. I buy a lottery ticket worth 500. Say example. Okay. Now tell me, my chance of getting that 1 crore is 1 lakh P1. Yes or no? How much? 1 lakh P1 means chance is 0.000001 out of the total 1 lakh people. Answer or not, everyone? That means I know that it is very, 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 very remote chance is there that it clicks in my favor. But still they are investing or not. They know entire 500 gone the day on which they put it. Yeah, but still they will put. Risk loving persons. They spend money. They know that where they are taking risk. Third type of category of persons will be there. Risk neutral. Risk neutral means they don't consider a risk. They don't consider risk. They don't consider risk at all. Okay. So they don't consider risk at all. These people are called as which type? Risk neutral. Derivatives uses risk neutral type of investors. That's why risk neutralization model came. Portfolio theories uses risk averse. Derivatives uses risk neutral. Okay. Who uses risk loving investor? No theory was very much till now. Are you understanding or not? So this is a point. Now listen carefully. Tell me, one by one, let us pull up the point. Question number 1 I asked is, why derivatives and options will use RF? Okay. Question number 1. What is a share? What is the value of a share? Present value of future dividends Discounted at KE is called as what? Is called as what? Is called as a value of share. Okay. You may know or may not know. I don't know exactly. I will write one formula. Whether you know it or not, please tell me. See here. I will write here. Value of a call equal to, please listen, spot price minus present value of strike price. How many of you don't know this or know this? One, two, three, four. Really? Okay. Value of put equal to? Those who raise hand only should tell, because others can't tell. Reverse. PV of SP minus spot price. PV of SP minus spot price. See here. Sorry, sir, I can understand. Please. So tell me, what is the value of a call? Spot price minus present value of strike price. Okay. Next, what is the value of a put? Present value of strike price minus spot price. Okay. This is proven formula. How? I will prove later, not now. So believe that this is the answer for value of a call and put. Up to here, everyone understood? So please, there are a lot of discussions we need to make. You should follow on properly. So listen carefully. What is the value of a call? Spot price minus present value of strike price. What is the value of a put? Present value of strike price minus spot price. Okay. Now answer my question clearly. Spot price means spot price of what? Everyone. Spot price means spot price of what? Very good. Spot price of a share. Present value of strike price. Strike price means strike price of what? Share. Up to here understood. So stage by stage I will ask you. Don't get irritated. Answer and let's go to the next step. Tell me, up to here understood? Tell me, spot price means spot price of dash. Strike price means strike price of dash. Same also here. Strike price of a share. Spot price of a share. Now listen carefully to the point. What is this? Value of a call. Tell me, what is the formula of a value of a call? Spot price minus present value of strike price. Spot price minus present value of strike price. Okay. Now tell me, listening everyone, what is the value of a share? Present value of future dividends discounted at required rate. Discounted at, like that you might have already got the value of a share or not. Like that here also you might have got a value of a share or not. Now tell me, value of a call is a separate value. It is a difference between value of two share prices. You only said, again you are forgetting. Spot price means value of A. PV of SP means value of A. This share value minus this share value will give the value of a call or not. That means value of a call comes from SCI. It is a derived. Derived from the value of an underlying asset. That's why call option is a derivative. It doesn't have any value on its own. It derives its value from what? Underlying share. This is a classic example for that. Listening. Spot price value 0. Automatically strike price will be 0. Sir, present day not there means how future will be there for that? Clear everyone? Okay, now tell me. What is spot price? Spot price of a SP. SP of a. Difference between both of them will become the value of a. Tell me, what is the value of a share? Everyone. Future cash flows discount, future dividends discounted at KE. Discounted at. Like that they might have already calculated spot price or not. Like that they might have calculated SP or not. Both the differences will give what? Value of a. First one, the problem is when value of a call is derived from two share values which are already discounted at KE, the balance figure which is a value of a call should not be rediscounted again at KE, which is a higher rate. This is how all the experts have found. What we are discussing now? Why RF is used in options valuation? We can't use KE because already share is discounted using what? Again, strike price is also discounted using what? Already two values are already discounted at a KE or not? They are discounted already at a higher KE. Again, discounting value of a call at a KE doesn't make any sense. Clear, everyone? So this is the first part. Everyone understanding the logic or not? So tell me, what we are discussing? Why derivatives and options will use RF and not KE? Clear, everyone? Futures also same reason. What is the value of a future? S into e power TRF. S is the price of a share or not? Already it is discounted at what rate? Then why you are again compounding or discounting using KE rate? Therefore, we will always take RF rates. Understood or not? So tell me, what is the value of a call? Present value. The surprising point is you don't know this formula. How much science is there behind this formula? We will understand later. At that time, you will get awestruck. గుర్తుపెట్టుకోండి టైం ఈరోజు నేను చెప్పింది కరెక్ట్ అవుతుందా చూద్దాం. Remember this dialogue. So the point is the value of a call is spot price minus present value of strike price. Okay. So spot price is the value of, strike price is the value of, difference between two share prices is the value of. That means a share might have already undergone a higher discounting at KE or not. Again, discounting call option cash flows at KE will make a double discounting at a higher rate. Listening, everyone? Therefore, first the experts have found that we should not use KE for discounting. Point number one. Hope everyone understood the point or not. So first point over. Next, second one. Why? Second question. Then KE should not be used is a conclusion. But why RF is the next question? Here, what is the conclusion they drawn? KE should not be used. KE should not be used. Okay, done. KE cannot be used. I will agree. But what should be used if not KE? They said RF. Then the question started. Listen. Then the question started. Why RF? Why can't any other new rate we can find? The question will arise or not. So why RF? What is so great about risk-free rates? That also we need to analyze. So see here. Please, everyone. See here. I will give you one question. You answer this. SP, AP, action by call holder, value by call holder. Please answer. 100, 100, 100, 100, 100, 100. 130, 120, 110, 100, 90, 80, 70. Okay. Now answer. First case. Exercise the lapse. Everyone. Sir, I have an option to buy a share at 100 which is available in the market at 130. I will buy with the writer. I will buy in the market. Buy with the writer, buy with the marketer. Buy with the writer. Therefore, I will exercise the lapse. Exercise. Okay, next. Exercise the lapse. Next. 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 Lapse. Next. Lapse. Next. Lapse. So tell me what is the value? 30, 20, 10, 0, 0, 0, 0. Now tell me, please. Now tell me, how many cases we have considered here? Answer. Okay. I will total them. Okay, I will total them. So 30 plus 20 plus 10, how much? 60. Average will be how much? 60 by 7. Yes or no, everyone? 60 divided by 7, it will be 8.5714. Sorry, 8.57. Listening or not? So now tell me, 30 minus 8.754, you will get one value or not? 20 minus 8.574, you will get one value or not? Like that, 10 minus, 0 minus, 0 minus, 0 minus, 0 minus, and these squares again. We will get a standard deviation or not? Will not? Why you will get standard deviation? Because there is a deviation from the average. There is a deviation from the average. What is the average here? 8.57. From that 8.57, everyone is 8.57. 38.57. Big deviation is there. So there is a standard deviation or not? Standard deviation is there means there is a risk or no risk. Standard deviation is a measure of. So there is a risk or no risk? Risk. Therefore, how can you use risk-free rates? Is the next subjected question. Okay, KEO should not use. I agree. But how can you justify that risk-free rates has to be used? Understood or not? Tell me, what is the value of a call? I will ask you till the end of this class. What is the value of a call? Spot price minus present value of strike price. Both are shares. They are already discounted at higher rate or lower rate. 18 or 20 or 16 or 17 it will be higher rate or lower rate. Difference between those two values is the value of. That means that the difference amount also already subjected to KE or not. Therefore, we should not rediscounting it at. So we should discount it at a lesser rate. Some rate we need to discount. People said discount using RF. Okay, then question started. RF okay, but why? Justification. RF can be used, sir, for example, I purchased a Government of India bond. Purchased a Government of India bond, 5% bond. 5%, 5%, 5%, 5%, 5%. Every year how much I will get? 5 rupees I will get on 100. Total will be 5 years, 5 rupees. How much? 25. Average? Average. 5 minus 5? 5 minus 5, 5 minus 5, 5 minus 5, last 5 minus 5, x minus x bar whole square, standard deviation, riskier, risk free. Now I can use risk free rates to discount the Government of India bond because cash flows are certain. Option cash flows are certain or uncertain. Then how can you use the risk free rates? Is the next question. There is a paradox, means there is a confusion, dilemma is there. Economists waited for years together. Someone has to come to give a reply for this. Okay. So at that time, please listen, at that time, one person is there. He has given answer through his model called as binomial model. Okay. And that subordinate person is also there. He is called as Hull. Hull. A person has given a thesis for the entire derivative segment. So he has written a book on Hull derivatives. So there he has given the answers for all kinds of questions on derivatives. Suggested recommended reading at CFA level 2. So the particular booklet, they have said every inch about the concept called as options and futures. In the derivatives market, how the behavior will be. How these concepts are made up. What is this binomial? Why RF will be used? So because he only modeled the theory, he only has written the book on that. His name is called as a Hull derivatives. You will find the book online as well. Hull derivatives. So what happened is, listen, they said this way. Option cash flows are certain, uncertain. Everyone? Uncertain. Option cash flows are uncertain. Since option cash flows are uncertain, can we use RF rate onto the uncertain cash flows? Sir, when you can use RF? If the cash flows are certain, uncertain. But option cash flows, already we have seen one example. 30, 20, 10, all these are guaranteed, unguaranteed. Probability only, it's not guaranteed. Risky or risk free? Then how can you use risk free rates is a question. They were caught in a paradox. Later they answered this way. One person came forward and given an answer through his model called as binomial model. What he said is, you can't value option independently because option cash flows are not coming directly because of that option. Option value will be derived from the value of the underlying asset. Now you can only see the question and try to answer. What is AP? First case, what is AP? 130. What is SP? Everyone. AP is the value of A. SP is also a value of A. Difference A become the value of a call or not? Therefore, the option is a derivative. Again proved. On the options table, we can prove that it's a derivative instrument. Clear or not, everyone? Now tell me, this become 30 because of itself, because of the behavior change in the share. How much I entered into the options market and locked myself, but the price went to answer. That means 30 came because of the option, because of the share. Answer, share. That means one thing they got. Options don't get values on its own. It derives from the value of the underlying asset called as a share. Therefore, no one in the world can value options independently. We need to take a share and an option. You have to merge both of them. Listening? Take, not answering. Take, share. Take, make a. Sir, when option share includes together, what will happen? Both will create what? First tell me, what is the first hand? Share. Next hand, can option handle the cash flows independently? Can option get its value on its own? It is dependent on what? Therefore, one conclusion Hull has drawn. That conclusion is you can't value option separately without a share. Therefore, he said, take a, prepare a portfolio, prepare a, value this portfolio first. Value the, from this remove the value of share. What remains is the value of an option. Are you understanding or not? Tell me, take, create what? First value the, after that from this remove what? What will be the balance is called as a, that's how they started developing the models. First point everyone understood. In this procedure, how the steps have been developed by Hull. In this particular scenario, let us see in detail. First, read the steps once again. First one, I think you might have slowly getting some hints about the model now. Read, create. Risk-free portfolio consisting of write a call and hold delta shares. But those answers I will tell you. Delta, all these things. Next, delta shares, future value, present value, all these things I will explain. Now, small hint to call share. Understood or not, everyone? We can't value option independently. There is no independent valuation for option. You have to merge what? Prepare a, value the, and in that remove the value of, then they will get the value of. That's how they started developing models. You understood the point or not? So, first, now slowly everyone is understanding why these steps came, at least slowly. So, that's how they started developing the models. So, they first have taken the share. Then, option. What will be prepared? First, what you have to do? Bring it to, from that remove the value of, what remains is the value of call. That's how they started developing this binomial model. Okay. So first, this is first point that everyone has to understand. Let's continue and further modify this. Now listen carefully. So this is the question that they have given and this is the answer. Now what we will do is we will take one question. Let us solve as per the steps. Okay. Don't ask any question at the time. Once I complete everything, I will explain each and every point inside it. Shall we start? Take the info. Options is given in the material, right? Okay. Take some good problems. Question number, option valuation models na come to 21. Take question number 21. Take question number 21. From here, hey, listen here. These two are two different questions in exam. I kept it as a single question. Both are 2 6 marks questions. This was a 4 marks question. This is a 8 marks question. This is a 8 marks question. This was a 5 marks question. All questions given in examination 1 or 2 times. Important questions don't leave. Okay. Even if I am not telling any one question in the crash batch, you do that later. Okay. Don't leave these questions. Model will be repeated as it is with the change in numbers. So, okay. First, let us take question number 21. La A, B, 2 bits are then take B. Take B. A I will give you. You will do in the class. Okay. First, let us do B. Okay. Now, first, what is the step 1? Sir, answer. One second. Tell me. Create a no. Consisting of. First theory point we have to write. Consisting of. Write a call. So some people are waiting till I write. Sir, you need not wait for my command. You are not Salman Khan, I am not Chiranjeevi. Wait for my command. You can write. Ana Garu. Right. So, write down. So, write down. You need not wait for my command. Write down. So, tell me, what is the step number 1? Risk-free portfolio consisting of dash dash. Very good. Next step. Next step. Calculation of delta shares. Easy method I will tell you. Remember this table. Logic I will tell once you write. First SP. Write down. AP. Action by call holder. Value to call holder. Tell me, we are writing a call or holding a call? Why not holding? I will tell. We are holding share or delta share. Why not a share? I will tell. Write down one by one. Copy down. First, how many chances are there? 90 and 150 na, 90 or 150 na, 92 150 na? One chance or two chances are? Biya, unia. That's why it's called a binomial, two numbers. Oh. Sir, can I write 90 and 150 na, 150 and 90 na? Anything is okay na? Yes, first. Why, sir? I will tell. Why? Everything has a reason. I will tell. Tell me what is a SP? 100, 100. Tell me. 100 to 115. Call holder will exercise a lapse. Exercise or lapse. Exercise. Second. Lapse. Tell me. If he exercise, tell me, he will have an option to buy a share which is available in the market at 115 only at. Immediately he can sell in the market at. Therefore, he will get an eventual gain of. On the other hand, writer has to go and buy in the market at. Answer. And sell to him at. What is a loss to him? That's all. Write down. Minus 15. Minus 15. Sir, please. No noise, please. Sir, if you lapse, the value of the call will be 0. Writer value will be 0. Tell me. Minus 15 if the AP is 115. 0 if the AP is 90. So what is the change? 15. Change in the value of call is how much? 15. For a change in the value of share at how much? 25. Sir, I am only doing everything. You tell sir, why you are sitting silent? Now answer my question clearly. How much is the call value change? Because of the change in the share value of? Answer. Write down. Delta shares is equal to change in the call by change in the share. How much? 15 by 25 equal to 0.6:1. This is called as hedge ratio in derivative Greeks. Derivative Greeks, they call this as hedge ratio, also called as a perfect hedge. I think I told you this when I told you futures. Okay, sir, listen. You may think unnecessarily I am telling about this perfect hedge, etc. This question was asked in May 2015. Examination 8 marks question. See this. Okay, so you can believe me, sir. Unnecessarily I am not telling anything. If something is required, I will take time and explain. But unnecessary, if that is not applicable for exam, I don't even touch it. So, point number 1, tell me, what is this called as? Hedge ratio. Other name? Perfect hedge. Other name is perfect hedge. Shall we continue? Okay. Next, step 1, step 2 over. What is the step 3? Calculation of future value of portfolio. Don't ask meanings, first copy. Tell. First point, I will ask you a question, answer. I am having a caller, I am having a share, delta share, I am having both. Answer. Okay, first write down. AP, delta, AP into delta, call writing value of a portfolio. Tell me, what is the AP? 2 chances. 115, 115, 90. What is the delta? 0.6, 0.6. 115 into 0.6. How much, sir? 60? 69. 90 into 0.6 is how much? 54. Okay. Go back to the previous table and tell me, when the AP is 115, what is the value of a call writer? So when AP is 115, what is the value of a call writer? Minus 15. 69 minus 15 equal to 54. Here the value is 0. 54 minus 0 is 54. Okay, up to here. Answers at everyone. Next, step 4. Don't ask any question, I will answer. What is the next step? Calculation of present value of portfolio. Calculation of present value of portfolio. Tell me, what is the present value of portfolio? How to calculate? Sir, this 54 is a value today na, after how many months? 6 months or 3 months? What is the period? 6 months or 3 months? 6 months. So this is the value of 54 is a value today na, after 6 months. Answer. I want which value? Present value. You can do in 2 ways. Exponential or normal discounting. When I teach, I will teach only exponential. Okay. In all classes, regular or fast track, anywhere, I will teach only exponential, which is more adequate in terms of derivatives. But still, sometimes institute will use a mixer. For classroom fastness, let us do with the normal discounting only. What is the interest rate given in the question? How much? And what is the tenure given there? 6 months. So calculate. 54 divided by 1.05. 51.43. 51.43. Shall I continue to the next one? Next, calculation of present value of delta share. Calculation of present value of delta share. First tell me, present value of delta share or future value of delta share? See the question, tell me what is the current price of a share. See there, 100. I am holding full share of delta share. Delta means how much? 0.6. Therefore, AP into delta present, how much? Rupees 60. Calculation of present value of delta shares. Rupees 60. Rupees 60. Sixth one. What is the sixth one? Value, call value. Call value. Tell me, in my portfolio, only share, only delta share is there, only call rating is there, both are there. Okay. Value of a portfolio equal to value of call plus value of share. Tell me, what is the present value of the portfolio? Already you calculated. 51.43. Next, what is the value of, what is the value of call? Missing figure. What is the value of a delta share? Answer, sir, 60. What is the value of a call? 60 minus 51.43. How much it has become? Rupees 8.57. This is the value of a call. 8.57. Huh? Minus? What minus? You are getting minus, huh? Minus say you should get. I will tell that also. Why? చాలా ఎక్సైట్ అయినట్టున్నారు. తప్పు చేశాడు ఈయన. అయిపోయింది తప్పు చేశాడు. నోట్ గ్రేట్ ఇన్వెన్షన్. వాడెవడో జపాన్ లేదా కనిపెట్టాడంట. సరే, ఓకే, కంప్లీటెడ్ రైటింగ్. That's all. This is called as which model? Binomial model. Without understanding the concept, if you do with the formula formats like this, it will be okay. So now listen, sir. Sir, everyone, can you mug up the formats now? Tell me, what is the step 1? Create a risk-free portfolio consisting of write a call, hold a delta share. Second step, delta share table same. SP, AP, action by call holder, value to call holder, value to call writer. Change in call value will be some number, share value some number. Okay, call by share value difference will be called as delta share. Clear, everyone? Now I will ask you one question, answer using the same model, everything. Can you do the previous one, A bit? Do that. After that, I will go into the logical interpretation of all these 7 steps. Then we will go into risk neutralization model, Black-Scholes. So make it fast, only 2 minutes. Please make it very fast. No one bothers about your writing. Make sure that you understood all the steps. Then we go into the interpretation of all the 7. Sir, everyone is doing the same mistake. SP is 97, not 100. So everyone doing 100. You also written 100. Yeah. Everyone. How much you have taken? 100. Madam, how much you have taken? ఇంకో మోడల్ చేసేసేయండి. Almost everyone, every bench full 100 you have taken. You have to take exercise price. SP means what? Strike price, exercise price. ఎందుకు క్యాలిక్యులేటర్తో దాస్తావు? అంటే క్యాలిక్యులేటర్ పెట్టేశాడు కరెక్ట్గా 98, 100 దగ్గర పెట్టాడు క్యాలిక్యులేటర్. రాంగ్ 97, 108, 11. Here 10. Delta 2 decimals. Delta 2 decimals enough. How much you got in the delta this time? Then take 3 decimals. Ideally it will give you an accurate answer. 0.6 అన్ని 1 లక్కర్లా 0.611 enough. So how much answer you got? No. That's correct. 7 point something. 7.7. How many of you completed either with correct answer or wrong answer? Sir, follow these 7 steps promptly and properly, you will get answer. If you do kirkiri with these steps, na gone. Institute follow these 7 steps promptly in its notes. Okay. Completed everyone? Okay. How much answer you got? 7.7. Okay. See here. Sir, listen. Point number 1. Have you followed all the 7 steps properly? If you follow all these 7 steps correctly, there is no chance of getting wrong answer. I will explain the meaning of all the 7 steps now. But you have to first follow them properly. Okay, ma? See here now. 1 second. See here. So the answer should be like this. See here. If you didn't get the answer. See here. 6.111:1. 55 and 55. I have taken E rates. Okay, small decimal differences will come. Ignore them. 53.37. How much you got here? 53.40. Small decimal difference will come. Nothing great. So 61.11. The calculation we should get 7.7. That last decimal change is tolerable, no problem, because I have taken exponential discounting. You might have taken a general discounting. Decimal difference will come, no problem. Up to here, everyone. Okay. Calculated or not, everyone? You check the answer where you have gone wrong. So totally how many steps? Technically in that 7, 6. First one is anyway theoretical step. 6 steps. If you follow all the 6 steps promptly, there is no question of getting a wrong answer. Yeah. Institute will follow. Shall we continue? Now listen. Each and every point that we have written there, I have an answer. See the screen once. Enough. See the screen. We have done this answer or not already? How much we got? Sorry, value of call. Ignore value of put. How much we got? 8.57. Because of exponential discounting, I got 8.64. Okay, ignore the difference. Small differences. Point number 1. See here, so many questions. Question number 1, sir, why we are creating a portfolio? Question 1. Creating a portfolio, okay, why we are creating with a write a call, why not hold a call? Sir, okay, sir, write a call, justify, na? Then why holding a share, delta share, why not a entire share? Yes or no, everyone? Okay, done. After that, what is this delta share? What is this 0.6:1? What we should call it? Next. Why future value of portfolio? Why 54 is 54 both the cases? What is going on here? Second one, why you are bringing into present? Why present value of delta shares? What is this meaning of negative number? So many questions are there or not? Every question has to be answered 10 minutes to 15 minutes max. I will give the answer for all the questions. Next 3 questions I will make you to do in the class. Exam questions, 6 marks, 8 marks, 5 marks. Clear? Now listen carefully. Logic of this particular discussion. First point. Enough, sir. Put your pens down. Nothing required. Don't write anything. Please see the screen. You may get these questions. I only have written the questions and answers also. See there. Notes on binomial model. What are the questions that I have to answer now? Please read. First one. Why to create a risk-free portfolio? Second one. Why to write a call and why not to hold? Next. Why to hold a delta share and why not a share? Next. What is the meaning of step 3 same values 54-54? Next. How can we prove that portfolio is risk-free? Why to calculate present value of portfolio in step 4? How to interpret negative VC in step 6? Why we use PCP, mean put call parity equation in step 8? That we didn't do because put call parity I didn't discuss with you. Okay, 7 steps we need to first interpret. Okay, I have given the full reasoning here, why and all these things, but in simple format from the crash batch point of view, I will first explain. Listen carefully, one by one. Start. Point number 1. We are valuing what? In these models, what we are valuing? Options we are valuing. Options valuation means we are valuing what? Premium. We are valuing what? Premium. Option will have its own cash flow or not? Option has individual independent cash flow, not dependent cash flow. Na? Answer. First tell me, what is the value of a call? Spot price minus present value of strike price. That will be called as a value of. That means value of call is just the difference between two share prices. Already share has subjected to discounting. At what rate? Again rediscounting the call option cash flows at KE will lead to a double discounting at a higher rate or not. Therefore, all the experts thought that we have to discount at a lower rate. Clear? First thing, everyone is confirmed that we should not use. We should not use. We should not use. Then what to use? YRF question arises. Option cash flows are stable or unstable? Answer. Option cash flows are not stable. We have seen the example. 30, 20, 10, 0, 0, 0, 0 we got. That means option cash flows are stable or unstable? That instability in the option cash flows have come because of option, because of a share. Therefore, they thought that we should not value options individually. We should merge them into a portfolio. Merge them into a. That portfolio, what you create, should be a risk-free portfolio. We will prove that later. Okay, risk-free portfolio. Value this portfolio first. From this, remove the value of share. What remains will be the value of a call option. That's the answer for first question. Why we create a risk-free portfolio? Theoretically, everyone understood. Second question. What is the second question to address? Why to write a call and why not to hold? See here. Tell me, we are valuing what option in binomial model? Put option or call option? Call option. Put option we don't value using binomial model. First we value what? Later which equation we will use? In the put call parity equation what we will put? Missing figures all we will put. The missing figure will be the value of a put. Clear everyone in the class? So put call parity equation will be used to value the put option. That means binomial model we don't do that. Binomial model values what? Okay, now tell me, value of a call means we are valuing the share value, we are valuing the premium. Everyone, premium will be collected by a holder or writer. That's why I write a call, because model has to be prepared from who charges the premium. Everyone understood? Second. So, second question also answered. Why not to hold and why only to write a call? Because the premiums are charged by whom? Writers. Premiums are charged by writers. Writers will charge a premium but not the holders. Therefore, the model has to be prepared from whose point of view? Writer point of view. That's how they started developing binomial model. So, this is written from whose angle? That's why in all cases writers will come. Okay. So, done. How many questions are answered as of now? 2. First 2 everyone understood. Next, what is the number 3? Why to hold a delta share and why not a share? See here. Tell me, from here some complication will come. Please listen, apply your brain. Point number 1. I will zoom in. Visible everyone? No answer. What is the SP? 100. What is the AP? What is the actual price? Numbers ready. Tell me, what is the AP? First case. When actual price is 115. Everyone, when actual price is, what is the value of a call writer? Actual price 115, value of a call writer. Plus or minus? Minus 15 is my value. Yes or no? If the actual price is not 115, but it is falling to 90, my value will be coming from minus 15 to 0. Minus 15 to, or I can interpret this way. Actual price is 90. Actual price is, call writer will have a loss or gain or no gain, no loss. Because of increase in price from 90 to 115, I am getting a loss of 15. Yes or no? I am getting a loss of 15 for every 1 rupee change in the share or for every 60 paisa change in share. Did you understand the point or not? Share changes by 1 time. Option is changing by equally 1 time, 0.6 times. That means I am correlated completely to the share. I am correlated 60%. Now listen carefully to the point. Listen. What is the change in the call? What is the change in call value? Answer. This 15 has come because of how much change in the share? Answer. Answer. That means for every 1 rupee change in the share, I am changing 100%. I am how many times sensitive to the share? 0.6. This is one part. So now listen carefully to the point. What they said is, what is this concept of delta shares? See here. Actual price is at how much? Answer. Then what is my wealth? If it decreases to 90, what is this? That means for 25 rupees change in the share value, my option value is changing by how much? Answer. That means, tell me, price of a share is at 90. I am having what value? 0 value. Now it increased to how much? 115. I got a loss. Yes or no? How much loss I got? How much loss I got? 15 rupees loss I got. Yes or no? Now listen carefully. This is more important. I will show you one example for this. I am taking one position, 2 positions. What are the 2 positions I have taken? One is a shareholder, another one is a call writer. Another one is a, I am holding full share, delta share. Sir, that leave off. I am a I am a shareholder and a call writer. Now I will ask you a question, answer properly. I will give you a news. You react with that news. Okay? A person said you that actual price of the share has increased. A person said you actual price of the share is decreased. Answer my question. You should only answer. A person gave you information. What information he gave you? Actual price is increased or decreased? Answer. Increase. Now tell me, you are a shareholder, call writer, both. Then use common sense and answer. You are also holding a share or not? I said prices of the share has increased. You will be happier, unhappier as a shareholder. As a shareholder, you will be happier, unhappier. You will be happy. So these are all Ananda Pushpalu. Okay. Now tell me, you are happier, unhappier? Answer. Now tell me. A person said you share prices have increased. As a shareholder you are? As a call writer, let us see. Tell me, 1 second. Actual prices are increasing on maturity date. A person said you. If actual price is increased, it is greater than SP or not? If AP is greater than SP, if AP is greater than SP, call holder, because I am a call writer, call writer cash flow will be dependent on call writer, call holder. When call holder will exercise? When the AP is more, then he will. Now tell me, price of the share increased, message came. I felt very happy. But at the same time, I remember that I am also a call writer. Are you understanding or not? So tell me, now tell me, AP, SP. Now the call holder, you are a call holder. You will buy at AP, you will exercise and buy at SP. Answer. Now tell me, increasing share prices in the market will make me unhappier, happier as a call writer? Answer. So, he's happier, unhappier? Answer. Very good. Now tell me. Now reverse the logic. I am a shareholder, call writer. Both. Okay. Decreased prices will make you happier, unhappier? Answer. What I will do? रो रहा हूं मैं. Next. After that, they said prices have fallen in the market. AP came to 60. Okay, now tell me, if AP comes to 60, this fellow will exercise and buy at 100, lapse and buy in the market. When he lapse, he buy in the market, he will die, I don't care. He will lapse, exercise. When he lapse, I don't get any loss. Then I will be very, very happy. Like that, he will also shout. So, happy. So, everyone first, see these pages now. So, answer to my question at the end. Understood the concept? Here the main concept will lie. When share price increases, I am laughing as a shareholder, crying as a call writer. When share price fall, I am crying as a shareholder, laughing as a call writer. My crying and laughing should offset each other. High crying, low laughing and high crying should not be there. High crying, low laughing, high laughing, low crying should not be there. My cry and laugh should offset with each other. I should be neutralized. That's why the model's name is risk neutralization. Are you understanding the concept or not, everyone? So therefore, I should not cry heavily. I should not be more happy. My cry and laughter should match. To match, I need not hold one full share. If I hold a delta share, then this will also become 15. Example, take calculator, 15 into 60%. 60.6. Sorry. 115. I'm very sorry. 115. I'm very sorry. I'm mistaken. How much? 69. 69. 90 into 0.6. 54. What is the difference? Exactly offsetting now. The gain in share price and the loss in call market will match each other, offset each other. Listening or not, everyone? This is called as a concept of which share? Share or delta share? That's how they started developing this model. So we need to calculate a share or delta share. Delta shares I have to hold, not a share. Okay, so tell me, to tackle the loss in the call writing market, I need to hold one full share. It is enough if I hold a delta share. It is enough if I hold a delta share. It matches together. It should neutralize my position. I should not more benefited. I should not be less benefited. I should be equalized. I should be neutralized. From there, they started naming also as risk neutralization model. That's why all the holders also will be risk neutral holders in derivatives. Next issue. So step 1, step 2 over. What are the questions I need to answer? First question. Sir, why to create a risk-free portfolio? Everyone understood? Next. Why to write a call? Why not to hold? Understood? Next. Why to hold a delta share and why not a share? Understood? Everyone? Next. What is the next question? What is the meaning of step 3 having a same value? Then we will see this. Tell me. In step 3, we are having a same value or not? As they said already, create. This portfolio should be, risky or risk free? देखो एक बार, बोर्ड के पास देखो. Tell me, last column 54 total. Doubt. Now meme starts. I should stand like this. 54 plus 54. 108. 108 by 2. 54 minus 54. 54 minus 54. 0 square. Root of 0 square by n. A standard deviation. Risky or risk free? That's what I am telling. So the portfolio is a risky portfolio, na risky free portfolio, na risk is gone. Any situation, share can be 115, share can be 90. My portfolio value will be 54. Clear or not, everyone? So this is a risky portfolio, na risk free portfolio, na. But I have to explain the table clearly. See the screen. Had I hold one full share on expiration date, my wealth could be 115 or 90. Yes or no? I am holding one full share, delta share. Therefore, my wealth will be delta times the share. Listening or not? I hold one full share on expiration date. What is the first possibility of a share price? Sir, on expiration date, how many possibilities are there? Number 1, 115. Number 2, 90. I hold one full share. How much my wealth is being? Share wealth. Answer, sir. 115. I am holding one full share, delta share. Sir, one fractional share you can't buy. You should understand this concept from lots. 1 lakh shares I bought. How many? Delta means you need not hold 1 lakh. You need to hold only 60,000 shares. Like that you need to understand the model. Model they made for 1 share. That does not mean really for 1 share you have to do this. Sir, options already I told you they are traded at lots or not. Then why they will allow in 1 share or 2 shares? So therefore, you should understand not one, their model for 1. You should understand in a bulk transaction. Sir, okay, anyway, tell me, had I hold only 1 share, what is my wealth? 1 share, had I hold only 1 share, what is my wealth? 115. I hold 1 share, delta share. Therefore, what is my wealth? I am only having a share, delta share, or I am also having a call writing. Because of that, I lost some value or not when 115 is a price. Therefore, what is my entire portfolio value? 54. Now, in this case, had I hold one full share, my wealth would be? I am holding one full share, delta share. What is my wealth? In this case, when 90, call writer value will be how much? That means across any situation, whether share price is 115 or 90, my portfolio value is 54. Means there is a deviation or no deviation. Standard deviation, no standard deviation. Variance or no variance. Risky or no risk. Risk free or risky. Can I discount them using risk free rates? That's what I am also telling. That's why options is risk free rates. Okay. So therefore, tell me, this is risk free portfolio, risky portfolio. Now tell me, sir, listen. 115 and 90 are prices today, na? Prices after 6 months. That means this 54 is a price value today, na? After 6 months. Gatiga. Everyone. Then I will ask you one question. Tell me. Correct. Answer correct. It will happen after 6 months. Options contract la, you can pay premium at the end. First you should pay premium and then enter. Upfront premium. Yes or no? That means premium I should calculate at present value or future value. Therefore, we are bringing everything to present. Because premium you have to collect to today. Understood the point or not? Okay? Now, so that's why we are calculating present value of portfolio. Listening everyone. In my portfolio, 2 things are there, 2 assets are there. Number 1, portfolio is here. We brought it to the present. Delta share is also there. We brought it to present. Present value of delta share is how much? Sir, today, what is the share price? See the question and tell. In the question it was given, sir, current price. How much? 100 is the price if I hold. I am holding 1 share, delta share. Therefore, what is the price of my delta share? How much? Okay, now tell me. Listen, this is one important point, observation. See here. Value of a portfolio equal to value of a call plus value of a share. Yes or no? Total portfolio, 2 things are there. One is a share, another one is a call. Yes or no? Now tell me. Value of a portfolio, already we got present value of portfolio. How much? 50. Just now we did now, sir. 50. 1.36. Sorry, in my exponential it came like that. Value of call we don't know. Value of a delta share, how much? 60. What is the value of call? 8.64. Okay, now this is really a negative number, yes or no? Really it is a negative number. But why we are not writing? Generally we have to write volatility equal to minus d by 1 plus value minus, you are writing like that. Here also you are not writing. In reality there should be minus, but meaning of that minus, there also I told you the meaning of minus by deriving it, dy by dx. In the madre derivation came na. Do you remember at least? Here not derivations are not there, but meaning is there. Let me explain that. Tell me, had I hold, listen to my words clearly. Had I hold only one delta share, what would be my wealth? Today only, sir, I am asking present value. Had I hold only a delta share, what would be my wealth? Very good. I am rounding it off. Clear? Now tell me. I am only holding a share, delta share. I am also writing a call. Writing a call means it is my obligation. Call holder's obligation I am taking. Technically, your loss I am covering or not, everyone? Yes or no? So now tell me, because of your obligation I am taking, my portfolio value has come to 51.36. I repeat once again. Had I hold only one delta share, what would be my wealth? Answer. But not just holding a call, but not just holding a delta share, because of writing a call, my wealth from 60 has eroded to 51.36 or not? That's because of whom? Because of whom, sir? Because of taking the obligation of whom? Call holder. That means this particular, first tell me, what is my wealth? What is my wealth? Wealth 60. Okay. What is the value of entire portfolio? Why 60 became 51.36? Because there is a call writing also inside it. What is also there? What is also there? 54 is the value or not? 54 is the value or not? That 54 came because of 69 minus 15. That means already what is deducted? You are not listening. See here. How much is the, one second. How much, see here. How much is the wealth? Because of taking your obligation, my wealth is reduced by how much? It came to how much? This present value is equal to how much? That means my 69 wealth has fall to 54 because of holding a delta share, because of writing a call. Answer. Writing a call means it is my problem. It is the loss covered for the holder. That means I am insuring whom? I am insuring whom? Against his loss. So, because of holding a call, because of writing a call and standing for you, I lost my wealth from 60 to 51.36 or not. The loss I incurred, I will ask you as a compensation in the form of a premium. Loss is negative. That's how they started developing this model. With this, binomial model has been completed. Understood or not, everyone? So these are the binomial model. Like this, another model, subordinates have also been prepared in the option valuation, and the next concept is called as a risk neutralization model. Everyone comfortable with the binomial model? Meaning, all the 7 steps has a meaning. These are the only authenticated 7 steps in the entire world regarding options valuation. You go any place in the world, there are no alternative steps for these 7, because the person who made it has written only 7. ఆయన book లో ఆయన స్వహస్తంతో రాసుకున్నాడు ఈ 7. There is no other concept of other than this. So because these 7 are written by that person in his book, that these are the 7 steps to calculate what? Value of a call. So everyone understood the concept clearly. Using this, let us do one past exam question 8 marks question is there. We will also do that. And then, sir, in your institute study material also this problem is there. Well, let us do. Finally, you check the answer there. Clear? 23. So let us see. Mr. Dayal is interested. We don't have that much time, so please, let's complete. Mr. Dayal is interested in purchasing equity shares of which company? ABC Limited, which are currently selling at 600. He expects that price of share may go up to 780 or may go down to 480 in how many months? 3 months. The chances of occurring of such variations is 60 and 40% respectively. A call option on the shares of ABC Limited can be exercised at the end of 3 months with a strike price of 630. What combination of a share and option should Mr. Dayal select if he wants a perfect hedge? What should be the value of option today? Risk-free rate is 10% per annum. What is the expected rate of return on the option? First 2 bits, can we do together or not, everyone? Let's do. Start. Step 1. You help me with the numbers, sir. Let us do together. What is the step 1? Write down clearly. What is the step 1? Sir, I think everyone understood how the numbers came. Logic of all the 7 steps, sir. So, do by knowing what we have to do. Start. Create portfolio. Create a risk-free portfolio consisting of write a call and hold a delta share. Write a call and hold a delta share. Shall we continue? Next, step 2. Calculation of delta shares. Now tell me the table. SP, AP, action by call holder, value to call holder, value to the call writer. What is the SP? First, 630. Sir, I am not seeing the question. I am believing in you. 630. Okay. AP. Highest one is 780. Lowest one 480. Okay. So, first situation, I will exercise a lapse. Exercise. Second situation, lapse. First situation, exercise na value 780 minus 630, 150. Minus 150, 0 and 0. So what is the value, change in value of call? 300, 150. And change in the value of share? 300. Now tell me, what is the answer for delta shares? Everyone, 150 divided by 300. Tell me how much? 0.5:1. This is called as perfect hedge. First question over. That's why he asked you in the question, what combination of share and option? What combination of share? 0.6 share for every one option value. 0.5, 0.5. Okay. 0.5 share for every option value. Hmm. 60%, 40%. It should not be adjusted now. Lastly, it will come. Not now, not now. You can do normal steps. Start. Next, step number 3. Do step number 3. No assistance. Start. Tell me. Value of future value or present value? Future value of portfolio. Tell me what are the headings? Yep. Sir, logically I said everything. First 2 times you have to mug up. Now that is also not required. Tell me. AP. I am holding full AP only delta na delta. So delta. Next AP into delta. This is one portfolio. This is one asset. Okay, I am holding only delta shares. I am also writing a call. Writing a call. So call writer value. Okay. Call writer value. Value of a portfolio. Tell me what is AP? 780, 480. Delta 0.5, 0.5. 780 0.5. 390, 240. Call rating minus 150, 0. 240, 240. Now tell me 240, 240 came. That means till then what you have done is correct or wrong? 100% correct. So in this model, if you go, that's why I tell you, go by the original model prepared. Mistakes you will not commit because the model will always step by step, they will only tell that you are doing correct. So how much? 240 and 240. Do step 4. What is step 4? Present value of portfolio. Tell me 240. How much is a rate given? 10%. 240, 10, 3 months, 10 into 3 by 12. How much? 1.025. Tell me. 240 divided by 1.025. How much? 234.15. 234.15. 234.15. Next, step 5. Present value of delta shares. Present value of delta shares. Tell me, what is the AP today spot? How much? Delta. Therefore, present value of delta shares equal to 300. Step 6. Value of a call. Tell me, what is the value of a call? Value of portfolio equal to value of a call plus value of a share. What is the value of a portfolio? 1.5 equal to what is the value of a call? We don't know. Plus what is the value of a share? Now you should explain. Had I hold only delta share, what is my wealth? Had I hold only a delta share, what is my wealth? Because of taking your obligation, my wealth decreased to that whatever I lost in my wealth, I will ask you in the form of a compensation, in the form of a premium. So 300 minus 234.15. How much it is? So value of a option, call option is 65.85. Everyone understood to here clearly? 65.85. Clear? Do you have any study material answer? Study material 65.85. That's all. You follow the original steps properly. Never you will commit mistakes. Sir, okay. Everyone, low. Answer not yet completed. What question we completed now? First question over. Second question over. Third question still he is asking. What is the third? Expected rate of. Then that expectation has a probability. Then your bit will come. That probability will come now. Expectation. Now listen carefully. I will explain. This one point alone we need to think and answer. Tell me, what is this expected rate of return? Answer, sir. Expected rate of return. Return on what? Option. Now listen. Expected rate of return on what? Option. See here. Everyone, expected rate of return on option. What is his expected rate of return on option? See here, sir. If I buy, listening, if a call holder has to buy, a share, two situations we are considering here. Yes or no? And now please assist me in telling this. What are the two APs possible? First one, 780, 480. Yes or no? Okay. Now tell me, if AP is 780, what is my SP? 630, 630. SP less than AP. I will exercise a lapse. Exercise here, lapse. What is the value? 150, 0. Yes or no? Now tell me. This 150 is the amount which I get as a call holding value. Yes or no? Guarantee, doubtful. This will come guarantee 150. That means this will have what? An amount of probability or not? What is the probability of occurrence? 0.6. Okay, here 4. Tell me. Value into probability. And the 90, 0. So what is the total probability? 90. So now listen carefully. Now, what is the value of a call option for a call holder? Tell me, how much is the value? I'm asking, what is the value to this call holder? How much value he will get across a weighted average? How much? In this, how much he should pay as a call writer's premium? 65 point. So tell me, what is the net value? 24.15. So take calculator. How much I would have invested at the beginning? Premium. Sir, what is my rate of return? Means return on investment. How much I invested? 65.85. How much I realized? 90. Clear? So 90, calculate, minus 65.85 whole divided by 65.85 into 100. How much is answer? How much? Percent. This is one way of representing this answer. There is an alternative also, I will show you. Okay. First, keep the heading calculation of rate of return. Two ways you can do. I will show you the both. My writing may not be good there. I will show you this. You copy from this. This is better. What is the problem number? 20? 3. 23. Yes, this one. Okay. Shall we continue? So see here, this is one way. I told you now we can do in another way also. This is another way. How I have done also, I will show you. Calculation of rate of return. So first do AP, SP, AP, action by call holder, value to call holder, probability, value into probability. This is one way of doing it. Shall we continue? Right now. SP. You should only tell how much. 630, 630. AP. 780, 480. Sorry, 480. 480. Action by call holder. Exercise a lapse. Exercise here. Lapse. What is my value? 150. What is my value here? 0. Tell me, this value is guaranteed or probable? What is the probability assigned? 0.6. Here 0.4. So what is the total? 90, 0. So what is the total value? 90. So this is the value that I get. Yes or no? Sir, it is a guaranteed value. Weighted average. Weighted average. How much is the weights? 0.6 and 0.4 are the weights. This is how I may get. Yes or no? That's why if you observe, he never make a mistake in asking questions. Expected, he also asked. He didn't ask calculate actual rate of return. He's asking to calculate what? Expected rate of return. Expectation will come out of probabilities. Clear or not? Tell me. If price is 780, what is my value? If price is 780, what is my value? If price is 480, what is my value? 0. So what is the weighted average? 90. Up to here, understood? So tell me, this is total realization. This is total realization. This came because of putting some premium or not. So write down. Return on investment equal to return divided by investment into 100. Return means total realization minus initial investment whole divided by initial investment into 100. Tell me what I totally realized. 90. Initially, how much premium I paid and entered into the market? 65.85. Whole divided by 65.85 into 100. Value please. 36.67%. So this is one way. Sir, I don't want to do in this way, means I will show you another model also. You can also follow that, no problem. Completed. Those who have the study material, you can see. Oh, same answer. 36.67. So you need not worry. The model, the structure, everything as it is, we can apply. You will get the answer. So therefore, how much is the rate of return? Everyone in the class answers 36.67. This is one way. Understood? Now listen. Already we calculated premium or not? Premium. You can insert a premium into the table and calculate. That is another way. See here, like this. Like what I did. In the notes, I have done that way only. Tell me. SP, AP, value, everything up to here, everything is same. Are you understanding or not? Premium also I have deducted here itself. Understood or not? 50 minus 65.92. Why I got 65.92? I use exponential compounding and discounting. So 84.808. Probability I applied. Directly I got here 24.08. Instead of taking 90 and all those things, directly here I got how much? 24.08. Directly 24.08 by 65.9 to 36.53%. You got 36.67 because of normal discounting. With this, completely we are done with the concept of binomial model. Sir, everyone confident with the answers? How to do binomial model? Everyone in the class? Okay. Next model is called as risk neutralization model. Please, everyone listen. Like binomial risk neutralization model also, there are 3 steps. First we will write, we will do. After that, logics. Shall we do? Take question number. So we have completed 21. Now we have completed 23. Take question number 21. Take question number 21. B bit you take. We do the same for risk neutralization. B bit we do for risk neutralization. Understood? Sir, once you do it for risk neutralization model, you will also get a clarity. That concept is essentially the same. Now, write down step 1. Or else you do one thing. I will show you in the notes. First copy down the steps. That's better. Write down the steps. Steps in risk neutralization model. Like the previous concept, here also 3 steps are involved. In those 3 steps, if you do, never you will commit mistakes. Mine is guarantee. I will make you to do 3 problems now. With that, you will also get a clarity. 2 approaches are there in risk neutralization. One is a table approach, another one is a formula approach. You can follow anything in exam. Okay, shall we calculate? Okay. Take question number 21B. Write down. Step 1. Everyone write down. Step 1. Calculation of risk neutralized probabilities. 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 Okay, can I continue? Calculation of risk neutralized probabilities. Okay, write down. AP probability, AP into probability. Easy to understand, sir. Actual price. That actual price will happen today na in future. Sir. In future. Future is always probable, guaranteed. Therefore, we are applying probability to the actual prices. What we expect. So tell me, what is the price? 115, 90. Tell me, what is the probability? P, 1 minus P. Tell me, what is the answer? 115P, 90 minus 90P. Total them. Weighted average probability or risk neutralized probability. Tell me how much? 90 plus 25P. Yes, sir, no, everyone. 90 plus 25P. 90 plus 25P. Okay. First, do what I say, later logics. 90 plus 25P equal to, what is the spot price? Answer, 100 into compound it. So what is the rate given? 10% for how many months? 6 months. So 1.05. Meaning every logic I will tell you, you can believe me, like in the last problem. First you copy down. Now tell me, 90 plus 25P equal to 105. Tell me, 25P equal to? P equal to 0.6. 1 minus P equal to 0.4. Next step. Step 2. Calculation of value of call. Calculation of value of call. Answer. Write down the schedule. SP, AP, action by call holder, value to call holder. Action by put holder, value to put holder. Directly we can calculate also for puts here. Logics we will say later. First write down. We continue. Tell me, what is the columns? Strike price, actual price, action by call holder, value to call holder. Action by put holder, value to put holder. All these are guaranteed or probable? Probable. Probability into call holder value, probability into put holder value. Place is not sufficient. Strike it and write down again. More than that, what you can do? Okay, start. Tell me, what is SP? 100. AP. Fast. 115, 90. Action by call holder. Exercise. Lapse. Exercise means how much is the value? Plus 15, 0. Action by put holder. Lapse exercise. Lapse. Here it will exercise. Value to put holder will be 0. Here the value will be 10. Probability. You have given 115 probability is how much? P. 0.6. 0.4. So 0.6 into value to the call holder, you tell me. 9. Value to the put holder, 0. 4. Next, here, value to the call holder is 0. Value to the put holder is 4. 9 and 4. Value of call is 9. Value of the put is 4. Understood up to here? Though not understood, no problem. At least copied the table. Now tell me. Sir, all these are futuristic or present? We have to pay the premium today in future. Premium. Therefore, we have to bring all these into what? Present value. Step 3. Present value of call and put. Branch into two parts. Call, put. Present value of call means 9 by 1.05. Value please. 8.57. Next, 4 by 1.05. 3.81. So, if you can observe, 8.57 is answer even in the previous model. Answer is same. This is a risk neutralization model. But nothing you understood out of it. Just you put numbers mechanically. When you understand a model, mug up the model without understanding the logic, it look like this. Numbers will be there, but that dissatisfaction will always be existed. Why I am doing this? I don't know. Can you do? Maybe I can do. That may should become a confidence. So listen carefully. Let me explain what is this. See here. Listen, please. So the point is, step by step, let us do analysis also on this. How much time that has taken for options binomial? 10% we will complete this. Steps are very small, easy to understand. Please see there. Binomial is prepared. Okay. 18 years after, another person came out with this concept called as a risk neutralization model. The premise and the very platform of the concept is essentially the same. So, the ground with which binomial started with the same assumptions, they also started. Two prices are prevailing. Here also two prices are only there. You can observe. Yes or no? I will ask you a question, answer. What is the probability of occurrence of 115 price on maturity date? Did you understand my concept or not? What is the, less than everyone, what is the probability of occurrence of 115 value on maturity date? Point? Okay. What is the probability of occurrence of 90 on maturity date? Both are wrong answers. Listen. Sir, why sir? You only written. These are not mathematical probabilities. These are risk neutralized probabilities. Point number 1. These are not mathematical probabilities you see. These are risk neutralized probabilities. Sir, I will ask you a question. You have written exam. Not you, sorry. I don't take you as example in exams. So some person has written exam. Okay. I asked him, how much you will get in SFM? Okay. He said, sir, I will get, sorry, you only said. How much? Tathastu. Listen. I asked you, how much you are expecting in SFM? You said, sir, I expect 80 marks. I immediately asked, what is the probability of getting 80 or not getting 80? Okay, you are expecting 80. It's an expectation. But sometimes your probability may go correct or wrong. What is the probability that 80 will come? Then what you will tell? Sir, I am asking you, all of you, what is the probability of you writing correct answers in forex, derivatives, bonds, all these chapters in the next coming exam? Means before the class and after the class, the probability will increase or not? Answer, yeah. You will tell a probability. I asked you, what is the probability of you getting 80? You said probabilities are 60%, 70% or 80%, 90%. Like that you will take some percentages or not. Now, percentages are always assigned. Probabilities are always assigned. Probabilities will not be calculated. I asked you, what is the probability that you will get SFM exemption in SFMA? Please wait, sir, I will calculate and come. You will not tell. No fool will calculate probabilities. Probabilities are assigned, but here we calculated probability. Are you understanding or not? That means something is. That means something he want to tell, which we are not understanding. So he want to tell something. These are not probabilities. These are what? Risk neutralized probabilities. So listen carefully. See the screen once. What is the probability of occurrence of a price of 115 on maturity date? Not 60. It can be 10 or 2 or 1% or 5% or some percent may be there. This probability of 60 is what probability? Risk neutralized probability. P is not a probability. P is a risk neutralized. That is, that probability has no risk inside. Clear or not? Okay. See there. Please see the screen. Not yet completed. I am not done. So the point is, everyone please tell me, these two are actual prices today, actual prices on maturity data. Future or present? Answer, future. Okay. These are what? Probability of occurrence, risk neutralized probability of occurrence. Now tell me, when I multiply both of these, okay, what is the probability? Listening everyone. What is the probability of 115? Risk neutralized probability. What is the probability? P. What is the probability of 90? 1 minus P. Up to here, understood? That means there are two chances on maturity date. One is 115, another one is 90. One is 115, another one is okay. Now listen. On maturity date, we will get 115 or 90 as per our expectation, or 115 and 90. Answer, or 90 and 90. Why I am asking this is, in mathematics, probabilities concept is there. Yes or no? Okay. In that, there are two types of probability. One is called as a joint probability. Another one is called as a cumulative probability. One is called as a, second one, cumulative probability. Cumulative probability. Now tell me, on maturity date, 115 can occur, or what can occur? 90 can occur. Listening, what is the probability of both together? That means either 115 can come or 19 can come. Listening everyone. I want to know the cumulative probability of both of them. That means occurrence of either 115 or occurrence of either 90. If both of them are there, how much will be the cumulative probability? 90 plus 25p. 90 plus 25p takes into it 115, 90, both. Answer. Now listen, I will tell you one point. I took a die. I rolled it. What is the chance of getting 6 on this? 1 by 6. I took another die. Okay, I rolled it. I asked, what is the probability of getting 6 on this? Answer, sir. Now I ask you a question. I took a die. I rolled it. And I said, what is the probability of getting 1 6 either in this or in this? Did you understand what I said or not? Tell me what I said. I rolled a die. First die, how many dice I have? So don't think that I am teaching some probability to you. Please listen carefully, sir. Tell me, how many I have? 2 dice. First day I rolled. I asked you, how much should come? 6. 1 by 6. మాటలు లేవు, నిజంగా మాట్లాడుకోవడాలు లేవు. సో టెల్ మీ, 160 ఏంటి సార్, అసలు అడుగుతున్న క్వశ్చన్తో పని లేదా? సో టెల్ మీ, ఐ రోల్డ్ ఎ డై. వాట్ ఈస్ ద ఛాన్స్ ఆఫ్ గెటింగ్ 6? వాట్ ఈస్ ద ఛాన్స్? 1 by 6. I rolled a die. What is the chance of getting 6 on this. What is the answer? Now I said I rolled 2 dice. What is the chance of getting 1/6 either on this or either on this? Now it is enda or both 6 should come, any of the 6. What is the probability now? 1/6 plus 1/6. 1/6 plus, because the probability is very easy now. I rolled both dice and I said in both the dice 6 should come. 1/36. 1 by. From this, what you understand? Multiplication should be used for a joint probability and addition should be made for a cumulative probability. Here additions are made. Shall I tell you another twist? Portfolio management lo covariance ki joint probability. That's why x minus x bar into y minus y bar both should come. Are you understanding or not? Covariance formula is what? X bar into y minus y bar. Y into will be my y naught addition, because I want the relation of x security and y security both should jointly happen. Time constraint, I didn't touch portfolio. So in that they are having a joint probability. Both should appear together. Both should happen together. So therefore they multiply there. That's why x minus x bar plus y they don't make. X minus x bar plus y minus y bar, why we don't make? The question answer should be, sir, every concept, formula, everything should have some logic behind. X minus x bar into y minus y bar divided by n. Why it is not x minus x bar plus y minus y bar? Anduku. You can't add, because either this or this should not happen. Both the securities, when they come together into portfolio, jointly both of them, how they react. That's why whenever there is a joint probability, we will multiply. Here 115 and 90 will happen, either 150 or 90. Therefore this is R and R. Understood the point? We should add a multiplier. Add. Therefore we added both of them. Understood or not? This is rolling. I will show like this. This is rolling a die 1/6. This is rolling a die another 1/6. What is the cumulative probability of both of them? 1/6 plus 1/6. 115p plus 90 minus 90p. This is the answer. Everyone understood? Answer. Now tell me. This is happening. This 90 plus 25p will happen today, will happen today, in future. These two are today value, future values. Participates of 5 minutes, I will complete. Today's value, future value. Those are all future value. Therefore, now listen. What is this 100? Spot price. Yes sir, no. This is compounding. This is what? F equal to PV into 1 plus R whole power n. Formula idea na? What is this PV? How much PV? 100 into 1 plus R means how much? 1 plus 0.05. Yes or no? That means we have calculated what value? Everyone. Future value. This is today's value of future value. This is today value of future value. Today value. I repeat again. This is today value of future value. This is today value of future value. Very good. Tell me, what could be the price of the share in future? One chance is? One chance is? One chance is? 1 second. Answer again. One chance. One chance. That means both put together, the chance is how much? 90 plus 90, 25p. Cumulative probability of both of them. Yes or no? Now answer my question. What is the spot price? What is the spot price? What is the futures price? Don't tell number. What is the futures price? Spot compounded to. Spot compounded to is called as what price? 90 plus 25p is called as future price. 100 compounded to future is also called as. That means I can equate both of them or not? That's how we equated. But you should understand one point. What is the spot price? Huh? Okay. We made it to go to the future or not? When we are compounding, we are using risk-free rates or risky rate of percentage. RF other rates. That means the 105 will be risky 105, risk-free 105. Therefore, the probabilities you get also will become risk-free probabilities. Are you understanding the point or not, everyone? First, tell me, some people are not in this world. Please come back for your kind information. Shall I continue? Okay. Now listen. Point number 1. What is the first table? Calculation of risk neutral probabilities. Tell me what is the step 1, first part. First tell me. One second. Tell me. See there and tell. There are how many actual prices? How many actual prices, sir? 2 actual prices are there. What is the probability of occurrence of first one? Second one. Cumulatively. 90 plus 25p is a price of 150 or 90. Both jointly or cumulatively? Cumulatively, not jointly. Both cannot happen. This can happen or that can happen. Both together can happen this way. Okay, so 90 plus. This is a price of 150 or 90 or anything. Any of these two can happen on the today. The probability is 90 plus 25p. Clear or not, everyone? That is a future price or today's price. We can equate future price with another future price. What is the spot price of a share? Answer 100. Okay, 100 is a spot up future. What is the future value? Yesterday only F equal to S into E power T or F. We have done F equal to S into E power T or F. Okay, what is the S? E power T or F. Now we are taking normal value 1.05. How much value we got? 105. 105 is the risk-free 105, risky 105. With that, if you equate, the probabilities you get will become risky part probabilities, risk neutralizer probabilities. That's how the probabilities have been calculated. First point. Everyone understood the point clearly or not? Later we applied and calculated the value of the call and value of the put. Clear, everyone? With this, we have completed risk neutral model. Risk neutral model institute is not following this tabular approach. Some problems they are doing, some problems they are directly giving a formula. See here, I will tell you the formula. Please, everyone listen. You might have seen this formula already. If this is a formula. But there in the question, they will give R minus D. I have taken what? Exponential. They will take direct rate sometimes. Listening, everyone. Okay. Tell me, what is the formula? P equal to R minus D by U minus D. How this formula has been derived is the next question. Easy only. 1 minute, 5 minutes we will complete risk neutral problems also. Please see the screen. That's all. Your work is to see the screen. Please see there. P equal to, what is the rate? 1 point? 1.05 minus D means, listen, D means downward actual price by spot price. Take calculator. What is the downward actual price? 90. Divided by what is the spot price? How much? How much? 0.9. Very good. U means upward actual price divided by spot price. 1.15 minus what is the D? P equal to numerator 0.15 divided by 0.25. P equal to. That's all. Answer over. Over. This is the formula institute will use. To this model also I started analyzing derivation because they didn't give derivation in the study material. Thereafter again started reading books where it was said. That means is there anything to tell? But I came to know even without doing that, a hint was coming from the table only. Everyone please help me with this. Table approach, do you remember table? Table. Equation I have written 90 plus 25p equal to, please tell that. 90 plus equal to 100 into 1 point. Elaborate. How you got this 90 plus 25p? Sorry, answer sir. How you got 115p? 115p plus 90 minus 90p equal to 100 into R. This is R rate or not? I can write or not? Yes. Now tell me. Listen. 1 minute. Divide everything by spot price. LHS and RHS. Divide everything by spot price. How much is the spot price? 100 cancel or not? Yes. Answer here everyone. What will be remaining there? R. 100 and 100 will be cancelled or not? Yes. 1 second. 100. It's automation over action. 100 cancelled everyone. Now listen carefully. R will be remaining. Now tell me. This 1.15. This I call as U. This I call as what, sir? U. UP plus this I call as D. This I call as DP equal to R. UP minus DP plus D equal to R. Yes or no? UP minus DP equal to R minus D. Yes or no? Now take P as common. U minus D equal to R minus D. P equal to R minus D by U minus D. This is how the formula has been derived. That is the formula. So write down. Break for what? ఏమి మిగిలింది మీరు ఫిల్ చేసుకోండి. ఎస్ డౌన్వర్డ్ ఇది దేన్ని యుఆర్ One second. So you calculated P or not? Hello, answer. P equal to R minus D by U minus D. What do you mean by P? What do you mean by P? Probability of higher actual price. Andike always I will ask you to write higher ones in the first. నేను ఏం చేసిన లోక కళ్యాణానికి. So I asked you to write higher number first always. Because the P represents always higher actual price P. Probability of higher actual price. Everyone tell me, understood the concept clearly? Yeah? 2 problems you do and take a break. First, hey, promise on you, it will not take more than, first problem will take 3 minutes, the next problem will take 1 minute. Really 1 minute, totally how many minutes? 5, 5 nimisha. Will complete. Take question number. No, I couldn't listen anything. Question number 24, question number 22. If you don't do, you promised on yourself already. In 3 minutes you couldn't complete. Problem is with you. Okay, see there. Question number 22. The current market, please see there. The current market price of equity share of Pension Limited is 420. Within a period of 3 months, Maximum and minimum price is expected to be 500 and 400 respectively. If the risk rate 8%, what should be the value of a call option under risk neutral model when the strike price is 4.50? Here they have given E rates. E rate they have given. Then you consider the E rates directly. Start. Which model? P will be calculated through table or formula na? Formula. Use formula only. Sir, when you use the formula, E power TRF you need to calculate. Don't write R. It should be written as E power TRF minus D. Because they have given exponential discounting. Hello, what is the answer? Point? Maybe. Study material, the question is there. If you want, you can check the answer. Here, this is the answer. They asked only value of a call. Okay, sir. So completed, huh? Hello, completed. If you completed doing it, please solve question number 24. See there, question 24 is dead easy, but let's read question first. Small question. Sumana wanted to buy the shares of EIL, which has a range of 411 to 592. A month later, present price of the share is 421. Her broker informs her that share broker. Eh? Ay, wow. I'm going. Namaste. So listen. So Sumana wanted to buy the shares of EIL, which has a range of 411 to first point number 1. There is a fundamental mistake in the question. You know what it is? 411 to 592 model does not work. But they have given like that only. And they have answered using risk neutralization model. Institute will copy and paste. I like it actually. But when they copy and paste, there might be a printing mistake. There, from where they copied, there might be some printing mistake. By mistake, what would have printed there? 2 is printed. What they have to do? They have to at least make it R. What the bro? ఇప్పుడు అది మారిస్తే ఆన్సర్ మార్చాలా రాదు అది. So therefore they as it is given, sir, okay, if it is given in study material somewhere, okay, exam directly given, understanding or not? And it was given in my exam only, May 2012. That's why with that much exact I opened the question paper, I found this, I didn't write this, I left for choice because I didn't understand this question. It is written as 411 to 592. I thought 411 to 592 means range of prices. It is not 2 prices. For this, I don't have a model. I thought that I didn't prepare this model. So, exam over, suggested answers came. You open suggested answer. R minus D by U minus D. This is right, this is wrong, no? No, this is right. Then I came to know, okay, printing mistake is there. So just because of the printing mistake, I didn't write that answer or not. Who is responsible? I got 74. If I would have written that, I would have got 82 or not. So Sumana, so Sumana wanted to buy shares of EIL, which has a range of 411 to or 411 or either this or this. A month later, the price per share is 421. Her broker informs her that price of the share can soar up to 522 within a month or so that she should buy a 1 month call of EIL. In order to be prudent in buying the call, the share price should be more than or at least rupees 522, the assurance of which could not be given by her broker. Though she understands the uncertainty of the market, she wants to know the probability of attaining the share price 592 so that buying of a 1 month call of EIL at the execution price of 522 is justified. Advise her take risk-free rate as 3.6. Again, they have given exponential rate, say e power 0.036 as 1.037. Sir, what we have to calculate in this? That's all. Nothing required. Only P calculation we have to do. And moreover, if you see here, tell me, I will ask you some information, give that. What is the present price of the share? Spot. Very good. Next, what is the probabilities that are possible? It can be 592. It can be 411. Okay, it can be 411. Now, she want to know the probability of both, probability of attaining 592. 592 is a P, 1 minus P. What is the formula? E power TRF minus D divided by U minus D. Can we do or not? Please do that. Point 13, 14. Okay. That's all. So with this, we have completed the risk neutralization model also. These are the two types of models. Sir, once after this, another one model, small models are there. We will discuss after the break and we will go directly to the mutual funds and mergers. Meanwhile, in the gaps, I will also do the currency options and futures, as I already promised that. Important chapter from the exams point of view, 8 marks. Okay. Please take a break and come soon. Last model for the options. Name of the concept is Black-Scholes model. So what is this concept of a Black-Scholes model? Let us try to understand clearly. Spot price, strike price, risk-free rate, term and volatility. 5 factors are given here. Shall we start, everyone? Shall I continue? Look here. Black-Scholes model, factors affecting the call and put options. First, so see here. Shall we continue? So completed. Shall I continue? Listen now. So factors affecting the call option and the put option values. So what factors will impact call options and put options values is a question. Okay. See there. There are 5 factors that affect the call and put option values. See the screen. One is a spot price. Another one is a strike price. Another one is a risk-free rate. Next one is a term. And last one will be the volatility. Question arises. What are these 5 things? Why we are first reading this? Because entire formula of Black-Scholes is dependent on these 5 ways. These 5 factors will decide. Okay. First, one by one, let us see. Sir, I am not going to make you to understand the entire formula, which takes around 2-3 hours of time in regular class to explain the formula derivation. I don't waste time. Small derivations means I can tell. Big derivations taking hours together, I can't spend time. I will only tell you how to do in exam point of view. Clear? Only this model alone. Okay? Let us see the screen. First, how many factors will affect the call option and put option values? Everyone. 5. Number 1, spot. Sir, very important theory question. Tell me, what is the first one? Spot price, strike price, risk-free interest rate, term, and volatility. These are the 5 factors which affects call and put option values. Okay. Now listen first. Later you can copy or you can do anything with that. First listen. First, what is the first factor that affects the value of a call and put? Okay, tell me, what is the value of a call? Spot price minus present value of strike price. Everyone tell me, spot price minus present value of strike price. Okay, now, spot price minus present value of strike price is the value of a call option or not? Now listen carefully. So, more the spot value, more will be the value of a call. So this is 100, this is 80. Let us take 80, 100 minus 80. Now this increased value of call will answer increase. It decrease value of call will. That means Tell me now, directly proportional, indirectly proportional. That means increase in spot. What will happen? Whenever, simply, I will tell like this. First, one second. Higher spot price will lead to higher call option or lower call option. Very good. Lower spot price will lead to the lower. Same reverse. Tell me, what is the value of a put? Present value of strike price minus spot price. Present value of strike price minus. Say for example, this is 90. This is 90. Okay, now answer my question. Spot price is 80. How much is the answer? 10. Spot price is 70. How much is the value? 20. Listening. Tell me, lower the spot price, higher the put value. Continue. Higher the spot price, lower the put value. So tell me, now you should see this diagram. Lower the spot price, lower will be the call price. Higher the spot price, higher will be the call price. Lower the spot price, higher will be the put price. Higher the spot price, lower will be the put price. This is a first impact that we have to understand. Everyone understood or not? Up to here, everyone had a clarity, yeah? So what is the first thing that impacts the value of a call? Answer, spot price. Another way of understanding this. See here. What is the value of a call? Spot price minus present value of strike price. See here. How to understand this? From the point of view of a hedger also we can explain this. Hedger point of view also you can explain. I said you, hedger will first make a short sell. Make a short sell when? When he make a short sell? Today na? In future. Very good. In future what he will do? Buy and sell. What he will sell? Buy and return back the share. Return back the share to whom? Kada? Now tell me. In spot, what he will do? Answer. Okay. Now, spot, I will make a sella buyer. Answer. Very good. SP la, I will buy a sella. At strike price, I will buy or sell. Why? To close the short position created. Are you understanding or not? Tell me, at spot what I did? At spot what I did? At strike price what I did? Sell minus buy is the value of call, yes or no? More the sell, that's how the spot price will influence the call prices. Are you understanding or not? So sale price should be more to order to get the more call value or not. So higher the spot price, higher the call value, because the spot price will always represent, okay, selling price in case of call option, because as a hedger you take a short sell position there. Do you understand what I said? Now tell me for the put option. Present value of strike price minus spot price. Tell me now. Tell me. First tell me. One second. First, put holder will have an option to sell in future or buy in future. Future la. Sell la buy. Okay, now answer. That means first you need to buy in the spot or not? Buy in the spot. At SP you will sell. Clear or not everyone? At SP, sell. First you have to buy. Here if you observe the entire scenario, I have to sell at SP and I have to buy at spot or not. So how much higher this will be, that much lower this will be. Higher the spot price, lower the put price. Did you now understand? So now tell me, relationship between spot price and call price. Direct. Relation between spot price and put price. Very good. Everyone understood the first factor? Factor 1 over. What is the second factor? Strike price. Reverse case. Nothing to discuss. Regular class I can discuss also on this for time together. But as of now, everyone understood the logic clearly. I'm going to the third one. What is the third one? RF and term. Two things are there. I will discuss both put together. Okay. Because RF can't be there without term. RF cannot be there without the term. Okay, now listen carefully. So listen, whenever I tell risk-free rate represents the interest cost, yes or no? So listen, observation required. Whenever I tell about a risk-free rate in this entire chapter, the risk-free rates are so important because they decides the PV of SP. They decide the PV of SP. PV of SP will be decided by that. Okay, I will explain this way. For example, whenever I enter into a call option, whenever I enter into a call option, I will make the outflow payment today na in future. I will tell like this. Again, answer. Whenever I select call option, I will buy today na, I will buy in future. Call option holder, I will buy the share in future, sell the share in future. I will buy today na, in future. Answer. Okay, in future. Now tell me, my outflow will be incurred today na, in future. Very good. Now tell me, today I need not buy anything, yes or no? Long the duration. Okay, long the duration. Long period will be my interest cost is saved. I will repeat. Sir, I will compare and tell. Maybe after that you can understand. Put option holder has to sell the share, buy the share. Put option holder in future has to sell or buy. Call option holder has to buy. Call option holder will buy today and buy in future. Put option holder will buy today and buy in future. Buy or sell? Sell. Tell me, call option holder in future. Put option holder in future. That means in order to sell, I need to first buy the share or not as a put holder. That means my holding period, let us say it is 6 months. I have to buy a share and put with me or not. All that is a loss for me or not. For 6 months, there is an opportunity cost on the outflow that I made today or not. Now tell me, in a call option, outflow comes today na, in future. Answer. In a put option, outflow will come today, inflow will come in the future. Did you understand? Now tell me. Sir, I will give you an example. Okay, suddenly one example came in mind. I will first tell that. Sir, I said you like this. I will give you an option to buy SFM classes at same 8,000 rupees even after 3 years, I said. Even after 3 years. I repeat, I gave you an option. You can buy the SFM classes at same regular classes at same 8,000 with books even after 3 years at the same rate. Sir, even after 3 years, SFM classes will be traded at same 8,000 will increase. Definitely it will tend to increase due to various factors. Maybe it become 9,000. But I said that I will give, listening, I said that I will give you only at 8,000. An option was given. Clear? Now tell me, you have an option to sell a buy. Sell a buy. Buy. Now answer my question. Today, what is the price? 8,000. 1 year after, 9,000, but you have an option to buy it. Next year after that, it became 10,000, but you have an option to buy only at. Now tell me, as term is passing by, your option is getting more value or lesser value? All options gain value because of term. Long the term, long will be your coverage. Understanding or not? So long duration is there. Now call option will gain more value. Tell me, put option. Put option you will sell a buy. Answer. Sell. 1 year after, you have to sell at 8,000. 2 years after, so you have to sell at 8,000 means you are having a loss or not. Therefore, longer the duration, lesser will be the advantage in the put option. Or you understand the differences or not, everyone? So tell me, what the same thing also happen with the rates of interest. Also happen with the rate of interest. So therefore, try to understand rate of interest and the term. Tell me, longer the duration, higher the value of a call. Next, Lower the duration, lower the value of a call. Yeah. Next, put option. Higher the duration, lower the put option, because long term after only I can sell. My inflow will come at a long term. If I would have got today itself that inflow, I would have invested or not. That means I am postponing my RF for another 1 year or not, which reduces it. So tell me, how the term and interest rates are going to impact. Please see there. First, low RF and low term, call option. See there, sir. This and this I said. Lower term, lower RF, call option will have lesser value. Lower the term, call option will have lesser value. Higher the term, higher the call value. Directly proportional to that. Listening or not, everyone? Put option will have a reverse format. Clear? First four, you please see the screen and observe and try to understand that first. Very, very important theory question. Completed? Shall I continue, everyone? Last one. What is the last one? Volatility. So see here, lower the volatility, lower the call price, lower the put price as well. Both. Sir, always, please, listen. Sir, you require a call option and put option for more fluctuating shares or government securities. Sir, government security today price is 100. After 5 months, 100. After 10 months, 100. After 2 years, is there any fluctuation? Then why do you enter into options market? Option market, when you will enter, when the volatility, the fluctuation, the movement of the prices up and down is very higher, very lower. Higher the fluctuations happening, greater the value of that particular dog. Clear or not, everyone? So whenever you are having higher upward movements or downward movements are there, then there is a chance. Therefore, people will enter into the call option, put option. Sir, I will tell you an example, you understand. AP is a movement price, yes or no? It will move up and down or not? एक बात देखो screen. Have you seen the screen? Middle one line is there. What is that? Strike price, because it is constant. It don't change. Yes or no, everyone? Green, red are what are those? Green, red are actual prices. Green, red are actual prices. Okay, I have taken one Bollinger Band chart to explain you. See there. So price movement started. Look at there. Price movement started. This is actual price. These are all what prices are? Actual price. Say I have taken a call option. Which option I have taken? Call option. Okay. Now, please see the screen and dial. When the actual price is increasing. Actual price is increasing. So tell me now. I am a speculator. I am a speculator. Now you should only answer me. I paid some 10 rupees premium on a share. 100 rupees is the SP. 100 rupees is SP. Now actual price increased to 120. Increased to, I will get a gain or not? Because a share which is available in the market at 120, I can buy only at 100. Immediately I can sell at 120 also. Answer. So therefore I will get a gain or not? Yes. It went up to 130. It went up to 140. It went up to 160. Again fall to 130. Again fall to 120. Again came to 100. Came to 60. Like this price can fall or not, everyone? So tell me, when it comes to 50, I will get a gain or loss? I will not, because when it comes below this line, I will lapse. Are you understanding the concept or not? What will be the only loss for me? Premium is the only loss for me. Maximum loss is premium. Listening or not? So tell me, higher the volatility, higher the profits. Lower the volatility, lower will be the profits. Clear or not? So tell me now, higher the volatility of the stock. What is that? Higher the volatility of the stock. Automatically what will happen? Higher volatility, higher values will come for both call and put options. Clear or not, everyone? A last conclusion. Tell me, higher the volatility, higher the value. Call or put. This is same for both because both are options. High volatility stocks will have high values. Clear or not, everyone? A person aged 22 years is taking an insurance premium. A person aged 40 years is taking insurance premium. Who is more prone to death, nearing to death? It doesn't mean that he will die, but when insurance company commercially think about it, who is more volatile to death, their premiums are more. Hope you understood the concept clearly. Likewise, same thing happens also here. More the volatility, more the value of the premiums of call and put. Everyone understood? But one last conclusive point, try to understand. Sir, in all the problems you see, any problem you take, call values are always higher than put values. Premium on call will be generally more than premium on put. There is a reason for that. In original life also there is a reason. Listen carefully, tell me. Call holder will get a profit if AP is greater than SPA, less than SPA. Sir, think and answer. Last question I am asking. Call holder will get a profit if AP is greater than SPA, less than SPA. Greater or lesser? Greater. Tell me. SP 100, AP 110. How much is my profit? 120? 200? That means higher it can go to infinity also. Yes or no? That means my profit bandwidth is limited or unlimited? Answer. Very good. Like that. Put holder will get profit if the AP is less than SPA, more than. Answer. 100, 90. Answer. 80, 70, 50, 40, 30, 20. Answer. 10, 0. Can I go below? That means the bandwidth is limited or unlimited for a put option. Therefore, put option values are always lesser than call options. Because the advantage put will give is comparatively less when you compare with the call options. For that reason, it will be like that. Hope you understood the concept. So here, with this, some formula has been given. These are the formula for what? Black-Scholes model. So these are 11 steps to calculate. Logics all aside because it takes lot of time. I can't spend so much time on this. These are all the formulae that have been given. So step number 1. What is the step number 1? Natural log value of S by SP. What is S by SP? Spot price by strike price. S by SP. Spot price by strike price. Next one. What is the next one? D1. What value, sir? D1 equal to, read, natural log value of S by SP. First step plus sigma square by 2. Sigma square by means average variance. What variance? Average variance plus risk-free rate into term. Term in years. Means if they given days, 240 days they give. 240 by 365. Like that we have to write. Okay. Next, whole divided by sigma into root T. Sigma into root T. Next, what is the next one? D2. D1 minus the denominator of D1. Logics all these aside. Don't ask now. It takes a lot of time to explain the derivation. We have to go directly into functions. So that takes a lot of time. I am not going to spare that much time now. Just remember all these steps. Never you will commit mistakes in Black-Scholes on the exam point of view. Step number 1. Natural log value of S by SP. Second step. D1. D1 equal to S by SP plus sigma square by 2 plus RF into T whole divided by sigma into root T. Next one. D2. D2 is what? D1 minus sigma into root T. Means simply D1 minus denominator of D1. Clear? Next, what is the step 4? Normal distribution table value of D1. Step 5, normal distribution table value of D2. Next, step number 6, ND1 0.5 plus or minus NTD1 0.5 plus or minus NTD2. Okay, sir, plus or minus he has given. Now we have to do plus or minus. It depends on the value of NTD1, NTD2. If NTD1 is positive, add. If NTD1 is negative, deduct. Clear or not, everyone? Next, e power minus TRF VC calculation has to be made. Okay, like this, if you see now, you don't get a clarity. Let us do one problem on this regard, such that you can also understand how to do this. Shall we start? Take question number. Take question number 26. Use Black-Scholes model for option valuation. Spot price, strike price, risk-free rate, term, volatility. Spot price, exercise price, risk-free rate, term and volatility. Sir, what are the 5 factors that affect the value of a call option and put option? Spot price, strike price, risk-free rate, term, volatility. 5 factors are given. That's what I want to tell. Clear? So that's why I explained first. So those 5 factors will affect call price, and those 5 factors are taken into the formula. Shall we do one by one? So slowly you do. After going home, na, take a problem, repeat the same steps on that. Okay, 1 or 2 problems you do not. From 3rd problem you will get a flow. I will explain you first problem now. Clear? Let's not waste time. 2. Step 1. Take it. Step 1. ln of S by SP. See the screen. ln of S by SP. ln of S by SP equal to ln of 50 by 49. ln of 50 by 49. This value they will only give. 1.0205 they will give in the question. They don't ask you to check that. They will only give 0.0198. Step 1 completed, everyone. Do step 2. First write the formula. When you are writing it, remember that. ln of S by SP plus sigma square by 2 plus RF into T whole divided by sigma into root T. Second formula have you written, everyone? Okay, apply that formula. Right. So don't just copy. Have you written the formula? First, ln of S by SP is how much? 0.0198. Sir, who gave 0.0198? Who gave that answer? Institute will give in the question. Clear or not? But listen carefully. They don't give ln of 1.0205 equal to 0.0198. Then every student will directly write the answer. They will give 5-6 ln rates. You have to select. Are you understanding or not? They give for 1.02, 06, 07, everything they will give. You have to select the right one. Clear, everyone? Okay. So next step. Sigma square. What is sigma? Given in the question already. Volatility. 0.3. Square divided by 2. RF also given 0.07. T means 200 by 365. completed. First two steps over everyone. Third step. Don't do fourth to fifth, etc. First, let us do together. Third step. D2, D1 minus denominator of D1. So D1 minus sigma into root T. Okay. Step 3 over everyone. Sir, at least say yes or no. 3 over step 3. 4, please don't do. First lesson. What is the next one? Fourth one? NT D1. What is NT D1? Normal table value of D1. Write down. NT D1. Like this, you need to present in exam. NT in the brackets 0.372. These values they will give. Range of values they will give in the table. Okay. Range of values they will give. So many students are asking me consistently, normally in my messages, etc. Sir, please tell me how to check the standard distribution table, normal distribution table, all those things. In the YouTube, tomorrow, day after tomorrow, I will make one video because they should know how to check the Z values. Z value directly given means people will write. Sometimes the tail and head numbers will be given. Gone. So tail and head numbers when given, how to check, I will tell you. Okay, there I will tell, just copy as of now. So NT D1 equal to NT into 0.3729, NT of 0.3729, 0.1443. From here you can copy, nothing great, just the values. So at the end, first everyone confirm me, what are the only two values which we need to know in this entire formula? One second. LN value institute will give or not? 100% they will directly give. Clear? Okay, done. Next, D1 key directly can we calculate or not? Yes. D2 can we directly calculate or not? Yes. What are the only two things we should rely on checking the Z values? That's all. That means not enough. NT D1, NT D2 are the only two values which we need to check the normal table values we have to check and we need to write there. Clear? Once you understood, once you got NTD1, NTD2, now ND1 is very easy, 0.5 plus or minus NTD1. Have you written up to ND2? Everyone, have you written up to ND2? Don't write step 9. I will explain the formula meaning. Up to step 8, everyone understood? Step 8. Up to step 8. Shall I continue? Tell me, what is the value of a call? Spot price. Everyone, spot price minus present value of strike price. Same here also. Spot minus, when you take SP into e power minus TRF, what it will become? Present value of strike price. ND1 and ND2 added in both sides. That's all. Write down. Spot into ND1. This is a new addition. Minus present value of strike price. Instead of doing present value of strike price, what he has shown? SP into e power minus TRF. When I take minus TRF, what it will become? Discounting or compounding? Discounting. Into ND2. So do the calculation work. So up to here, everyone copied. Up to here completed. Step 10, n minus d1, n minus d2. N minus d1, n minus d1 means how to calculate? 1 minus n d1. 1 minus n d2. Simply to tell probability of getting d1 is n d1. Probability of not getting d1 is called as n minus d1. That's why 1 minus 64.43% means how much is the probability of not achieving it? 35.57%. Did you understand the meaning or not? Like this we can analyze each and every number, but we don't have that much time to analyze this. So n minus d2 means the chance of not getting the n d2 is called as n minus d2. That's why 1 minus n d2. 44.04% or 0.4404. Sir, what is the value of a put option? Normally, present value of strike price into, present value of strike price minus spot price. Here what will be added? SP into e power minus TRF into n minus d2 minus n minus d. So completed the valuation of put option, everyone. You can check the answer. Purchasing power parity theory will be satisfied. Completed. So with this, all important concepts inside the options have also been completed. So main concepts I have covered. Small little arbitrary small concepts are still there, but from the exams point of view, what are important we have covered. So all the models of valuation understood clearly. Those are very important from the exams point of view. Now we are having 3 slots as per your selection. I will go. One is currency options and futures. Okay, selected. I will do 3 different types of problems in that. Do you want that to do or second one is mutual funds, the third one is mergers. I will do all the three now. Okay, selectively what are important models, I will connect those here. So which one do you want? Mutual fund, merger, currency options and futures? Anything is okay for me. How many of you go for currency options and futures? Then let's start. And these many people are scared for derivatives. Okay, see here. In the notes it is so what is the name of the concept, sir? Currency options and futures. One second, please see here. Currency options and currency futures. From the currency options and currency futures, I think in your material I have given the questions material separate. There you can see currency options and futures. I have given there. It is there, right? Not there. Can you please give me once? It is there, after futures. It's not there. Huh? One second. I think I didn't give there. So I will show you the question. Please look at here at least. Or, sir, everyone have the study mat with you? Study mat I will show you directly. Those problems I will do. You will also get a clarity. Please see the screen once. Sir, please. Okay. See here. Please. Here in study material 9.50 page, there is a question. Money market hedging, first question. 28th question in the study material. 28th question in the study mat. Okay. So money market hedging, do you know the procedure? How to do the money market hedging? What is the procedure? Anyone? When there is a one second, bro. Continue. When there is a payable, why? Why? Because of that, what they will get? Really? Next. Any other answer? You do that, okay? Procedure, okay. But why? Sir, yes. Due to interest rate. Why you are laughing? Okay, okay. Okay. Next, any other answer? Yes. నేను చెప్పింది నాకు చెప్పేశారు. నా క్లాస్లో నాకే చెప్పేశారు. నేనేం లేదండి బాబు. యాజ్ ఇట్ ఈస్ యూ రిపీటెడ్ మై లాంగ్వేజ్ నా. సరే లిసన్. Listen here. So the point is, sir, first generally people will do like this. Generally, they will first see whether there is a receivable or payable. I mean, an import or an export. Depending on that, predeterminedly they will prepare some steps in mind. Whenever we have a receivable, step 1, step 2, step 3, step 4, 4 steps la answer over. Without doing any step procedure, there is a best procedure to do the money market hedging with more practical intent inside it. I will first tell you the model. You will only understand whether this is more appealing and understandable or not. See the screen once. First tell me what model we are doing. Tell me first. Money market hedging. Hedging is a strategy of risk reduction, yes or no? Or loss reduction. Answer, yeah. Stop loss strategy, yes or no? Now listen. See the question. Through this question I will explain. An Indian exporting firm, Rohit and Brothers, would be covering itself against likely depreciation of pound sterling. The following data is given. Receivables, pounds 5 lakh, spot rate 56 per pound, payment date 3 months, 3 months interest rate, India 12% per annum, UK 5% per annum. What should the exporter do? We will do now 28 and 29. 28 is exporter with one-way quotation. 29 is importer with two-way quotation. Listening everyone. Shall we do both? Yes, we will do both. Such that two problems we do on money market hedging also. Sir, morning all the hedging strategies we have done or not? How many hedging strategies are still pending for us? 3. Number 1, money market hedge, currency options, currency futures. In currency options and futures law, what I will do is 2 currency options, 2 currency futures questions also I will do. From the study mat, sir. You need not doubt me. Randomly anything you pick and give me, I will do. Okay. So first point number 1. First we are going to do MMH, money market hedging. See here. Okay. Whenever money market hedging is given, I will give you a easy methodology to understand this. How many dabbas? 4 dabba. How many dabba? 4 dabba. In this 4 dabba, you fill numbers. Okay? తన్నుకుంటూ ఆన్సర్లు వస్తాయి. ఎలా వస్తాయి? తన్నుకుంటూ. సో లిజన్, ఎవరిని అనుకుంటే తెలుస్తుంది మీకు తర్వాత. సో లిజన్ కేర్ఫుల్లీ. See here. Listen. We call the first set this as future. These two top. These are present boxes. Spot, future. Tell me, Rohit and brothers example you take. See there. So don't do. I will first do and I will give time for you to copy. Tell me, spot rate, how much? Spot rate, spot rate. I'm very sorry. What is the payment date? Payment date. Okay, 3 months. Future is 3 months future. Today is month 0. Month 0. Now listen carefully. You can fill these 4 to get the answer. First answer my question clearly, one by one. Tell me. Future is, how many months of future in this question? 3 months. Okay. See there. An Indian exporting firm, Rohit and brothers, would be covering itself against the likely depreciation of a pound sterling. Receivables 5 lakh. Now tell me. First you should answer me. I am having, listening. This is foreign currency boxes. These two are home currency. Now please answer my question properly. Just I will ask you one question. Answer those. Tell me. I have written F and F, future. Yes or no? This and this are present boxes of future. Answer. This and this. Present. Spot. This and this. Spot. This and this. This and this. Very good. This and this. Foreign currency. This and this. This and this. Future. This and this and this. This and this. Everyone understand up to here? And now first tell me, I have a receivable after 3 months, payable after 3 months. See the question and tell, sir. Receivable. Okay, first. Receivable in rupees or dollars, or pounds. So tell me first, receivable or payable? Receivable. How many pounds? Pounds. 5 lakh. Now answer my question clearly. These pounds of 5 lakh creating a receivable, payable? Foreign currency, Indian currency? Asset or liability? It is creating a asset. First duty is create a corresponding liability. Create a reasons I will tell you. Every point has a reasoning. I will tell you later. First tell me, here there is a asset or liability. Asset or liability. Therefore what we have to create? I have to create liability here. So tell me, to create a liability here, I need to have a payable or receivable. So I need to take a payable. Payable will come because of borrowing a deposit. Therefore I have to first borrow. What I have to do? First tell me. First box. Receivable or payable? Receivable creates. Therefore I need to create corresponding. Liability is a receivable or payable? Payable means I need to deposit money. I need to borrow money. Now tell me. Borrow. Sir, tell me. You are borrowing today. Which box I am writing borrow? Spot or future? Today we are borrowing. Yes or no? I need to create any borrowing equal to 5 lakh pounds borrowing. Today if I borrow 5 lakh pounds, it will become more than 5 lakh. Therefore I need to borrow 5 lakh. Present value of 5 lakh. Borrow na deposit. UK na India na? UK rates you see and tell me. How much is a UK rate? 5%. So tell me everyone, I am writing here. Tell me. Pounds of 5 lakh divided by 1.0125. 5 lakh divided by 1.0125. How much? Borrow 4,93,827 pounds. This is called as present value of exposure. What exposure, sir? Present value of exposure. Now you should only answer me. Today I borrowed, I deposited. Borrow means I will get the dollar in my hand or not. Answer. Convert that into rupee. Convert that into rupee. Now, convert that into rupee. Conversion is made today, in future. That means spot rate or forward rate. Tell me what is the spot rate? 1 pound equal to rupees 50. Okay, convert this. 2 crore. So, now tell me. Okay, one answer you tell me. I am borrowing here or not? Here, I am borrowing or not? The borrowing amount I have converted into rupees. My receivable is today after 3 months. For that duration I will deposit here. So tell me what I have to do. Deposit rupees amount. 2 crore 76 lakh 54,000 312 okay na? For how many months? 3 months at the rate of 12% per annum. Up to here, understood? This deposit will sit silently. It will mature to a higher value. Tell me, maturity value of, tell me, deposit. How much it will be? 2 crore 76 lakh 54,312 into, what is the value of interest rate in India? How much percent? But we want for how many months? 3 by 12. How much? 1.03. Tell me. 2 crore 84 lakh 83,941. This is the answer. Now I will explain you the logic behind this particular money market hedging. With this, we have completed money market hedging problem number 1, but I will explain you the logic behind it. So please listen carefully. Just some small logics are involved here. If you understand this, no steps, nothing. Just you follow the procedure, you will get the answer. Listen carefully to the point. First one, I am having a receivable, payable. Today, in future, risky or not risky? Why risky in future? There may be fall in pound prices. Yes or no? Importer will fear for the hike in prices. Exporter will fear for the fall in prices. But anyway, fear is common among everyone. When fear will not be there? I repeat. Listen carefully. I receive everything in when? Today and future. Future key today, what is the difference? Today, whatever rate they tell, that rate will be stagnant. But future can be turbulent. Future la price will be same or different. When if I receive, no risk will be there. Again, start from the beginning. Listen carefully, don't commit mistakes. Understanding la no compromise. Point number 1. You are receiving 5 lakh pounds today after 3 months. Risky or not risky? Because that conversion value can be changing. Yes or no? When you receive, problem will not be there in spot. When you receive, problem will not be there. If you receive entire 5 lakh today in spot, will there be a risk or no risk? Then do that. Sir, I receive after 3 months. Therefore, borrow and convert. Therefore, observation required. How beautifully MMH models have been designed. You should only tell me. We are borrowing 4,93,827 today in future. Everyone, that money is converted into rupees today in future. That is deposited in India at a 12% rate for 3 months today in future. That will mature to 2 crore 84 lakh 83,941. That amount you will know today after 3 months. Today only you will know. That amount may come after 3 months, but 100% it will come. Sir, today I went to a bank. I gave 1 lakh deposit, 10% interest. Money may come in 1 year, but I know how much money I will get or not. That means today itself, I know whatever happens in future. That's called as hedging. I repeat. See here, point number 1. Original transaction I have done receivable or payable. Receivable or payable. Receivable today after 3 months. It creates an asset or liability. Corresponding what we created. This is liability, means I have to borrow or deposit. Borrow when? And I immediately converted that much amount into rupee. That means I will receive 5 lakh pounds today after 3 months. But because of borrowing and converting, almost 95% of the invoice value I am receiving today itself or not. You may ask, sir, you borrowed, you have a liability. This liability will be paid by the asset I receive after 3 months. 4,93,827 I borrowed today will mature to how much after 3 months? Answer. That 5 lakh I will pay today in future. Answer. At that time I need not worry because my receivable will be ready to pay this payable. Understood or not? What will be ready? Receivable will be ready to pay this payable. So I need to worry about forex fluctuations. I need not worry. Need not worry because all conversions are made today itself. If you observe, money market hedging law, forward rates are not involved. Money market hedging law, what rates are involved? And shall I tell you another point? Answer one by one. Getting $5 lakh pounds after 3 months is certain or uncertain? Certain. They don't make a default. Like that we should assume. What default? That is called as a performance default. Forex don't cover that. Okay. Yes, insolvency code. Sir, listen. Say 5 lakh pounds, receipt of 5 lakh pounds. I'm not talking convertible amounts. Everyone please answer. Receipt of 5 lakh pounds after 3 months is certain or uncertain? You borrowing that much amount, present value amount to today at borrowing of pounds 4,93,827 is certain or uncertain? Again, start from the beginning, please. Someone is not answering. Please, everyone, participate. You receiving receivable of 5 lakh pounds after 3 months, certain or uncertain? Very good. Present value of this 5 lakh is coming to 4,93,827 today. Is certain or uncertain? That much amount you are borrowing today is certain or uncertain? Today's spot rate is certain or uncertain? Your conversion is certain or uncertain? That amount converted to this much amount is certain or uncertain? Today you went to Indian Bank is certain or uncertain? You deposited it 3 months for 12% per annum is certain or uncertain? That much amount will definitely mature to this amount, certain or uncertain? Everything is certain, nothing is uncertain. That's called as a hedging. Are you understanding the concept or not? Also, uncertainty is totally wiped in money market hedging. Everything you can sit today and tell what happens in future. Are you understanding or not? So this became one of the most popular ways of hedging strategies. Did you understand the point or not? So like this we can also do for a payable with a two-way quotation also. So you copy this, we will do that. If you have any doubts, you can also check the StudyMate answer. It is there in your material, what I given you. Okay. Hello, completed everyone? So the arrow mark should be like this. This payable will be knocked using this receivable. For this 5 lakh, I have received this much. So you can easily tell like this. 2 crore 84 lakh 83,941 divided by 5 lakh. You received 56.96 for each pound. You received how much? 56.96, almost 57 rupees you received on each pound. Are you understanding or not? This is how you can understand. Sir, if the forward quotation given by the banker is 56.1, what you will choose? Money market hedging, you have to choose. Like that also question can be tested. If you complete, we go to next one, we will do together. Shall we start? Let's take question number 29. Take question number 29. Take question number 29. See there. An exporter is a... Sir, stop sir, please everyone. Last problem on MMH. We'll go to currency options and futures. See there. An exporter is a UK based company. Invoice amount is $3,50,000. Credit period is 3 months. Exchange rates in London. Spot rate 3 months forward rate. Rates in money market 7-9 deposit loan. Pound 5%, 8%. Compute and show how money market hedging can be put in place. Compare and contrast the outcome with the forward contract. We don't even need forward now. I'm not going to do. Let's do only for money market hedging. Shall we begin? Before that, just take a minute, read the particular question properly. Okay, see here. So first tell me what is a term? What is a term? Okay. So first, one by one answer to this. Please. Payment or receipt? Receipt. Receipt with one-way quotation or two-way quotation? Two-way quotation. Credit period is how many months? 3 months. Spot rate to forward rate given. Can we do the money market hedging or not? Let us do together. Start. So totally how many boxes has to come? 4. Let's do together, please. First. Three months and 3 months. Sir, see there. Please. 3 months and 3 months. First tell me. So please don't waste time. Practice in the class. Tell me. We are having a receivable or payable? Receivable. Asset or liability? So we need to create a payable being a liability. First write down these two. This is a correct pattern. So you will have a clarity. Okay. Receivable. What is the worth of the invoice? $3,50,000. What is a payable? Payable is a liability. I have to borrow on a depositor. Borrow present value of exposure. So you should only tell me borrow in which currency. So see the question clearly. Invoice amount is in what currency? Dollar. And again, you see the rates clearly. $/pound. What does it mean? Did you understand the point or not? 1 pound equal to, this is also directly given normally only. 1 pound equal to dollars 1.5865 dash 1.5905. Sir, we should understand which is more stronger, dollar or pound. Therefore, 1 pound equal to dollars, they have given in that format. Clear or not, everyone? Okay. Listen carefully. See here. So, borrow present value of exposure. You should tell me what is the exposure value? $3,50,000. Borrowing rate in dollar. What is the borrowing rate in dollar? 9. We should take 9. 9 into 3 by 12. 3 by 12. 2.25. 1.0225. Value, please. $3,42,298. Don't just copy. You do on your own. Next. Sir, immediately I received $3,42,298. I keep it in dustbin. I will convert. Convert today na after 3 months. At what rate? At what rate? This you have to answer. 1 second. 1 second. 1 second. See there. First, spot rate we are going to convert. Tell me. What is the per unit currency? What is the per unit currency? We should think everything from whose point of view? So tell me, how many dollars we have? We have to convert this into what? That means we want to buy pounds or sell pounds. Buy pounds or sell pounds. Buy pounds. We have to buy pounds. Bank has to sell pounds. Bank sells at higher rate. Higher rate will be ask rate. Therefore, what is the required quotation? Required quotation is ask of dollar by pound spot. Understood or not, everyone? Please tell me what is the dollar by pound spot? 1 pound equal to dollar 1.05. So please write down here. Sir, I borrowed here. What I have to do? Deposit. Deposit dollar 3,42,298 converted to pounds. How much value? $3,50,000. Sorry. I'm very sorry. Not $3,50,000. How much I need to take? $3,42,298. 3,42,298 divided by 1.5905. 2,15,214. These many pounds. What I have to do? Deposit. Where? Where deposit? UK. This will be stagnant. It will mature in future. It will come for a maturity value. Okay. Take maturity value of deposit. Pound 2,15,214 into, we have to take loan rate or deposit rate. Deposit. How much percent? 5. 5 into 3 by 12. How much it is? 1.25. 0.0125. 217,904. That's all. Please see the study material answer. 217,904. I will check the answer. 217. See here. Exact answer. Never we will be wrong. What is answer? 217,904. 904. Exact answer. 0.45 is overaction. Pounds lo why we need overaction? Sorry, anyway, the overaction and underaction, leave it off. Understood the concept clearly? Yeah? That's how they will ask questions in exam with regard to money market hedge. Sir, money market hedge till now we have done for receivable, payable. For what we have done? Let us do one payable question also. You will get clarity once you do one payable. Okay. Question number. Sir, please. Question number 40. I am doing this from currency options, currency futures point of view. Along with that, MMH is also asked. See the question there. This is a question on currency options, currency futures also. The currency options also of MMH. Shall we do? Sir, forward cover don't touch. Waste of time. What are the two things we need to do here? Money market hedging and currency option. Currency options are very, very difficult. Please listen and apply your brain properly. I will explain the easiest way possible. Okay. So before going into that, let us check question number 40. 40 study material. In my book also it is there. If anyone want, that question is, see this one. Question number 7, forward cover. This is the point. Money market hedge. This is a question. Shall we continue? Okay. Sir, I have given the best presentation for currency options and futures. Let us slowly do this. Before going into that, keep the heading money market hedge. Sir, money market hedge we are doing for receivable, payable now. Payable. First, what you need to do? Dabba. How many dabbas? Sir, honestly tell me. One second. Honestly tell me, after drawing these 4 boxes and doing in a sequence, do you need to remember a deposit, receivable ki deposit, payable ki deposit? Do you need to remember all those? I said. So, don't depend on remembrance, depend on a flow. First, you have to see the question. On that flow, you need to do entire answer. Don't remember payable is receivable or receivable is payable, payable is deposit. Don't do like that. Go as per the flow of that particular problem. You will give a correct answer for that. Take 4 boxes. Let's do. Please give me the time period first. Write down 6 months, 6 months, 0 month, 0 month. So participate properly, please. Important question. See the question and tell me. A Limited of UK has imported chemical worth US dollar 364,897 from one of the US suppliers. The amount is payable today in 6 months time. So the relevant spot and forward rates are spot rate US dollar, 6 months forward rate US dollar. The borrowing rates in UK and US are 7% and 6% respectively, and deposit rates are 5.5% and 4.5% respectively. Currency options are available under which one option contract is for GBP 12,500, that's called as a standardized lot size. The option premium is US dollar. The option premium for GBP at a strike price of 1.7 is 0.037, put is 0.096 for 6 months period. The company has 3 choices: forward cover, money market and currency option. Which alternatives is preferable by company? 10 marks. So this is a 10 marks question already, 12 marks question already tested in exam. They have given forward cover for 3 marks, money market hedge for 4 marks, balance for currency option. 12 marks question given in examination. Big problem. We are not going to do forward because we already know how to do the forward. Answer. Just tell me one point, sir. Whenever forex question is given, first you need to check What is the per unit currency in the given question? See there. Therefore, everything you should think only from whose point of view? Tell me, we are importers or exporters? Importer, exporter? Importer. And you need to think only from whose point of view? First tell me, invoice is in, but per unit currency is. So you should express the entire quotation only from whose point of view? Pound point of view. So tell me, we have to, first one, we have to pay in dollars. Actually, we have to pay in dollars. So we have to buy dollars. Buy dollar can also be understood as a sell pounds. So from pounds point of view, tell, we are going to sell. Bank has to, 1 second, start from the beginning. Tell me, what is the per unit currency? So we should think only from whose point of view. But the quotation is invoice is in which currency? So how to understand? We have to pay in dollars, means we have to buy dollar, sell dollar, buy dollar. We have to buy dollar. But quotation la buy dollar is given, pound is given. So convert into pound. We have to buy dollar means in reverse what you can tell? We have to sell pound. Okay, we have to sell pound. Bank has to. Bank by side. Lower it will be. Required quotation will be bid of dollar by pound 3 months forward. In the question, see, bid of dollar by pound 3 months forward. How much? 1 point. Why spot you will take care? I am talking about forward hedging. Start from the beginning. Tell me. I am asking you about forward rate. Tell me. Forward rate. We are given invoice in which currency? Answer. But the per unit currency is. So we should think entire question from pound point of view. Clear? Okay, done. First tell me. We have to pay in dollars. That means we have to buy dollar, sell dollar. Buy dollar. But the quotation is given on pound. Buy dollar can also be understood as sell the pound. Clear? So tell me. So now start the transaction. We have to sell. Bank has to. Bank by say. Lower it will be. Required quotation will be bid of below pound. Okay. Dollar by pound. Today na 3 months forward. 3 months forward. So the 6 months forward. How much? 1 point? 1 point? Okay, roughly I am writing here. Tell me, 1 pound equal to dollar 1.5455. Okay, how many dollars is there? 3,64,890. So how many pounds? 2,36,103. This is the answer. You can see the answer as well. 236,103. Please see here. This is the answer. Okay, now 2,36,103. Next, now we completed forward hedging. What is the next hedging strategy? Money market. Please do this properly. Some critical points will come in this question. We have to do that properly. Please see there. First, in the question internally, if you observe, he said there are 4 rates. Borrowing rates are given. Deposit rates are also given. Yes or no? Yes. We have to convert that into 3 months, 6 months period contract. Okay. Next. First, one by one, let us do. Tell me, we are having a payment receipt. Do along with me. Receivable or a payable? Payable. Payable in dollars 3,64,897. 3,64,897. So now tell me, here we created a liability, asset. Obviously, here what we need to create? Asset. Asset means receivable or payable? Receivable means I should have a deposit or borrowing. Deposit. How much? Present value of exposure. You should only tell. What is the exposure? Dollar 364. 897 divided by, please listen, we are making deposit of borrowing. Deposit rate in USC is how much? 4.5%. How much? 4.5%. See here, in the 1 second, sir. Please listen. 4.5%. I will show you one point. See there. 4.5% whenever you take. Okay, 4.5% whenever you take, it is to be converted into how many months contract? 6 months. Because they have given 4.5% directly. Yes sir, everyone. That's what I want to tell. Convert. 4.5 into 6 by 12. How much it is? 1.0225. So 364,897 divided by 1.0225. How much it is? 356,867. So those are pounds or dollars? Dollar. Now tell me, 1 second sir, answer. This deposit will mature to how much after 6 months? So this will take care of this payable. Hope you can understand. This will take care of this payable. But you have to remember one very important point. Tell me, now this will be converted into pounds. Yes or no? Wrong. To deposit, first I should have equal amount of money in my home currency, pounds or not. First I have to borrow. Arrow should come like this. I should borrow and convert. Are you understanding or not, everyone? So to deposit there, first I require money or not? Write down. Borrow. Pound equivalent of $3,56,867. Pound equivalent of $3,56,867. Did you understand what we are doing, sir? We are converting 356,867 into pounds. Borrowed pounds are already converted into that amount. Sir, use common sense. We are depositing means first we require money or not. What is our home currency? What is our currency in what is our country in this case? UK. Means our currency is what? How you got dollars? You might have converted pounds. You deposited in dollars means you should have pounds or not. From where you got? That's all. That means first you borrowed and then deposited. Understood? So one thing you need to remember. Receivables means you convert like this. Payables means you will borrow and convert. Always remember, first borrow will come. First what will come? Next what will come? Because deposit after no one will borrow. Borrow and deposit or deposit and borrow na? Borrow and in case of receivable, here the borrowing will come. Therefore borrow and deposit. But in case of payable, borrowing will come here. So borrow and deposit. Listening or not? How much I should borrow in pounds? That much amount which will get converted into $3,56,867 today na, after 6 months. Today. Spot I need to convert everything. So please tell me 1 point. I require how many dollars? So my currency is what? Therefore I need to borrow first in which currency? How much amount? That much amount at the spot rate should get converted into. Can we do or not? First tell me. I want to convert pounds into dollar. Means I want to sell pounds or buy pounds. Per unit currency is what? So everything you should understand only from whose point of view? Therefore I have to sell pounds to get converted into dollar. I have to buy pounds. Answer. We have to sell pounds. Bank buys it. Lower rate will be. So tell me, what is the applicable rate? I will write here, bid of dollar by pound. So tell me, what is the bid of dollar by pound value? 1 pound equal to dollar 1.56. What means spot rate only? Now I want how many dollars? Dollar 3,56,867. How many pounds? 867 divided by 1.5617. How much? 2,28,512. Yes or no, everyone? These many pounds I need to borrow. These borrowings has to be repaid. Maturity value of borrowing. Maturity value of borrowing. Pound 2,28,512 into. So tell me, what is the interest rate for borrowings in UK? 7 means we will take direct 7. 1.035. So 228,512 into 1.035. How much? 2,36,510. So you can check the institute study material as well. Same Last one. What should be the last one? Currency options. If you don't listen, you will fly off. Okay, first we are entering into the dangerous zone. What is the point? Currency options. Correctly you do this one question alone. No need to do hundreds of questions. One single question. Pasak. Make sounds. Question will come in examination. At that time I will stand outside your room. I will see forex currency option. Currency future. I will also shout. See here. A Limited. See there. A Limited has import. Sorry, I am reading question. So listen. We are now entering into which market? Currency options market. Sir, we are not going into money market hedge. Sir, money market hedge, everyone thorough. So as per my promise, all hedging strategies are getting completed. Last one also we are going to complete. What is the last one? Currency options. Okay, see there. Currency options are available under which one option is for GBP 12,500. Option premium is GBP at strike rate of 1 GBP equal to US dollar 1.7. USD 0.07 call option, put option 0.096. First, everyone read the question. Answer one by one. We are going by which option? Third option. What is the third option? Currency options. Tell me. Second question. Question number 2. We are having a payable or receivable? Very good. In payable, we have to buy dollar, sell dollar. Buy dollar, we have to pay, we have to buy dollar, sell dollar. Buy dollar. That means we have a payable or receivable? Liability or asset? Okay, next, fourth one. We need call option or put option. What is the call option? Please tell me. Right to buy. Next, put option means right to sell. We want to sell, we want to buy. So call option or put option. Like this, you should not think. Reason is very clear. Given quotation is in pounds. We should check pound point of view. I said hundreds of times. Forex chapter means always what is important? Per unit currency. In the given quotation, what is per unit? Dollar call can also be understood as pound put. Sir, I am buying dollar. Means in reverse, what else I am doing? Selling pound. Yes or no? Pound selling means I want a pound putta, pound caller. Therefore, put option will work here. Selection of rate is important. Did you understand what I said now? Tell me now, I will repeat once again. In the given quotation everywhere, what is a per unit?
Sir, always forget about everything. Standardized lot size is given in which currency? In that currency only everything is getting traded. Our currency is given is also in answer, but I have to make the payment in. But still, entire understanding should be made only from pound point of view. Are you understanding or not? Okay, now tell me, you are making a transaction in pounds. Okay, every transaction. Now tell me one by one you answer. Per unit currency is what? Options is created on what? So I should think only from whose point of view? My invoice is in. I have to pay in. I have to buy a dollar, sell dollar. But quotation is given in dollars, but it is given in what quotation? So buy dollar means in reverse it is. Sell pound means I want option to sell, option to buy. Means put option, call option. For first selected is pound put option. This is the first answer. Clear or not, everyone? Let us do one by one. Let us do first currency options. Step 1, selection of option. Selection of option. Selection of option. Dollar buy is also called as pound sell. So we need pound put option. This is a summary of this answer. Shall we do together, everyone? Very good. First point over. Second. Step 2. Step 2. Calculation of number of contracts to be traded. Calculation of number of option contracts to be traded. Calculation of calculation of number of contracts to be traded. You should only tell me, see the screen first. Number 1, tell me what is the invoice value? $3,64,897. Write down. I will ask question, answer and then write. If you copy concept you will lose. Okay, till now you have done that only. That's a problem. So don't copy when I am discussing about it. So please listen. What is the invoice value? $3,64,897. Up to here, clarity, yeah? Now, furthermore, let us move on. Please, first I will write. You tell understood or not. After that, I will give time. You copy. First point number 1. We created the contracts in which currency? Sir, everyone. Pounds. We need to enter into options contract or not. That options contract is created in dollars or pounds? Pounds. Therefore, I need to convert this dollar invoice into which invoice? Pound invoice. I have to convert for the purpose of entering into currency options market. Because the options are getting traded on. So, I want pound value of this dollar invoice. We are in which market? We are in which market? Money market, forward market, options market. Therefore, in options market, what price is there? At that price, we need to convert into invoice value. That's called as a strike price. At what value I need to convert this invoice? Strike price. Because we are in which market? Options market. In options market, forward rate is irrelevant. Money market rates are irrelevant. Spot rates are irrelevant. Those are all bankers rates. This is the stock exchange rate. Strike price who will give? Banker SBI will give strike price. Who will give? Who will give, sir? Stock exchange. Therefore, you are in a different market. So, when you are in that market, that prices will be traded. Are you understanding or not? So, tell me, invoice value is how much? Okay, write down. Strike price equal to, you see and tell me how much is the strike price given in the question. US dollar 1.7 per GBP. 1 pound dollar, how much? 1.70. Number 3. Invoice value in pounds. So 364 897 divided by 1.7, how much? 2,14,645. ఏంటిది 2,14,645 pounds. Why we converted, sir? First tell me the reason. Contracts are created in terms of dollars or pounds. Therefore we are forced to convert. Really invoice is in pounds. For purpose of what we are doing this? For purpose of currency options hedging we are doing this. Everyone understood? Number four, standardized lot size. How many? Pounds 12,500. Number 5, number of contracts. 214,645 divided by 12,500. 17.1716 contracts. But 17.1716 fractional contracts we can create in future, sir. No, we can create only how much? Rounded off lot sizes only. Yes or no? Therefore, round off to approximated to how much? 17 contracts. Round off to 17 contracts. Shall I continue, everyone? So we rounded off to how many contracts? 17 contracts we have rounded off. Shall we continue? Okay. So we converted into 17 contracts. Okay. Now, not at done. Please see here. 17 contracts we have converted. Okay. Now listen. 17 contracts we completed means there is a problem here. 0.1716 contracts are not covered. Yes or no? 0.1716 is not covered. So first write down 6th point also. Covered portion. 17 contracts into pounds till 12,500. So 12,500 into 17. How much? Pounds 2,12,500. Only this much is covered now. Yes or no? What is my total invoice in pounds? In that only how much is covered? Balance is uncovered or not? We can't keep the exposure uncovered. Yes or no? That balance we will again take back into dollar invoice at 1.7 rate. First, everyone, please, presence of mind. One question you are doing, please keep your presence here. 214,645 came because of conversion of 364,897 and 1.7 SR. Did you understand my point or not? 214,645 came because of converting 364,897 at 1.7. Are you understanding or not? So 364,897 is converted at what rate? Because of which only I got 214,645 or not? Really I should convert invoices, huh? No, but purpose of hedging we converted. But in that how much is unhedged? 212,500 minus 214,645. 2145 is unhedged or not? That we have to again take back to dollar invoice. Clear, huh? So divided by 1.7 into 1.7. Very good. Into 1.7. How much it is? 3647. 3647 euros, sorry, pounds or dollars are. That much amount is unhedged inside this. Yes or no, everyone? That will be hedged using forward. That will be hedged using. That will become forward cost, options cost. Options cost. Because of imperfection in option, we have to enter into forward or not? That will be accounted into the cost of options only. Did you understanding? We are entering into forward intentionally here because of inefficiency of options. Therefore, that should be taken into the cost of what? Options only. Because I am not going totally to forward. Since you could not cover full contracts, I am going into the forward contract. Therefore, that cost also should be included into the cost of options only. Understood or not, everyone? Now you should tell and you should do. Tell me step 3. Number of pounds to be reconverted into dollar and hedged using forward forward. Shall we do now? Number of pounds uncovered. Tell me, how many number of pounds are uncovered? 2145. Very good. Next, reversal rate. Which price? Strike price. How much strike price? 1.7. So number of dollars uncovered. 2145 into 1.7. 3647. 3647 what? Pounds or dollars? Dollar. This is dollars, na? So $3647. So this one I need to cover through what? Forward, forward, okay. Forward, buy forward seller. That's what I'm asking. Again, I'm telling you, when you are telling forward, again go back to the normal concept. Transaction is happening with the per unit currency being. So we should think everything from whose point of view? So tell me, we have to buy dollars. Means we have to sell pounds. We have to, tell me now, continue. We have to sell pounds. Bank has to buy pound. Bank buys said lower rate will be, therefore required quotation will be bid of dollar by pound. We are buying at spot in forward. Answer. So bid of dollar by pound, forward rate we have to consider. Understood or not? Write down cost of forward. Step 4. Cost of forward. Bid of dollar by pound. 6 months or 3 months? 6 months forward equal to, please see the question. 6 months for 1.5455. 1.5455. So 1 pound equal to dollar 1.5455. We have dollar 3647. Tell me. 3647 divided by 1.5455. How much? 2360. 2360. What is this? 2360 dollars or pounds? Pounds. So as of now, 2 costs we have taken. Cost number 1 is 2,12,500 through the options. Next one is 2360 through. We should add to the forwarder, we should add to the options cost. Why we are adding? This happened not because of forward cover. This happened because of what? Inefficiency of options to cover the standard sizes. Here or not, everyone? Last. Step 5. What is step 5? Cost of premium. Without paying premium, who will open the contract for you? Cost of premium. Tell me. Premium will be paid for 17.1716 contracts or 17 contracts. Why? Uncovered portion. Why we will go to options? So write down number of contracts 17. Number of contracts 17. Number of pounds per contract 12,500. Premium per pound dollar. We should take call up, put 0.096. So premium in dollar 0.0 0.0 This calculator not working. 1 second. How much? Dollar 20,400. Sir, up to here understood everyone? Hello, everyone understood? Why we calculated this? First you need to pay this premium or not? Tell me, we will pay premium in dollars or we will pay premium in pounds? We have to pay in dollars, no doubt. But we have to spend our pound currency or not? So tell me, we will pay premium and then enter into contract. After entering into contract, maturity premium will be paid. Using spot rate, again we have to convert this into pounds. Right on. Pound value of premium. 12 marks is very less, sir. So, pound value of premium. Pound value of premium. So, we should take spot rate or forward rate? Spot rate. We should take spot rate. So, tell me, bid of dollar by pound spot. Tell me how much is the bid of dollar by pound? 1 pound equal to dollar 1.5617. 1.5617. We want how many dollars, sir? 20,400. 13,063. 13,063. Everyone understood what I have done? Answer 13,063. So now tell me, how many costs are totally there? One by one, please tell me the values first. Pound 2 lakh 12,500. Next pounds. CN tell ya 2360 plus 13,000. Please tell the value. 2 lakh 27,923. 227,923. 227,923. 40th question. I am saying the answer from the institute. What is answer? 227? 227. So 47th. 40. 227,923. Exact. Never go wrong. So this is the answer for the question on currency options. This is how we have to do. Sir, really tell me, is it difficult? It just requires some patience, thinking process. You have to sit and do that problem. That's all. Applying the rates is important. So do that properly. You will crack easily. So with this, same sir, options and futures also same logic. Just instead of options, they will take the futures in this case. So remaining everything is same. So with this, all these areas are also being completed. Sir, first answer up to here, whatever we discussed, are you all comfortable? Everyone in the class? So we completed up to here. Next. So everyone is exhausted. Just I want to give that information as well. Sir, now the time may not be sufficient to carry on that, but for SFM regular classes, I have to upload them 2 topics. One is theory in SFM. So 3 hours or 4 hours are recorded till now. Another 4-5 hours will be taking. IRRM SWAPs, that will be one set. 14 hours already recorded. Okay. 13 hours, 20 minutes, something it came. I have divided that into 6 classes. 1 hour, 1.5 hours like that. Okay. I will be putting that into the YouTube directly. You can, whenever you want, you can listen to that, because IRRM and SWAPs will be a 6 marks to 8 marks question will come from that IRRM and SWAP. This time, definitely IRRM SWAP representation will be minimum 10 marks will be there in exam. Clear? So therefore, what I have done is, for so many students are asking, not just you, everyone is asking that, because who have taken coaching from me, anyone. When I have given the recent classes for SFM, due to the time constraint, I have given all the chapters except that SWAPs concept, IRRM and SWAPs. So anyway, for my students, I have to upload on the YouTube. So therefore, what I have done is I recorded 14 hours of lecture, around 13 and odd it came. So I am breaking that into 6 lectures, 1.5 hour, 1.5 hour, 2 hours like that, and I will be putting onto the YouTube. Full clarity, and you can believe me. At least now. Before, if I tell, no one need to. So each and every point, how the interest rate swaps occurs, starting till the end, and I have uploaded regular classes only. So you can imagine how it will be. So listen, sir. So the point is, I have uploaded the regular classes directly. So the regular classes have been uploaded. I will be uploading into the YouTube channel directly. So stay into that YouTube channels. Definitely all the videos relating to the direct access. So many students are also asking. Actually, last month I have to do, but last month I was fully packed with the schedule. Sudden schedules came for Inter FM. So I have to lock myself into that. So because of that reason, this month, I mean in the month of March, I will be having only 2 works. Number one, Inter FM, Inter revision I have to do, because once I put it in YouTube, first question that will come is, Inter students they will ask me first question, why you are not doing for me? Did we do any wrong to you? Didn't we pay fees to you? Why you are not doing like that? They will question me. So first thing is, I have to take classes like this also for Inter students. Inter FM, Inter Law, again I have to take. So law already completed, so no problem. Inter FM is there. So I have only 2 works. Number one, IRRM also recorded. I will upload, no problem. That I will do. So I will be having only 2 works. Work number 1, SFM theory I have to record. I recorded only 3 hours. Whenever I start trying recording, I am getting sleep. Really, I started startup finance. I opened. I tried to explain. One day, what happened is, in my home, I am sitting. Okay, I am sitting there. I started recording. I kept startup finance. Something I am trying to explain. Okay, I'm trying to explain something. Practical problems means just like the jujube we will do. The difficult, easy, that will not be there. Any problem. So flow will come. Startup finance, they have given some theoretical questions. 6-7 theoretical questions are there in startup finance. I started doing it. But I explained. After some time, when I slept, I don't know. So I kept hand on my keyboard. Some oh no, yes or DO is going on. So another person came to me and said, what you are doing? Then I realized that I was almost coma stage after seeing that startup finance. Then I understood I am unfit for SFM theory. So with regard to pure theory chapters, but I will do, because securitization is anyway related to law subject only, I can do that. So pure theory chapters, 2 chapters are there. I am taking another person out from me. I have to, by force, by hook or crook, at least for the regular batch students, I have to do that. So they are also asking me consistently. So I will be doing that. And next one, a small another SFM revision class will be there again, because I will cover small concepts like mergers and mutual funds also there. I have to cover, because not just you will again listen along with you, others also. I have to put that, because small chapters are there, some small areas like mergers, acquisitions, mutual funds. That is sir, corporate valuation, if you do, you need not separately do. Same concepts will be repeated. We have done that. That's not a problem. Any 2 topics that are remaining means there are only 2 topics that are pending for us. One is mergers, other one is mutual fund. But so please, one second. Everyone, are you thorough with whatever we have completed? The substantial 60-70% portion every day, 9 hours. Everyone, sir, any review about how the class is? Word action ended, eh? Hey, listen here. Sir, tell me, honestly, anyone want to say any word about the classes? Because law classes, I need not ask that question. There is only one Koushik Mukhesh. So, therefore, I don't ask that question. That I want to replace also for this. So, that's why I'm making a hard effort always. So, after a gap, I came now. So, people should also know. And one person is there in South India, people should know that they can make a resounding effect. So once these videos, all these once these videos comes to the YouTube, everything, it creates sensation. At the time, definitely people should know that there are persons also here. Best. Okay. So therefore, yeah. So sir, first thing, whatever the pending 2 topics are there, I will definitely do and put it on the YouTube first as an emergency. 2 topics. One is mergers, because no one will be ready to listen to for a new chapter now, like mergers or mutual fund. But I will make definitely live. I will come, because recording means you can't believe me, because I may not be in a position. Directly I will come up live. So 3 hours live if you put na. Most important questions on mutual funds and mergers I will cover there. That's not a problem. Main concepts which are very difficult. Forex law, all concepts you have covered or not? Derivative options, derivative futures, bond valuation, currency options, and all the hedging strategies here, futures, all these concepts have been covered. Corporate valuation, so including FCFF models, everything. What are difficult are our target. Those are all completed. I hope that I didn't just complete easy chapters. Are you understanding or not? That is always will be there. Don't remind me about portfolio. Maybe who have taken the regular classes will know. Stress always Koushik Mukhesh is equal to portfolio management type, because in the entire CA SFM curriculum, if my class is running for around, fast track will be for around 180 hours, regular maybe 300 hours. Then shall I tell you how many problems are there in regular? 791 problems I solved. Fast track, I mean exam oriented, 431 problems. So in and out SFM that border to this border, everything. So listen carefully, sir. Okay, listen, sir. My point I want to tell is, from the beginning till the end in all the classes, do you find that the sessions are important and something new you have learned in the class? Do you find these 4 days are a waste of time for you? So did you find that you completed faster than what you do individually? Mainly we completed big chapters and we have done almost all the problems, all big problems, all important, all difficult problems, all study material questions we have done. Especially the chapters like Forex also we completed. So therefore all the big chapters, important chapters, everything I have covered. So hope you like these sessions. So please tell to your friends if you really like the session. Okay, again we will be meeting on a YouTube channel again. We'll have a continuous sessions this time till you write the examination. So any say about the classes if you want, you can. If you really find it really useful, you can put a say about how the classes are. Nothing is getting recorded. Okay, nothing is getting recorded, not for promotional purposes. For me, because this much marketing is there for me, I need not again ask, because I know negative also you'll spread in the same way. I know that also. అది కూడా నాకు తెలుసు, రాట్ అయితే ఎలా ఉంటుందో కూడా తెలుసు నాకు. So there is no compromise. Students I know very well, because it is not new for me. Since 10 years I am traveling with them. I know if it is good, how they take on head. If it is bad, I know how they will tell to others also I know. Because some people will come to me and tell. So they are not about me. So therefore I know very clearly. So that's a big marketing, no problem. Student I will tell to 10 persons. I'm not talking about that. Anyone want to share your views as to how the classes are? You can. You want to tell? Come bro. Take that mic. Take that mic.
హాయ్ ఫ్రెండ్స్, యాక్చువల్గా నేను జాబ్ చేసుకుంటున్నాను.
One second.
హాయ్ ఫ్రెండ్స్, యాక్చువల్లీ జాబ్ చేసుకుంటున్నాను.
సారీ
ఈ అటెంప్ట్ అసలు ప్రిపరేషన్ స్టార్ట్ చేయలేదు. నేనైతే ఇప్పుడు అసలు ఈ అటెంప్ట్కి నేను అసలు అన్ఫిట్ అనుకున్నా. ఈవెన్ ఒక్క పేపర్ రాద్దామని డౌట్ వచ్చింది. ఐ మీన్ ఒక పేపర్ ఇద్దామా ఏంటని డైల్మాలో ఉన్నా. బట్ సార్ క్లాస్ అటెండ్ అయిన తర్వాత నాకు లా కానీ ఎస్ఎఫ్ఎం కానీ బట్ అంటే పర్వాలేదు ఈ అటెంప్ట్ నేను ఒక గ్రూప్ క్రాక్ చేయగలను ఒక కాన్ఫిడెన్స్ అయితే వచ్చింది. సో ఐఎమ్ రియల్లీ థ్యాంక్ఫుల్ టు సార్.
థ్యాంక్ యూ వెరీ మచ్.
అంటే నాకు అసలు నేను ఇక్కడికి రాకముందు వరకు నా ప్రిపరేషన్ 0 అటెంప్ట్ అయితే ఆనెస్ట్లీ స్పీకింగ్ అసలు ఇప్పుడు దాకా అసలు ఈ అటెంప్ట్ బుక్కే టచ్ చేయలేదు. నేను ఇక్కడికి వచ్చిన తర్వాత లాస్ట్ అటెంప్ట్ ఇక్కడ బుక్స్ వదిలేసాను హాస్టల్లో. ఇప్పుడు వచ్చి సార్ క్లాసు మార్నింగ్ వచ్చానమాట. ఆ రోజు వచ్చి బుక్స్ తీసుకుని అంతే. బట్ నాకు లా కానీ ఎస్ఎఫ్ఎం కానీ ఓకే ఇవన్నీ రికలెక్ట్ అవ్వడం కానీ నాకు కొంచెం కాన్ఫిడెన్స్ వచ్చింది. లా మీద ఎస్ఎఫ్ఎం మీద ఐఎమ్ చాలా హ్యాపీ. సో ఈ అటెంప్ట్ గ్రూప్ మీద ఒక చిన్న హోప్ పుట్టింది. థ్యాంక్ యూ సో మచ్.
థ్యాంక్ యూ బ్రో. Anyone else want to share your view? So your views will be taken directly. Okay. So your views are very, very important. So tell me, anyone, how you felt about, because 4 days, your thinking process might have changed. Your ideology may change. Many changes may come in this 4 days time. How you are before 4 days with regard to this subject. You may not be in the same state, starting from the bond valuation chapter. So you can share your views. Ma'am, you are telling something. పురజనుల కోరిక.
After this 4 days class, we got conceptual clarity. Before, like, we used to mug up a little bit formulas, but now we understood what is the exact meaning of that formulas and easy to do the problems and all. It's thank you, sir.
Leave them.
Thank you, sir, for the class.
Thank you very much. Thank you. Anyone else? Anyone? Who is Nikhil? Sir, okay, no problem. Sir, everyone is satisfied with the classes, everyone. So again, 2-3 topics I will be taking. 1 full regular classes I will keep, IRRM and swaps, no problem, I will do that. But we have to do revision of another 2 small chapters. Maximum we tried, but small portion of mergers and mutual funds is pending. So we will be doing that. Mergers and mutual funds we will be covering out in a YouTube class, a live class we will have. Max I will spend only 3 hours and 4 hours. 7 hours we can complete that entire portion. Once that is completed, we can also put it onto the YouTube. You can view at any time. So I will be coming up live with regard to those 2 chapters. One is the mergers and the one is the mutual funds. Most important problems in those we will be doing there. Sir, are you confident with all the big chapters like options, futures, currency options, currency futures, forex? Everyone? Okay then. Thank you very much. All the very best. Bye.